the concentrations in its economy, the failure of diversification in the U.S. economy, the inability to moderate expansions that get out of control, etc. If we don't get rid of that model, if we don't understand that the need to get rid of that model, all of this will continue. And getting rid of that model will require a systemic approach to the global payment system.
As a further comment on development, comment on your proposal to channel portfolio investments toward development goals rather than solely towards short-term profits of investors. In All Fall Down, you present this as an idea for restructuring flows of private international investment to emerging and developing countries. It seems to me that this kind of restructuring of flows of private international investment could also provide the kind of patient capital all countries of the world need in order to meet climate goals.
It could indeed. And the idea there is to build again on the World Bank framework, but to have the ability to use a closed-end fund. A closed-end fund means that in the market, if you have to sell the shares that you have bought into this fund, you will take the market price. But it means that the issuer does not have to sell the asset. Whatever goes on in the market, that's okay. But having made a loan for infrastructure in country B, that loan will not be disturbed. No sale will have to happen. That's why it's important. It's also important because it is a place, an additional place, for the reserves of countries, not only necessarily emerging countries, to be put where they are not subject to political issues or things of this sort. And so the other very important issue there is that they are a place for emerging markets to acquire assets that can be used as reserves on their balance sheets in order to expand or contract their own economies. And so that would be a very important fact as well. And I think one of the issues that needs to be addressed, and UN did address it some years ago, is the what's going to happen with all the pension funds that are being generated in emerging economies, and they are substantial because very much like our own state and local governments, that is something that can be is being done by governments in emerging markets and some private sector, but mostly at this point governments. And so, how do you invest them so that you get return, you get the development you want from them, and you've got to create a situation in which they become a stable investment somewhere, non-national, etc. And so then you could actually make use of the monies that are created in a given economy to reinforce its development strategies. And in advanced companies as well, because as you say, climate change is going to be a major issue in terms of the need for stable investment.
And a closing thought?
I do not see the political will at the moment to initiate the kind of discussions that I would like to see happening. If they do happen, it will be as a result of yet another crisis. And as I have said repeatedly, I believe another crisis is coming. The build-up is very similar to the one that we saw at the beginning of the millennium. On the other hand, I also know that we have made some progress. After that last crisis, we see out, at least in the American situation, so many groups now that are concerned about economic issues, and they were not there before. I mean, the hopefully the internet has made this possible as well by giving people the ability to do the research and also to publish the material that they write. And so that is a different world from the one that we were in before, and at the beginning of the millennium, and that is very hopeful. That is where I am hoping that things will begin to work out.
Jane DeRista, thank you.
Thank you.
And thank you for joining us.
Hello, everyone. My name is Lotfi, it's like a sneeze, Lotfi. And I'm founder of Yiki. We're a partner of SOCAP, a media platform. So we're making accessible to everyone the possibility to create community video campaigns. And when SOCAP asked me to join the team on hosting the conversation around smart contract, just make sure you're at the right place, smart contracts, blockchain technology as a blended finance tool. I said, okay, that's going to be not geek. It's going to be really, really close to the reality and to the field. So we have three great speakers, and they know they're really on the field on it, are investing on it. So we're going to have a great conversation. So without further ado, I'm going to ask you to introduce yourself in just 2 or 3 words, sentences. And at the same time, we're going to go up into the question, what is smart contract for us in a simple way? So if you can introduce each other briefly.
Hi, everyone. Good afternoon. Hopefully we have some coffee in us after the afternoon slump after lunch. My name is Antoinette Marie. I'm the director of Heifer Labs. We're a digital technology support unit within an INGO called Heifer International, working with smallholder farmers in Asia, Africa, Americas, and the US. My team's role is to work hand in hand with our country and our regional leaders, looking at their programming and determining how digital solutions can help them accelerate and achieve their impact through intentional and locally led programmatic integration. It's really a pleasure to be here.
Hello, I'm Gabriela Chang, co-founder of Ethic Hub. I am an industrial designer. I work for the Secretary of Economic Development in Chiapas, in Mexico, and I was also an organic coffee producer. In Ethic Hub, what we do is to enable that anyone in the world can become an impact investor. And the funding, the crowd lending platform we developed 5 years ago, enables that smallholder farmers get access to affordable financing to improve the living standards. This is connecting Global South with Global North in a win-win arbitrage. And we also, we'll talk about that later. Thank you very much. I'm very happy to be here.
I'm Matthew Stotts with Cerulean Ventures. Cerulean Ventures is a very early stage technology investment fund. Our focus is putting nature and social impact into the global economy, and we do that via software and technology investments. Our background is partially in blockchain and in other globally distributed internet-powered software systems. You might know that as anything you've ever subscribed to and received over the internets. And we're actually investors in Ethic Hub, and we're glad to be partnered with Heifer as well. And so looking forward to getting into the conversation today.
Anybody knows about smart contracts or use smart contracts? Raise your hand. Good. So that's good that we have a little bit and we don't. So we're going to go clarification of vocabulary. So what is smart contract for you in a simple way that people that are not knowing the system? How can I use this and look good to my wife or people around me? What is smart contract?
I would say first, what's blockchain? Because smart contracts run on blockchain.
Okay,
in a very simple line, blockchain is a warranty that data has not been tampered with. And a blockchain, and a smart contract, it's executable agreement. It's a program that executes the agreement between the parties. And once this program is locked into the blockchain, it becomes also immutable and cannot be tampered with. I don't know if that was too geeky. I hope it was sound more normal.
Good. Everybody can repeat it. Good. So, so when we say in the title, like, how can it be blended in finance? How do you say that? What does it mean? How can it be blended in finance?
I think we can talk a little bit about our partnership here, and that'll help to clarify. Heifer International, Heifer Impact Capital, which is our impact investing unit, Heifer Labs, and Ethic Hub have partnered in Mexico in order to deploy a $450,000 revolving facility through Ethic Hub in support of agriculture, smallholder farmers in coffee. And so I want to pass it over to Gabriela a little bit to talk about that structure. But I will say that in order to support innovations such as a blended finance tool via smart contract, there is the requirement of the facility to be supported and for there to be boots on the ground that can help ensure that the recipient of the funds is ready, they have intake, and they have the capacity to run their business. That's fundamental. Before we get into blockchain, before we get into smart contracts, that the business is viable and that they're supported through the innovation and through the processes of running their own business.
Okay. So again, blended finance. What is, most of you are familiar. For those who are not, blended finance is concessional capital that is willing to absorb first losses. So other investors are willing to impact invest because they know if there is a default or a loss, it will be absorbed by the other side. In our case, did you know that 1/4 of the world population is excluded from the traditional financial system? 70% are farmers. This means 1/5 of the world population is producing 1/3 of our food, and yet they remain poor because they don't have access to the system. So at Ethic Hub, what we build is two platforms that complement each other. One is a lending platform, a crowd lending platform where everybody can lend working capital. And the other one, it's a blended finance. It's a crowd collateral where anyone can contribute to a port collateral on behalf of the farmers because they don't have. As a simple example, 80% of the coffee in the world, and coffee is one of the biggest commodities traded, 80% is in the hands of people with only 2 hectares of land. That's not a valid collateral because no one would grab those 2 hectares in the middle of nowhere. It has no valid commercial value. So because they lack collateral to access the system, that's one of the main reasons. Also living very far away, also not having connectivity, not having data. But when third parties stake collateral on behalf of them, this blended finance attracts more impact investing because you don't know farmers are very good payers. You don't know maybe, but the global default for long-term farmers is less than 3%. But people mix this up with the default for microfinance, which is 36% for consumption. So it's a different thing. Because you don't know they are good payers, we have to provide you the comfort that if they don't pay you, we have something, a liquid collateral, to come in and cover your investment. We're very proud to say that after almost 5 years, the platform has lended more than $4 million with less than 1% default. And even this small default, thank you, has been covered by the blended finance, by the crowd collateral we develop. And we're very proud to start scaling this solution because as Antoinette was saying, if it doesn't work, if it's not doable, it doesn't make sense. We've been doing it for 5 years, and now, after our partnership with Heifer, we are confident we are going to start scaling and reaching more farmers with the solution that we implemented. And also with the support of Cerulean Ventures, who has supported us to keep growing and taking the solution abroad. We are now in 6 countries, and this is just starting.
Yeah, I mean, I think what's super exciting about what you were describing is just this inflection point of growth. So much of what Antoinette Marie was talking about is having this foundational capacity in the communities to actually take this step. It's to move to a digital transformation. It's doing something different than you had before. Most of the loan environment for smallholder farmers is a cash, absurdly high rates if they can get it, and they need that money to actually bring crops to harvest, improve their yields, process coffee that they have, or if it's cassava or cocoa or other crops. So bringing this technology in just lowers all of the costs of accessing what should just be I need to bring on maybe additional equipment and hire additional labor from my community to work with me. And so when we look at the technology, we're just looking at an accelerant, something that lowers the cost. It can be distributed broadly and used by many, but it's this hard work that has been done by the Ethic Hub team over the years and with the support of Heifer that's actually now positioning Ethic Hub to expand in this way. So you have to do that work first on the ground. And now that you can identify more and more opportunities, we're really excited to see this software, smart contracts, blockchain, all of this stuff. We can get into the technical parts of it, but it's really just the types of tools many of us use every day to manage our lives and our finances in the hands of folks at scale. So we're really excited about that.
Quick question, when you were speaking and also with the farmers, there's a lot of digital literacy that we need to bring in, and also this is so abstract for some people. Now we go with the farmers, and how do you bring them on board and make sure that they really understood and it's not like a scam or something like that? There's a lot of work behind it that was done. So how this happened on getting on this?
I think it's worth mentioning that we are working with organized producers. These are cooperatives that have a level of literacy, they have a level of digitization that already exists. Of course, there's training that comes alongside the implementation, not only technical training in order to support their operations, but things like digital literacy training around smart hot wallets and getting onboarded into the Ethic Hub platform. And there's a bit of a conversation as well about on and off ramps. So how do we go from a cryptocurrency or digital currency into pesos that can be readily used in country? And the reality is that it's already being used in country. There is already cryptocurrency exchanges, mobile penetration, data penetration, that's an enabling factor to the adoption of technologies such as this one, such as the platform with Ethic Hub. And the key is ensuring that the access to the on and the off ramps is as simple and as easy as possible, and that there is, when we're implementing with a partner like Ethic Hub, there is support with people on the ground who can facilitate that transition. The first time is always the most difficult, but oftentimes we're finding that the producers that we work with, they already have wallets. They're already working through exchanges. They already have tested out cryptocurrency. They're curious about it, and that really helps. But the continued support on the ground is a big enabling factor.
I would like to add to that we have proof that farmers can benefit from the technology even if they don't interact with it, because the more evolved cooperatives, they have this literacy, they have connectivity. But most of the farmers we work with, they don't have data because they don't have connectivity. So the technology enables to create the proper incentive loops for everybody, every stakeholder, do what is best for them because it is what is best for the system. And regarding technology and how we explain it for them, we don't. It's like, I like to say this example about WhatsApp. Any of you know how WhatsApp works? I don't mean how to use it. We all know how to use it. But any of you know how it works? We don't. We only need to know how it is used. It's the same with the smart contracts and the wallets. You only give them the account, and in this case, I would like to clarify. Is a representative of the cooperative the ones who manages the funds. In the future, we expect the farmers to receive the wallet, the funds themselves. But in this moment, it's all carried by one guy, one woman, that is the legal representative of the cooperative, and they register the bank account of the cooperative with the account in the exchange. In the case of Mexico, it's Bitso. It's a well-known exchange. So they receive the funds from the smart contract, and the smart contract, I would like to set an example, it's kind of a scroll. You don't need a third party to receive the funds because they are in this scroll, and it's only retrievable by the cooperative account because it's registered in the smart contract. The money is only for that cooperative. You cannot change the sign. So it's through the existing organizational systems that we are already reaching the farmers. And yeah, as Antoinette said, we count on people that is accompanying them online in present if it's necessary. And the first time is difficult. But when you have so much difficulty in your life, opening a wallet and opening an account in an exchange is nothing compared to their day-to-day difficulties.
I think it's worth mentioning just the context here about how, I mean, Heifer came with almost $500 million. This is a big commitment for, I'm sorry, $500,000. This is a really big commitment. Sorry.
Whoa, take a couple zeros out of there.
I'm very aspirational.
Maybe
folks.
next year.
Very aspirational. So you have to look at the context of what's been accomplished here from an impact investing platform. So this is where I get very excited about what EthicHub has built. In just over 5 years, $4 million in loans to farmers with an incredibly high repayment rate. In fact, an almost impossibly high repayment rate. And Bank of America is not seeing the repayment rates like this at 1% default, which is incredible. And that it took a crowd of impact investors. Any of folks can go on the internet and find EthicHub and participate in this. That groundswell of support actually brought the big funder to the table. And I think that is, as an impact investing model, is super interesting to look at. Part of that was the technology, the fact that you can actually put these pieces of software out into the world. They are immutable. They do not change. They function exactly as they're described, and they do the job they're supposed to do. And they have built-in trust. And so as they get used more and more, all of a sudden, my $100 donation or loan, if you will, gets backed by a large organization like Heifer. And we hope to see more of this as the platform takes off.
I love this slogan within the SOCAP, at the speed of trust. So we're doing impact investing at the speed of trust. And the first tranche was very difficult because we have to earn the trust of the farmers by providing them the money we said at the rates we said and connecting all pieces. And for us, it's a huge, so it's a huge thing that we count now on such a huge NGO, as such a big institution as Heifer International, because this will open the doors to other entities. Imagine what it is to work in the intersection of impact and Web3 and blockchain. This is like talking of carnivores and vegans. It's quite complicated because the crypto bros don't want to know anything that is not algorithmic, that is related to real world. And I think farmers are poor, so they are not an opportunity. And when we talk with most of the impact investors that are very traditional, of course Web3 is not within their investment thesis. Of course it's not, because they think it's speculative and all the things that we see in the press, because it is a very early stage. But the real value is this. Imagine some years ago if someone told you that you need not to be in the internet. Nowadays, you don't exist if no one can look for you into Google Maps. It's the same thing is going to happen with blockchain. It's very important to understand the huge consequences of this technology used for real-world problems, to solve them in a sustainable and regenerative way.
Let me just add something to close that off. You might be wondering, well, how did we generate that trust between Heifer International and EthicHub? We didn't focus on the blockchain. We didn't focus on the smart contracts. We didn't focus on the cryptocurrencies. We really pitched the impact and the potential for disruption, reaching last mile financing at an affordable rate for farmers. And that's what drove the decisioning. Everything else had to make sense, and we did our due diligence. But that was the core. Did the model make sense for the impact? Was it verifiable? And it was.
So it's really interesting because what I got from here is that you worked with the communities. You have the leaders on the ground that can work with the farmers, so they can. So you build over there. You don't talk about how the bike is built, but let's ride the bike. So that's the second element you said, and also like how the technology is really strong and a great tool for those kind of impact that we're having. So those are the three, and after that, you were able to create traction of investments from small investors, showing that there's a case, and after that, we got a lot of juice coming out from the big organization coming in for the 5 billion. That's New United.
It's coming. It's coming.
It's going to come. Two questions we got here that's really interesting, and it came to my mind too, is what's the interest rate? Like, what are the terms that you're offering for the small farmers when you say like it's really affordable? So what are those rates?
Well, I would like to point out that the Inter-American Bank for Development was our first institutional investor, and they said no one had reached at commercial rates below 50%. And we were lending in those years at 20%. Now we are at 16%. And this 16% is like 70 times less than what they used to pay. This profile of farmers were taking money from shark loans are 80, 90, and even over 100% interest. So this 16% is divided. 8% for the impact investors, the lenders, 4% to feed the system within the blockchain. I won't talk that technically. And the other 4% are fees. So we said we are regenerative finance because we generate more value than the one we extract. The farmer earns more, wins more, the lender also. But because we are a scalable technology, we can reach millions of farmers, and this small fee, it's enough to make it sustainable.
Okay. What were someone's going to start building a project like this and want to integrate it? What are like the pitfalls that you face that you want them to face? Like if they do it, like what did you face? Is hey, watch for this. These are the red flags that if I knew before, I will not.
First of all, fall in love with the problem, not with the solution. Figure it out. What are you wanted to solve? What's the market fit of what you're doing before going into building into the blockchain, because it's expensive, it's small, because this is still in early stage. So for us, that would be the first learning. We start building before validating. Fortunately, what we built was usable since the beginning, but it takes time. So I would invite you, like, there are a lot of blockchain educational branches now doing it, but part of our job, part of our aim is also to spread word about the technology. We've been working for 5 years on it, so if we can help you, please reach out and we can discuss the models and see how can we help you to adopt this technology for your purposes.
From a programmatic perspective, design with your partners as early as possible and really embrace co-creation, not just with your partners, your technical partners. Perhaps there's government partners, perhaps there's private sector partners that's building out the business ecosystem that's required for the loan repayment to be successful, but also with the end users. Bring them into your process. We work at Heifer Labs, within Heifer International, we work with a lot of different kinds of technology verticals, not just blockchain. And the number one lesson that we've learned is that you have to include the end user as part of your design process. You create an environment where they can feel that they are part of the solution, and the adoption curve is much easier to climb. And I like to say often that the problem really isn't the technology, building out the tech. We have the resources, the knowledge, and the capabilities to do that. But behavioral adoption of the new solution is the real heart of the challenge. And if you don't have that product market fit and you don't have a plan for behavioral adoption, the technology can be great, but it won't be used. And it won't deliver the impact that you're looking for.
True. To Gabriella's point about falling in love with the problem, I think when we invest directly in these projects, we meet a lot of technologists who kind of see everything they could possibly do with technology. Look at all these fantastic features and things we could build. And so what we're really focused on in finding those key entrepreneurs who understand the high leverage but limited application of technology, and that the rest of the problem solving is about the business model, the community, and the customer that you're serving, to your point, Antoinette Marie. And so, like, it's not that we look for technology light or small amounts in particular, but that there's a specific discipline for using technology where it's high leverage. So if you look at what EthicHub has built, the ability to repeatedly transact in a loan format that is consistent and proven time and again, there's no additional cost to that contract. It's been created, it exists, it's essentially bulletproof at this point. It's been hammered on so many times. That will extend for a very, very long time. We hope to these extra zeros I keep talking about. And so, when we think about like how to get to that start, it's really about getting right at the point of the thinnest possible amount of technology that gives you the highest leverage and can be repeated.
One question is very interesting is like, what is the scale needed to adapt that technology and in other markets? And the example was asked for Haiti. So like Haiti, exactly. So what is the scale that you say, okay, this is the enough scale to say, yeah, I'm disrupting, I have good traction. What is the amount of scale that says, if you reach that point, yes, it's good. Or if not, you have to drop it. Is there any?
I think I come at this at a little bit of a different approach. The technology needs to be scalable. Fortunately, software models usually are once they're built and there's a good product market fit. We look at scale more from a maturity perspective. So when is the right time to bring in tech in development contexts? Because the fundamentals need to be there. Our farmers need to be organized, they need to be operational, they need to be on their way to profitability. And then at that point, you start to think about how do we increase the efficiencies of their operations and provide them with what they need to be successful, like access to affordable capital. Sometimes it's really basic, like they need electricity, they need a place to work. Sometimes it's a little bit more advanced. They have paper-based accounting and they need an ERP system that can help them digitize their operations and connect into a supply chain traceability platform. That would earn them a premium because they have provable origin that they can offer as an incentive to their buyers. So I think there's levels to it, and it's scalability is hand in hand with maturity and readiness. And the tricky part is figuring out what's that inflection point to go in and deliver a digital solution that can then do what software does, which is hopefully virally scale.
You're good. Second one, like I prefer to use your question. So how you currently, or what do you see emerging for Web3 to encourage regenerative practice with farmers? What's emerging?
Well, I think we're working on a site. People is familiar with blockchain use for traceability, right? For traceability of items. Imagine that blockchain with blended finance, we're talking about traceability of funds. If we can deliver enough funding for the farmers to keep their practices, the regenerative practices, we will protect the way they produce food. And this is key because agriculture is key for climate change. And if farmers cannot make a living out of their agroforestry farming, they will cut down the trees, plant another crop like it's not suitable for the mountains, like corn, for example, so they can eat 1-2 years, and the heavy rains wash all the land down, and the desert is lost, and they migrate to the United States, in the case of Latin America. Let's reflect why such big countries as Mexico, our main source of income is remittances. When there's so much nature around that has to be taken care of, please think with me that the greenest areas of the planet is where the unbanked live. So it's very important to give a way of living in order to them to remain the stewards of the land. And we're talking about financial exclusion, but they are also excluded from the carbon markets. They're also excluded from the certification markets. The whole global system is not designed for the small scale. And it's very important to see that. So I invite you for the next time you design a system, keep in mind the excluded, to not keep repeating this problem. And regeneration is important because I think sustainability, it's about keeping things as they are. But we need to heal. We need to cover the holes that are done. So we need to regenerate, to do more than what is done until now to make this sustainable, and also to keep thinking about this. So the whole planet is connected. I use the terms that I heard because it's easier to explain about global north and global south, but I don't like it. It's not a north and a south. We are all together into this. So for those who have the privilege of eating 3 times a day, please think the enormous power your money has when you decide what to eat and to whom to buy it. And that makes a huge difference into the lives of millions of people and into the planet, of course.
Maybe I can get a little geeky. I love what you were just saying, Gabriela. When we're thinking about folks who have a natural connection to the land, you had mentioned that 80% of cocoa farmers, for example, this is coming from 2 hectares or less of land. And so you just do the quick math. That's tens of thousands of livelihoods of families, of farmers who are working there. And so to take that to a technology conversation, blockchain is a grassroots technology. It is distributed over the internet. It is open source. It is contributed to by a large community of many of the folks in this ecosystem in the Silicon Valley and around the world. But it's fundamentally a grassroots technology. It is for everyone can be on the blockchain and access whatever smart contract you bring. So if it's one that allows you to get a loan to do better work or invest more in your farm, that's accessible to everyone. Now, there is also that hurdle of adoption we've been talking about, but it's fundamentally a bar to be cleared. And once that bar is cleared, you have a grassroots platform. And I think that's, from a technology perspective, really important to understand. So much of what we see in development, so much of what we see in impact is very large scale, top down, big development dollars coming out of governments, coming out of large multinationals or NGOs. And in some applications, as we're seeing with Ethic Hub, the blockchain technology actually provides an equalizing factor where cooperatives and smallhold farmers can do for themselves with tools that have already been written and put out on the internet for them to access. So once we get them up over that hurdle, I feel very encouraged by the potential for the grassroots to grow.
I'd like to add something to this, because they were talking about philanthropy at the beginning, and there's a lot of prejudice thinking that helping others should be philanthropic or altruistic. It's not. This technology is proving it is possible to create share value models because they are more efficient, because when you can present from a third party as intermediary, when you can disintermediate and replicate and scale, it's business for everyone. It's a huge problem, but it's also a huge opportunity. And if we focus it as an investment opportunity and not as a donation, because it is not.
I'm supposed to make the for-profit pitch.
No, it's okay. I'll make it too.
It is a good business to invest into the common good.
I want to add to that, and I think this was part, as I was planning for this talk, it was part of my closing remarks, that even being a representative of the NGO, the philanthropic partner, we are very bullish on viable business solutions, blended finance, and private partnerships, because for us to reach sustainable impact, the intervention needs to work when the grant dollars are no longer there. So once we're gone, it's the local businesses or the businesses that have been localized that remain. If you're relying on philanthropy to solve the problem, you're not going to get a sustainable solution. And there are always going to be asymmetries. Working with rural producers, these are some of the world's most difficult challenges. But with this technology, there's a preconception that alternative finance is a disruptor. It's going to replace traditional finance. And I see it as a parallel. It's opening a different avenue, a parallel avenue by which those who are not served by traditional finance can be served. And it's great. We can have both. Have traditional finance serve that it does, and alternative finance opening new avenues for those who are excluded from formal financial systems.
This suit. Every time I speak, I'm sorry, I have to get. No, it's okay. Good. Okay, I would say it like this because the microphone, so I'm going to turn. Two questions here, and one is interesting because, like, we know we're preaching for people that believe in it. So one of the questions, okay, why there's so much resistance, or why there's so much blockage? So what are the risks around it? Because not be that perfect. So resistance.
I would answer human nature. We distrust what we don't understand. This is a very early stage of the Web3, of the blockchain technology. Remember when we start using internet for payments? Most of us had a different card to use it in the internet because we were worried our data was going to be stolen and all that stuff that we now take for granted. So I think the challenge is adoption, and we need more use cases to explain how the technology can be used for purposeful things. And I think that's the main challenge. Get to know it, embrace the unknown, learn about it. Don't distrust, don't say no because you don't know it. Give it a chance to understand what it's good for, and not just to hear what the bad press is saying, because it happened with the other technologies. It's always happened. It's the same curve of adoption, I think, here.
I'll just add a follow-up question. Do you want to add something in? Bilba, I'm going to shoot a follow-up question on this. It's really like, okay, so related to this, are we going to see a crash like 2008, a bubble like that happened on this? Like, are we going to see, that's a follow-up question I received.
No. I mean, just to be straightforward, I mean, this is, it's kind of like saying blockchain is maybe equivalent to like a category like music. You can find a lot of terrible music in the world. So you can find a lot of terrible blockchain projects as well. And so when you have a proven platform, I think this is why, when you look at a project like Ethic Hub with a 5-year track record you can go on, if you're technical, you can actually look up their smart contract on a blockchain explorer and see the transactions. You can also go to their website and see the real lives of people that have been touched and improved by the loans that you make. And I would say, take the risk that you can take. It is an investment product to some extent. So you've heard that $4 million have been loaned and returned. You've heard that the rate there of repayment is 99%, and that is then they have a blended model so that actually doesn't impact any investor. Take your risk capital and put it to work. If you buy a CD for 4.25% return on an annual basis right now, you can actually find a different interest rate by helping farmers with a loan on this platform. So I think the answer is no. This is a very specific and proven project, and we need that. We need more specific and proven projects. We'll start to see more folks like Ethic Hub and Heifer working with people, and we'll see that there's probably an extension of what you've built that others, when it comes to maybe carbon crediting or other things that we'll see in the future, where you'll become the center of trust and accelerate things.
That's one of the amazing things about the technology. It's composability. It's like blocks that can be combined. We don't need to start from scratch. The technology is evolving very fast. So very soon, most of the implementations we need, we can build them because it's our founding team, which is technicals, but it can be adopted for many and apported by many.
We just have a few minutes left, so I just have moving to the closing. The first question I have is, what is your biggest fear related to your field, and what's happening? If you have one biggest fear, what it is?
Is it a fear or is it an opportunity? I'd say it's an opportunity. I think that the gap or the divide between the philanthropic space and the impact investing or social enterprise space is getting smaller, and that trend needs to continue. We really need to work hand in hand to understand the development challenges and the maturity that's required for investors to come in with a healthy risk appetite and work hand in hand to create viable and sustainable solutions. It's difficult because the challenges that we're working to solve are difficult, and they require patient and flexible capital. And they require time and thoughtful data collection in order to not prove out that it's working, that's important too, but also to influence and help the programming pivot together with the private entities. So we have to work together to make our programs better, and we have to be really humble about what's working and what's not working, discard what's not working, and innovate again to find what can work for the long term.
I'm an optimist through and through, and so I think maybe just impatience and anxiety rather than fear. So my emotional state is, come on already, folk. I mean, like, we've proven it, right? It's working. So it's really about just, I want to just see more and more adoption. I would love for half of the folks in this audience today to get on to Ethic Hub and try and explore and put something down that can be massively impactful in the next 5 to 10 minutes. It can literally happen that quickly. And if you don't, or if you need help doing that, I'd love to chat with you about it. So let's move fast.
Also, I'm quite optimistic, but if there's a fear, could be that people, that I'm optimistic also. And if I have a fear regarding the technology, would be that people here doesn't act fast enough. And instead of having the amazing tool it is to catalyze a development for the SDGs, we end up with a Wall Street on steroids. I mean, the technology being used to do the same business as usual, faster, cheaper, but the same, instead of creating whole new models. Imagine e-marketing, or how was before, when they said you need to use catalogs to do stuff, no, instead of using the technology. It's going to be the same. This is amazing new model. This is just starting, and I invite you to embrace this technology and adopt it, and of course join Epic Hub to learn how to use it for purposeful things and not to do the same as usual.
And quickly, your biggest hope.
I'll just say that we meet and connect with more incredible folks like Heifer and Ethic Hub. I think just getting the word out there that there's potential here, that we've proven a model that works. I hope, to use that word, that more entrepreneurs, more builders, and more NGOs are inspired to come down this path.
Yeah, my biggest hope. They said Web 2, Internet, it's about competitors, while Web 3, it's about collaborators. My greatest hope is to create synergies between the world changers, the game changers that want to do something positive and do it now, not to wait to that future. It is in our little hands to do huge things, and we can do it all together.
I hope to find more Ethic Hubs, more builders who are looking at very viable use cases, and they're talking about their impact, and they're using the technologies available to them. A couple of years ago, it was blockchain and smart contracts. Now it's all about AI. Let's use all the tools that we have at our disposal to work on solutions that can create an impact.
Just to close, last one, like, there's so many good information that was shared. What is the one-liner that you want them to keep in mind? Like, what's the next morning top title in the newspaper, the headline? What will it be for people to live with? So, okay, I need to live with this one. One takeaway they need to go with.
I'm just going to summarize what I said before. Take a risk at making an impact.
Perfect.
Be brave. We need new ways to solve old problems.
Take a risk, be brave, and keep innovating.
Governor of the Bank of England, Mark Carney. Also worth noting, I think, for the purposes of our conversation, for the past 7 years, the chair of the Financial Stability Board. Hugo Chong, a founding partner of IDG Capital. Christine Lagarde, the IMF Managing Director. Jörg Kukis, the German State Secretary and Deputy Finance Minister. And can I just make note of the fact, for the purposes of the panel, an ex-Goldman banker. So we should just remember a little bit about your background. Mary Callahan-Erdoes, the CEO of JP Morgan Asset and Wealth Management, welcome. And Sergio Amotti, the CEO of UBS. A very warm welcome to all of you. A very quick preamble for me. As we came into the World Economic Forum, two important pieces of information about growth. One, coming from the Chinese economy, suggesting that the growth rate is moderating, although at 6.6%, that is a number that most European finance ministers would be very happy to stick on their own economic growth rate. The other, of course, courtesy of Madame Lagarde, the fact that we now have another downgrade to global growth expectations. Some countries expected to do the same or better, some obviously expected to do worse, but I think the overall message is this is another downgrade in expectations in just a few months. As I came off set this morning, I also heard PMI data from France, the weakest in 4 years, manufacturing data out of Germany, the weakest in 4 years. You also heard from the IMF, of course, concerns about public and private debt, protectionism, Brexit, trade tensions, and tightening financial conditions, all raising worries and creating headwinds for the global economy. So how resilient do we actually think our current financial system is to deal with some of these challenges? What I'd like to do as we've listened to the feedback over the last week is just sharpen our focus somewhat on some of the vulnerabilities that may lay ahead through 2019 and beyond for the financial system. And Madame Lagarde, if I could start with you maybe, and then we'll run along the panel, just to single out one or two things that we should be very sharply focused on.
First of all, thank you very much for summarising the views that we're taking at this moment. I would like to qualify a teeny tiny bit what you said. We did revise modestly the forecast for 2019. It's only a 0.2% revision, so it's modest. What we are essentially saying is, number one, it is coming from the advanced economies, so we don't have a synchronized movement as we had observed before. There is asynchronicity in the making. And second, we have revised downwards modestly because we are seeing those risks that we had identified pretty far away on the horizon, which prompted me to say, sun is still shining, fix the roof, please, have resilient economies. But we're seeing those clouds coming much closer. And if I may, I'd like to just identify two of those. One which I think is particularly relevant, and yet is not affecting the two major players in that risk, and I mean by that US and China. And clearly what we see as the major risk at the moment is the development of tensions, notably in trade, but not only in trade, unfortunately, I think, between the two largest economies on the planet. And we have not revised down our forecast for these two because the US still has the benefit of the stimulus package that it had launched about a year ago, the corporate tax reform that it took a year ago. And on the other hand, China has taken some modest successive stimulus measures that have helped it sustain a growth that, as you said, European finance ministers would not be surprised about, but would dream of. And I was one of them, so that's true. So this is the major risks that we are seeing that could precipitate even more market recognition of what has finally been recognized at the end of 2018, number one. Number two, it could, if it was aggravated and accelerated, precipitate slowdown of the Chinese economy. And by that I mean that the Chinese economy is slowing down is fine. It's legitimate, it's right, and I think it's very much designed to be under control by the Chinese authorities. That the slowdown be excessively fast would constitute a real issue, both domestically and probably on a more systemic basis. Those are the 2 points that I wanted to make.
Thank you. Minister Kukis.
So for us, of course, as an economy that is very exposed to the global cycle through our integration in the global value chain and the supply chain, obviously the question of trades functioning smoothly is a predominant issue. And if you look at our numbers, the vast majority of the growth slowdown has been driven by one-off issues which are weather-related and related to some elements of the new rules around the automotive industry. But of course, the overriding concern to us is on the one side the exposure to slowdown in growth to the global economy, but also the less smooth functioning of world trade, be it through the threat of increased tariffs, be it through all of the potential disruptions that we're facing related to Brexit and its effects on the supply chain. So those are the things that we are very worried about and are looking at most carefully. On the other side, of course, the question is how do we deal with these issues? And for us, the key element there is sending signals of increased unity for us, of course, predominantly in the EU. And we've achieved some progress in that sense with some implementations of the global financial reforms with respect to your questions on strengthening the robustness of the banking system. In December, Europe agreed on quite far-reaching implementations and deepening of the European Monetary Union. But of course, we need to go much, much further than that because the European market, as opposed to the Chinese and US financial markets, is still very fragmented and a lot still needs to be done, both on the risk sharing within the banking union, the capital markets union, and the fiscal cooperation.
Since you've taken me down this path, and I hate to interrupt the flow, but why doesn't Europe yet have a targeted fiscal instrument for supporting individual countries in the Eurozone that may be suffering fiscal or financial problems? We're 10 years after the crisis, and we still do not have that specific instrument for helping those countries. And because they're all in the Euro bloc, they cannot print their way out of the problem by going back to the peseta or the franc. What are we doing? Why are we dithering? Why has it taken 10 years?
So France and Germany made quite concrete proposals along those lines. And Europe has embraced some but not all of those proposals. But we have the mandate from the heads of government and heads of state to work further on exactly these instruments. But there are very fundamental differences within Europe on the question of the need for that. But Germany and France agreed on the need for tools that further convergence, further competitiveness. We are of the view that also stabilization needs to be an element. But around that, there is pretty wide disagreement within Europe on the need for further integration along those lines.
But if I may interrupt for a second, you should also mention the European stability mechanism, because that is one of the instruments whose mandate has been enlarged most recently in order to act as a backstop in case of bank major issue. So at least on that side, there's a better...
That one, I mean, the fact that we agreed on making the European Stability Mechanism the common backstop for the Single Resolution Fund of the banking union, I think is massive progress already towards further integration. As I said, and we agree with the IMF's assessment in that Europe is way too fragmented and we need further steps forward. But Europe, unfortunately, moves a bit slower, but we are going in the right direction.
I mean, I love the united front, but what about the question of sovereign risk? I mean, which we see in countries in the south of Europe.
So to that, we think that addressing the issue of zero risk weights of sovereign risk on financial institutions' balance sheet has to be part of a compromise. We couldn't achieve that this December, but it is part of the further risk reduction. But that being said, you have to acknowledge that very substantial steps have been taken to reduce risks on bank balance sheets. We've achieved a very broad agreement on a very significant series of steps towards reducing non-performing loans on European bank balance sheets, and that is also supported by the fact that these risks are going down. But we've also empowered the European supervisory authorities to work further on that reduction. So I think that is also a very important element of risk reduction. And of course, we need to make the next step. But on the other side, we also have to be willing to make the next steps towards further integration. Because what won't work is, the northern European states always saying reduce risk, but not being willing to go the next step in terms of European integration. I think that is also, those are two sides of the same medal that we have to tackle now with the new Commission coming in, and Germany, France, and many other states really have the commitment to go further on that.
Minister, thank you. Mary.
When you look at the challenges that are sitting here in Europe and that are faced by the policymakers and the regulators that have to deal with it, it makes the U.S. look easy to have to navigate that. And the strength of the U.S. really is the thing that obviously everyone's focused on because it's such a driver of global growth. It has been a very, very long expansionary period, but it's really important to remember that in the 9 years of our expansionary period in the U.S., we are only about where you would be in a regular recovery 4 years in. So it's just that it's very slow in the way that it's gone. So it doesn't mean that a recovery has to end just because it's gone through a certain amount of time. The question is, how continuous can you make it without having the high volatility? The high volatility comes from shocks in the world, which we have talked about ad nauseum here in Davos, and we know those very well. The issue for us as asset allocators and putting money out to work around the world is where can you take advantage of the pockets of opportunity that exist. You saw great opportunities at the end of December to be able to make moves into emerging markets. If you think about the Fed possibly being on hold and not aggressively tightening as people had thought in the past, emerging markets equity, emerging markets debt, they start to look very attractive. Their valuations went from top quartile down to bottom quartile in a matter of days. Unfortunately, you had to be there within the first 17 days to catch that, so you have to be quick, and you can't take holiday vacation in the month of December anymore. So that it just leads us to where these pockets of illiquidity, that's what we all worry about. We all worry about, is the system going to provide enough liquidity, right? We put $11 trillion of assets into post-Great Financial Crisis around the world. We all tried to do that in a coordinated way. We had great demand for yield everywhere in the world. So what happened? You had great supply of fixed income instruments, and those doubled and tripled depending on the markets that you looked at. You have very strange anomalies that come out of that, right? You have 85% of the Italian high yield market trades below US Treasuries in 2017. That's down to 50% today. There's just anomalies that are out there that have to be cured. How do those get cured? It's not going to stay that way forever. Where it comes out and gets redeployed to, and whether there are gaps in the liquidity that's provided at the time, that's when people get in trouble. It's not going to be the financial system like we knew it before, right? That has been very heavily cured. You talked about risk-weighted assets are, double what they were in the great financial crisis. Short-term liquid assets as a percentage of short-term liabilities are much stronger. You have short-term liabilities being totally financed, so loan-to-deposit ratios are 100% in Europe and are 75% in the U.S., so much, much stronger. You have money market fund issues that have been solved. You have sec lending issues that have been solved. You don't have the Uniform Net Capital Rule that had broker-dealers be able to go from leverage of 12 to 1 up to 34, 35 to 1. That's been cured. You've got the housing issues in the U.S. that also found themselves in other pockets of the world, where you had government policy that said instead of affordable housing be about 10% of the market, it zoomed up to 40%, and now you've got loan-to-value of 97% on a bunch of things. That's not there. The CIVs aren't there. There's a bunch of stuff that's not there. So we're all looking for where else it is. The financial system itself is there. The Volcker rules may have caused us not to be able to provide the liquidity that we used to. It doesn't mean liquidity won't be provided. And so you then go looking into the shadow banking system and the assets that are there. You look at the private equity markets. Many of them of the managers of those are here in the audience. They have a lot of capital that hasn't been deployed. And every time they see these pockets of opportunity, they're also going in. But they're not going to go in to make markets in the way that banks used to make markets. They're going in as a fiduciary. They're not supposed to make markets. They're supposed to make money for their investors. And so those are the dynamics that everyone's struggling with. And our job is to take advantage of those when they occur.
I might come back on some of those issues around the structural shifts and where the liquidity will come from, but I can't let you get away with your opening remark because I put the German minister under pressure. Let me come to you. How easy in the United States, given that you've got a government that's been shut down for the last 33 days? You have a Federal Reserve that says it's data dependent, but it's not going to get any data because it's provided by government agencies. Is our problem, partly our problem, one of confidence now that we have a president in the White House who is making life very difficult for people who want to put risk assets to work?
Okay, so government shutdowns are not new. There's been 15 of them since 1982 when the rules changed about how you would fund your financing. It's happened to almost every major president. President Clinton had one that was 21 days because of Medicare. There are, all sorts of things that happen. The issue is if it goes longer, there are certain expenditures that just don't re-happen. A lot of these just get delayed. Some won't happen after a series of time, and for sure, confidence and the CEO confidence of, so am I going to build that new plant? Am I going to think about that, CapEx expenditure? Those are going to start to weigh heavily on their mind. I think that governments will come together and try and solve this. There are lots of things that can sort of handle themselves until March 31st, really. And so most people know that, and hopefully all the officials are working towards that. At JP Morgan Chase, we have lots of data that we correlate to the data that we usually see in the government, so we know exactly what's happening in the underlying economy. And certainly there are pockets of it that are slowing, if you can see things in the retail sales market and the like, but nothing that significantly worries us, but it certainly will have an effect on GDP. It's about $1.5 billion every week that we go through this, and those numbers may change. They're very hard to calibrate when you go through time because you don't have past measures that you can hold them up against.
Thank you for the answer. Sergio, let me come to you. Vulnerabilities. What are you focused on?
Well, I would say complacency. Complacency, although if you go around Davos nowadays, you would find that maybe there is not such a high level of complacency, but investors, corporates, entrepreneurs have been used in the last few years to live with a lot of macroeconomic, geopolitical, geoeconomic challenges. And if you look at financial markets and investments, the tendency was we can take care of that. This is not a big problem. What I think was a warning signal is the fourth quarter of last year, and particularly December, when you started to have a convergence of those fears and those dynamics coming into one moment and triggering unease by investors. You don't have many months. Actually, December in terms of equity market performance was the worst month since the Great Depression. If you look at 2018, it doesn't feel that way, but 90% of all financial asset classes had negative returns. Now, the implied assumptions that we hear about liquidity being there, being able to step in and function as a mechanism of leveling those tensions, it's the wrong assumption. Liquidity can freeze very quickly, like water in Davos out there. And it's exactly for the reason many of those investors with a lot of liquidity have a fiduciary duty. So they will not easily step in when they see discontinuity and issues like the current debates on Brexit, the unknown, the shutdown. I fully agree that is not the first time, but people may start to ask themselves, so what? What's next? What's the next escalation? And there are facts that seems to indicate, if we look at our clients and the broader investor base in the US, for example, at the end of Q4, they reached a declared 24% of cash asset allocation. That's a very, this is an unprecedented record high of declared cash for US investors. We have been seeing that for a while in Europe. So And this is not liquidity that is there to be reinvested if things gets a little bit better short term. It's there because people fear that something may go wrong. So, in a nutshell, what is the solution? The solution is that, first of all, I hope that we don't rely once again on central banks to resolve the issues. I think some of them have very limited ammunition. I'm going to let Mark discuss on that. Some others have a little bit more flexibility. And this is the time also to take the bitter medicine and also think about how to bring through some reforms, at least, that are necessary to create, again, a better environment. We need to address the fears of people out there feeling, not happy about their developments of their life, their purchasing power, where they stand. We need to address some of those issues. We need to address some of the fears that people have about their futures and their jobs. So it's a complex environment, but complacency could potentially be an issue. We can touch on what the banking sector and financial sector can do, but it's for later.
Look, I hate to twist the knife, given that your chairman's within distance that he could throw something and hit you from the audience. But
we can swap seats.
But I mean, you've had quite a week of it. I know. What was it? $7.9 billion exited in the fourth quarter.
Right.
So I mean, it was a tough quarter. But if markets are a discounting mechanism, is that money moving because people are worried that they're going to be exposed to a recession or potentially a financial crisis by 2020?
No, Jeff, I wouldn't extrapolate 7 billion quarter outflows on 2.3 trillions of assets we manage, and after we increased our asset base with clients by 25 billions in wealth management and around 30 billions in asset management. I think that, of course, there is an element of outflows that is driven by deleveraging, because net new money in the wealth management industry is also a function of leverage. And of course, we see deleveraging coming from investors, and that's a sign of unease, and is explainable in the fourth quarter with what happened. I mentioned it before. I do think that those are the signals that we need. We need to put things into the right perspective, and those are signals one by one that indicates unease.
All right, we'll not over-extrapolate. You mentioned Brexit as one of your risk factors. It is a bit of a tradition in this particular panel, or it has been since George Osborne was here in 2016, I think, to ask the audience actually to vote on Brexit. I think there's no point in asking you whether the Brits should be in or out, because I think we've done that one. But maybe I could ask you a slightly different question. There is a clamour here, I hear, for there to be a second referendum in the UK. Could I just maybe put this to an audience vote? Do you think there should be a second referendum in the UK now that the Brits have had a chance to see what this now means? Put your hand up if you think there should be. You're not voting on this one, Mark? No?
I can assure you.
Okay, put your hand up if you don't think there should be a second referendum. Okay, so I think it's pretty clear that the room as a whole feels that the Brits should have another chance to vote on this. Obviously, this process is winding forward, and we'll see what happens over the course of next week. Which brings me to Mark Carney, the Governor of the Bank of England. Mark, I'm not going to ask you a political question because that's not your job. But what I will ask you is a question about the data and about the preparedness for the outcome. I think you won't be surprised if I suggest that maybe some of the forecasts from the bank and the previous Chancellor were rather pessimistic compared to the data that's coming through at the moment. So was something misunderstood about the confidence issue? And two, the preparedness. How robust do you think the systems are in the UK and Europe to deal with whatever comes, if that's a hard Brexit or not?
Okay. Thanks for having me. Just put a marker down that if we could come back, if we have time, to the types of issues that Mary and Sergio and Christine raised around the other half of the global financial system, the market-based system, liquidity, the dynamics, because when you think about vulnerability and opportunity, it bears greater explanation. Look, actually, I think the data is broadly borne out. What certainly we at the bank said prior to the referendum, we said we felt if the vote was to leave that sterling would go down sharply. It did. We felt inflation would go above target for a period of time. It did. We thought the economy would slow, driven by investment. Business investment in the UK since the referendum has been absolutely flat. It's about 20 percentage points lower than we had forecast prior to the referendum. And that's 20 percentage points lower than we thought as a level at a time when the global economy actually accelerated. Financial conditions were very easy. Corporate balance sheets were in good shape. But and the reason I mention that, aside from the fact you asked me the question, but the reason I mention that is that when one talks about trade tensions and looks a bit at what's potentially happening in the manufacturing sector, globally, what's potentially happening in terms of corporate confidence and corporate investment, you have obviously a reduced. You have the same effect potentially happening in a number of advanced economies, obviously not to the same degree, because ongoing discussions with the United States and not as a major potential structural change underway within the global economy. But if you're going to have an element for a period of time of deintegration, you start to see it through the corporate sector, less on the household side. We've seen it in the UK. We're potentially seeing some of that globally now, and it's a question of degree. It's important we get it right. Level of preparedness. Where we do have direct responsibility is the financial sector. And from the day after the referendum, we've been preparing for Brexit, whatever form it takes. If you're a central bank, the easiest thing and the most important thing is to prepare for a hard Brexit with no transition. So that's what we've been preparing the sector for. We've ran stress tests, which are not forecasts of what would happen, but GDP down by 8%, commercial real estate down by 50%, house prices down by a third, interest rates have to go up, unemployment goes up to almost 9%, and on and on and on. And to make sure that the banks have spent the last few years putting themselves in a position with enough capital to absorb those losses that would come with that situation, and of course risk premium go up in the UK, other factors, and still be able to lend to the real economy, so to come out the other side. To give you an idea of how much capital has been put into the system, rightly and necessarily so, after all of that happens, the UK banking system has about 3 times as much capital as it had prior to the financial crisis, after all the losses that would be absorbed there. Second point, we talked about liquidity in the core of the system. UK banks, core banks, have £1 trillion pounds of liquidity. That's 4 times as much on an apples-to-apples basis as they had prior to the crisis. That's on-balance sheet, high-quality liquid assets. Their short-term funding, as a proportion of their balance sheet, has gone down from 20% to 5%. I think it was Mary referenced the deposit funding. They're deposit funded effectively for their domestic lending. They can borrow another 300 trillion plus from us, 300 billion plus from us, because they have collateral preposition in all major currencies. So capital liquidity is there. Sergio raised policy room. We have policy room, both in terms of conventional, potentially unconventional policy. We can cut something called the countercyclical capital buffer, which releases lending capacity equivalent to 200 billion plus of the banks. Last year in the UK, banks lent 60 billion. So that gives you a sense of the order of magnitude of the flexibility there. Now, one of the things we caution in terms of preparedness is it's not, and I'll try and finish with this hand back, it's not automatic which way policy would go in the event of a hard Brexit. And remembering, we're not predicting that, but we've got to prepare for that. And the reason, and this is an important point when thinking about the global economy and trade tensions, is that when you go through a period of if we go through a period of deintegration, deglobalization, reduction in trade openness, that's akin to a supply shock to the economy. So demand, it's not just that demand's going down, we're all familiar with that, and then you try to bring up demand, but supply is going down at the same time. On top of that, you have an exchange rate effect on inflation, and you have tariffs effect on inflation. And so The central bank in that circumstance has to make the right judgment about the right path of bringing inflation back to target while doing what it can to support. But it is not an automatic approach. And particularly at times when there are big changes, you have to have some constants. And for a central bank, there are two constants. Have a financial system that functions, which we would have if that were to happen, and keep your focus on your democratically given mandate, which is to achieve the inflation target.
Governor, you have said that you didn't feel that British business is necessarily prepared. Clearly, you feel the bank is prepared, but you've said British business isn't prepared for a hard Brexit outcome. Do you still believe that?
Well, look, I don't think I used exactly those words in terms of pointing to UK business. There are a series of logistical issues that need to be solved, and it's quite transparent that in many cases they're not. So port infrastructure is not there, border infrastructure is not there, to the extent that it would need to be for jumping from an absolutely seamless trading environment to one with frictions that aren't just tariffs, but are rules of origin of products, safety standards, other inspections that would need to be done. And I think George mentioned earlier about supply chains and just in time. A number of people in this audience run businesses that rely on that. Look, minutes matter in that world. And it is, I think the point I would make is that there is a limited amount that many businesses can do to prepare for if there are going to be substantial delays on the logistical side. Now, obviously, these would eventually be worked out over time, but you can't build up the inventories in order to, when, if you're a car plant that relies on, and there are ones in the UK, that rely on 40 18-wheelers coming through Dover a day, and they have to show up within minutes of each other in order to meet the just-in-time requirements of the plant. Look, you can't stack things up all over Wales in order to ensure that you can continue to run it for months. That's just reality. So some element, if there were to be a sharper break, some element of that would be there. And business is doing what they can, but in many cases they can't do it.
Did you want to just specifically make any other point about the vulnerabilities? I think you partially addressed
Well,
them.
the thing I wanted
to,
thank you. The thing I wanted to flag, which is both a vulnerability and it's a strength and a weakness of the system, and it's tested a bit in December, it'll be tested going forward, which is that now half of the assets in the global financial system are so-called market-based finance, and a big chunk of that is asset management. And in many cases, in fact, 30 trillion of those assets under management are daily liquidity. So people have the right to take their money out of their mutual fund or use it or whatever it's called. But they're investing in assets which are varying degrees of liquidity. And I think very importantly, the private sector here is saying, and you can have jumps to illiquidity in certain market segments. So a corporate bond, a leveraged loan, a emerging market debt that is liquid in good times is not liquid in tough times. And the question is how robust that system is going to be if and when there is a bigger shock to the global economy, a real shock to the global economy. The good news is that exposure does not jump to the core of the financial system. That's what's changed. So the core of the financial system will be there if there are challenges over here. But there could be some surprises in terms of pricing. It could lead to bigger overshoots. And I would add this, which is that all of the net capital flows since the crisis to emerging economies have been through market-based finance. So it's pretty important how well this functions.
Okay, Hugo, let's move to you. The question was vulnerabilities. Okay. I think you're probably uniquely positioned on the panel to give us a Chinese perspective on this. I don't know whether that bears on what you're going to say, but the floor is yours.
Okay, for me, first of all, I'd like to say IDG Capital is actually an American company, and we are the first one to start the first venture capital firm in China in 1992.
Terrific.
And we make a lot of investment in China over the past 25 years. We invested over 750 companies in China. We're lucky that we have been able to take 180 companies for IPO or exit through M&A.
If you'll forgive me,
that's right,
your bio is in the documents that
That's
all of
right.
our audience can read.
Yeah, but then looking as here, talk about the Australia issues, etc. Because I want to just a little bit of history is in our business, particularly with China. When I remember started, that's time talking about the most of the favored nation status. Then of course WTO and etc. But now it's really we want to see the trade tension really resolved, come with a good effect. Because as an investor, we like to have more certainty rather than uncertainty. Yeah.
Do you think there is a case to answer, though? The 301 investigation was very clear in its findings. Other countries around the world also have frustrations about market access, about subsidies for select industries, about challenges in dealing with the administration and the process. Is actually what the Trump administration is doing at this point, trying to set a standard for the rest of the world, not just for American companies? And there is a case to answer.
Yeah, for us, we actually invest in the country. We invest in the industry, right? The government policy allowed, right? So particularly, we invest in a lot of consumer internet companies in the past. We really invested in the technology-driven companies in China. But I think it's really now is the thing is like the fintech area because there'll be data-driven, data-intensive, but then the compliance should be very key, and then for both the investors and the industry to stick with. That's what I feel.
And we had a growth number at the beginning of the week that caused some alarm in capital markets.
Yeah.
Is that your sense, as you do your business, that we are only going to see lower numbers printed from here? That the government itself is managing a process of slower growth as it looks to transition the nature of the economy?
I think you mean the 6.6%? Well, that's the official numbers, and then
you don't believe the official numbers?
Well, I do not question.
Everybody in the room believes the official number,
yeah.
I'm sure.
What?
You don't believe the official number?
No. I believe what they said, but then I don't know. That's really for me to question whether it's true or not. But then I believe those are the numbers.
But your experience is that growth is slowing.
What?
Your experience
the
is
growth,
growth is
of
slowing.
course, China in the past is always talking about like 8% the GDP growth,
Right.
etc. But then, of course, now 6.6. I think it's given the size of the economy, it's a pretty good number, and then that's what I feel good about. But then I don't have much of a concern of this.
I don't want to make you the spokesman for Chinese economic policy, so we'll just move on. But feel inclined to jump into some of the other conversations. So what I want to do is just circle back now and focus on some of the issues. One of the key ones, it seems to me, is whether the institutions involved in the financial system have actually been healed at this point. Governments were given a very clear set of guidelines by the FSB and other organizations, the IMF, about what needed to be done. Is the system now healed sufficiently that we are, if we see slowdown, slip into recession, we don't slip from recession into financial crisis? Are we robust enough to protect against that? And Minister, if I could just bring you back in on this, and you're going to hate the question, but people look at Commerzbank and they look at Deutsche Bank and they see potentially one bank from here on in, or at least they look at Deutsche Bank and they see a bank that hasn't quite been healed since the global financial crisis. They look to the south and they see other banks in the south, in other countries, that still have not dealt with their non-performing loan issue. Does Europe have a case to answer here? And should Deutsche Bank get on with a merger to make sure it's got capital buffers to survive a crisis?
So very obviously, that's actually the most easy question, because I very obviously will not give any answer to it. We've said many times that we we strongly urge the German banking sector, and by that we don't only mean the private banking sector, but also the public and the mutual banking sector in our country, to do its homework and to think hard about cost efficiency, because a globally oriented economy like Germany needs a strong banking sector, and we strongly support the strength of that banking sector. On institutions, the one element that you do have to remember is the key issue, or one of the key issues that eroded confidence of our populations in the stability and the viability of our systems, is the nexus between sovereign and banks. And the fact, we did a very large study on the impact on the fiscal position of Germany of the banking crisis, and it turns out the German taxpayers paid 60 billion euros at current mark to market, the best estimate that we have, to repair the damage of the financial crisis. And that is the really systemic, fundamental issue. And I had the privilege of serving on the Financial Stability Board under Mark, representing my country. And the reforms that Mark and the FSB have really worked on deeply have now been implemented. I mean, we just are putting into legislation a requirement for every European bank to hold 8% of its balance sheet as bail-in capital, i.e. immediately available for the orderly resolution of a bank if and when it comes into a systemic event of potential need for resolution, before depositors are touched, before the taxpayer is touched. And I think that is a very, very central element to illustrate to you, as I don't want to repeat for Germany or for Europe the numbers that Mark, but they're very, very similar in terms of resilience and the liquidity buffers, the capital buffers that have been built. So I think a lot of work really has been done, and that work has been done in all regions of the world, including Europe. And as I said, in December, we implemented in the banking package that is now going through the legislative process all of these specifics that also make the European banking system a lot more robust.
Mary.
Can I just chime in here? I think over the years that I've been coming to Davos, there's a lot of conversations about the banks. What the policymakers have done to get the right regulations in, to make sure that the leverage is not in the banking system, and to have the banks there when you need them, all of that has been, we have beaten that as much as we can. And I would tell you that banks around the world are completely different. That's not actually the issue. It may be difficult if you're a global bank and you have to sort of live to the highest common denominator, because there's different parts of the world that have different capital regulations. So I don't think that's the issue. I think the issue is today, it is really hard to imagine not being a bank at scale. I can't imagine having to figure out how to protect yourself from a cyber perspective or a technology perspective. We spend $10 billion a year on technology. We have 50,000 technologists. That's the size of like most firms in total. We spend $750 million just on cyber protection. And so to keep up with that is really, really hard. And to be able to deliver to the consumer, so we're all here from the banking side, but when you flip it on its head, our day job is to deliver to the consumer. You had to be there to be smarter for the consumer. You got to be able to help them to know, oh, you had a raise. Let's see if you can save some more money. Oh, I'm looking at your financial picture and you could pay off that debt a little sooner. So all the AI we have, all the big data, all the ability to help the consumer to make a smarter decision, to be better, to be able to save money so that they can retire in a hopefully better manner than they would with otherwise not attended to. That's the goal that we're all seeking to do here. And if you don't have scale and you don't have the ability to do that, it's just going to be a really, really hard slog.
So then fragmentation in the European banking sector is a real problem. If we need scale, Sergio, you've said we need cross-border deals, we need consolidation, we need Deutsche Bank to merge with someone, don't we?
No, I have everything right other than the last one. I've been saying for a while that in Europe, the topic will be one day or the other too small to survive, not too big to fail. And in that sense, I guess we're going to get there sometime. Maybe another angle. First of all, I would echo what has been said about the resilience of the banking sector. And I think that before the taxpayer comes in right now, I would say if the taxpayer comes in, is likely to do a good deal, because the amount of losses that shareholders and bondholders would have to take are quite big. Second, fundamentally, a bank, if a bank operates in a negative rates environment, is de facto taking away a big chunk of its natural profitability. Number two, for Europe, if you don't have growth, economic growth, you are losing the asset side of your. So there is also fundamentally something to be done and twickled about banking regulation. I think that I would say that fragmentation in Europe is one, but I also say that the aftermath of the financial crisis seems to indicate that on a global basis, we still see a lot of parochial, fragmented approach to regulation, even within the same countries, where between prudential and conduct, and or in countries where you have 4 or 5 agencies or regulators regulating the same matter, creating potential confusion in a crisis. It's not up to me.
Can I tempt you to name a couple of those countries? Give us a continent. Italy, maybe?
I stay very diplomatic. So when... Now, the second issue, which I want to also point, because it's too easy to look at what banks can do, each bank, focus on what you're good at and where you can add value to clients and shareholders. And last but not least, is shareholders themselves. How many, there is a responsibility for many institutional shareholders not to let banks who have no sustainable business model to continue to be funded and recapitalized forever. So how you take out overcapacity is a function of some mergers, because there are a lot of mergers that make sense, right? If you look at strategic sense, you tick the box. Financial, you tick the box. And then there are feasibility. And feasibility means shareholder, management, regulators, politicians. How many times do you hear people still talking about national champions? National champions. At the same time, they want to have one Europe. I mean, it's a huge contradiction. But in essence, shareholders should also really put pressure on management, on boards to basically restructure and do the right thing.
Okay. Mark?
Just pick up on these points and Sergio's theme of no complacency. And I think what's quite important here is planning for failure. So assume failure. And that's one thing bondholders in banks now have to think about, because they are going to be bailed in. And the ESM and other mechanisms being put in place in Europe will make that much more credible. Other countries have different mechanisms to do it, but the capital's there. And I'd say a little plug for the UK banks. They have bail-inable debt. They're 2020. They're already meeting their 2020 targets already, so they don't have to issue more. The second bit of complacency goes to what Mary's talking about in terms of operational risk in cyber. So one of the things, and it's one of the things we've started working with the IMF and then down through the FSB, is assume a successful cyber attack. Obviously, tons of work needs to be done to prevent successful cyber attack, but assume success. So how quickly can you get back up and running? How will you get back up and running? What are the mechanisms? Think that through. So planning for failure is hugely important. Then this last point on scale and competition in the sector. I'm not in the too small to survive. I think there are elements, and I'm not just going to wave a fintech wand and say they're going to solve all things, but elements we've been thinking about. I know Christine's leadership on the IMF and others in terms of where there's going to be competition coming in for small, medium-sized enterprise lending, how institutions can use the cloud to narrow some of these gaps in terms of resilience gaps, how we can be nimble, and what we need to do at a global level for direction, but then it's going to have to be tailored on a local level to make it actually happen. And I think that's a big element of the reform agenda on a go-forward basis that, as I say, the fund is leading.
Any conversation about shaping the financial future cannot leave interest rates and the Federal Reserve out of the discussion. I think everybody's probably got a view on this, but Madame Lagarde, I might start you off on this. Last time I had you on a panel was, I think, in Bali, just after President Trump had been critical of Jay Powell. We subsequently had an interest rate hike. Jay Powell very clearly declared to the world that he's an independent banker who will not be pushed around by the head of government. We are in a position now, though, where the nuance from the Fed seems to have shifted, and the capital markets seem to be urging the Fed now to be in a restraintful mode, not to hike rates again, and perhaps even to think about cutting rates if we see growth slowing down too quickly. I'd just appreciate your thoughts on whether that's a very good place to be, given the $11 trillion that Mary mentioned still sits on central bank balance sheets, and the debt that we have been encouraged to take on board since the global financial crisis. We need normalization, don't we? Not Fed or any other central bank that shirks its responsibility to normalize rates.
You know, I'm not going to comment on the interest rates path forecast and various dots, but I'm certain that what Jay Powell is doing is going to be data dependent, because this is the sort of key principle that he has applied, that he has advocated, that certainly we very, very strongly support, just not as far as the Fed is concerned, but as far as central bankers are concerned, with their legitimate and necessary independence. So if he has slightly changed his tone during his latest communication, that is probably because he's seeing data and analyzing particularly the labor market numbers and the slightly varying numbers on inflation that will actually lead him to change slightly or to qualify slightly the course that he had adopted. But as far as, you know, room to maneuver, he's one of the very few. Marcus may be one of them as well, but he's one of the very few central bankers who have a little bit of space. And I would agree with Sergio. It would be very nice if the economies at large didn't have to rely on the central banks yet again in order to resist the next shock, which is why I think that policymakers have to really take the right course of action when it comes to fiscal policies, when it comes to actually completing the reforms that some of them have undertaken, but that some of them have only just touched softly and need to go much deeper into. Can I come back 1 second on the on the fintech? Good. Yeah, briefly. Because I think that the point made by Mark is critically important, and in a way it touches on what Mary was saying. I was just thrilled to hear you, Mary, talk about the concern that banks have about their clients, consumer protections, long-term planning for them, stability and all of that, because I think those are really legitimate concerns on the part of the banking sector. If there is one word that I'm taking away from Davos so far, it is the word purpose. And I think that we are hearing that loud and clear from civil society, from the millennials, from many, many corners around the planet. And I think any sector, the financial sector alike, needs to have that purpose. And it cannot just be single-mindedly the pursuit of profits. It has to be multifaceted, and it has to take into account multiple stakeholders. I would caution the sector against one thing. One is the significant development of fintechs, which is good in and of itself, provided that it is adequately regulated, that anti-money laundering risks are taken care of, that the combating of the financing of terrorism is legitimately addressed, and consumers are protected as well. But they are going to come and shake the system. And I think many of the large banks actually know that, have internalized that, and are taking measures to either include them or move in the same direction. The second caution that I would like to also address to the banking sector is watch out where your compensation systems are yet again going. I'm a strong believer that people move depending on incentives. I think we're seeing some incentive systems in some corners of the financial sector yet again moving in a direction that I find not exactly aligned with the sense of purpose that I hope banks actually have.
Do you want to name names?
No.
Okay.
Never mind. Hugo, very quickly.
Yeah, I like to mention that the fintech actually will be a very big theme for us to invest, particularly in China, because we are really want to build a scalable and sustainable business. Because China, with so many users of the mobile internet users, and particularly with the Alipay and WeChat Pay, so they can reach a lot of customers very quickly. I think now is really they change the people's habit, going shopping, traveling in China particularly. So now I hear it's a lot of opportunity for us to get into that one. That's what I'm thinking.
Okay, can I circle back to interest rates with you, Governor, because I think we still need to tie off this issue. Since the global financial crisis, we were all encouraged to borrow. Governments were out there saying, build up your cash, get out there, buy cars, stimulate the economy. Now we're seeing growth momentum slow again. Can we rely on the same old party trick? And will we force the central banks to engage in doing that to make it happen?
Okay, I'm going to pick up on something you said earlier on, which is Jay Powell's purpose, or the Federal Reserve's this need to, quote, normalize interest rates. The purpose of the Federal Reserve is to meet its dual mandate for inflation and employment, full employment. Purpose of the Bank of England is to meet its inflation target, and subject to that, support the real economy. So you stick to your purpose, and there's not a magical level of interest rates that we're just trying to get back to, interest rates that were consistent with an entirely different structure of the global economy. The reality is that with interest rates as low as they are and balance sheets as large as they are, central bank balance sheets as large as they are, there is some stimulus being provided to the economies, but not that much. Not that much. And if you look at the speed limits, and the speed limits of the economies have gone down. Now, one speed limit being growth in labor force and productivity, as you know. Now, we can't influence productivity in the economy, except in a bad way. We can influence it in a bad way by letting inflation get out of control, messing up the financial sector, and having a drag on productivity. Productivity is driven by the private sector, it's driven by innovation, it's also driven by the right public sector, infrastructure, education, et cetera. We don't influence any of those things. So the world being in a growth path, and we'll take the IMF forecast, which I believe, Christine, is sort of decelerating to something around global potential. So kind of 3.25, 3.5, bouncing around in that area, around, let's say 3.5, I think, for the IMF, around global potential. 10 years ago, global potential was north of 4, in some respects even 4.5. That difference is not because of central bank policy. Central banks can't magic up moving from 3.5 to 4.5. The real economy is going to make the difference there. So I think it's important to have all that context. And I will say one other thing, which is that if you look at the US, the UK, particularly, households have delevered over the course of the last 10 years. You wouldn't know that from the headlines, but they have paid down debt relative to their incomes. The corporate sector has levered up, and that's one of the potential vulnerabilities, and obviously governments have moved. But in terms of the core of the economy, households have not rushed out, gotten over their skis, to use a skiing expression, and so they're in better shape at this point, which is one of the reasons, I'll stop here, why, because that imbalance in those economies is not what it was on the eve of the crisis, it's one of the reasons to have some confidence that the slowdown does not necessarily follow that the slowdown moves to stagnation. In other words, that it's a deceleration to a round trend. Lots of other issues that could knock growth in either direction, but I would just leave you with that point on the household side.
Let's just talk a little bit about what is it, the Rumsfeld-esque known unknowns or unknown unknowns. And it's the unknown unknowns that I want to get into for a moment. Because I think as you at the FSB and others were crafting how the world would look after the global financial crisis, you couldn't have anticipated Brexit, and you couldn't have anticipated the trade war, you couldn't have anticipated protectionism. What's been remarkable is we've had a rebound and a recovery that's seen very little inflation. Mary, I know you, in speaking with CNBC over the last year, have said this could be one of the unexpected consequences, perhaps, of the trade war, that we begin to see real inflationary pressures begin to emerge in the United States and in the global economy. That doesn't sound like a very benign environment going forward, given where we are with debt and interest rates at the moment.
No, that's right. That's why Christine Lagarde said the most important thing, which is that the Fed will act on data-dependent information, and that data will show up or not, right? So we have wage pressures showing up. We don't have inflation rising as fast as wage pressures. We're watching those two things. You can see those daily. And you watch them, and you manage to them, and you try and stay ahead so that you have ammunition, you try and renormalize, you try and do all of those things. And so I'm very confident that that's what's happening. You know, on Mark's point about the consumer, that is the whole problem with all these headlines, right? The headline that you read is that the U.S. consumer has the highest debt ever, period, end of sentence. That is true. But what they forget is they have the higher assets ever. They have the highest net worth ever in the history. They have the lowest debt servicing ratio ever in the history of the U.S. consumer. They have the most people employed, lowest unemployment rate. For the first time in history, we have jobs posted being greater than people looking for jobs. And so you just have all these headlines you have to pull together, and you have to figure out how that's going to come to fruition. And the wage inflation is the thing that will maybe or not lead to inflation, but that's why the data dependency is the way. And they will act factually.
But let's throw up some facts in. Then corporate debt as a percentage of GDP is the highest it's ever been. We've had companies in the United States primarily that have gone to BBB rating because of the amount of leverage they've taken on to buy back their own shares. There are pockets of concern.
I would say
Let's not paint a picture of
I would say
everything
interest expense to operating earnings is about 15%, which is about the 30-year average history. I would say that BBB means the BBBs used to only be about a third of the investment grade market. Now they're about 50%. That means that there's a lot more companies that have been able to come and access the capital markets at very attractive interest rates. You see default rates in the high yield markets still at about a 2% level. I mean, that's just, those are incredibly strong numbers that would take you forward a lot longer than I think what people are nervous about from a recessionary standpoint.
So, and then I'll hand to Christine, because I know you want, do you want to come in first?
It was a very quick reaction to what Mary was saying, which is completely right. But what is really disconcerting to us economists is how the US economy is producing those unbelievable employment and unemployment numbers. And yet we're seeing hardly a little shake in the wage numbers. And that is something which clearly needs deeper understanding and deeper research.
But 3.5%. I mean, 3.5%. I think was the last print out of the non-farm payroll.
Yeah,
so
but that's...
I mean, it's rate of change, perhaps.
Yeah,
Mark.
way to go. I'll pick up on the corporate leverage point. Agree with Mary's right on the stats and needs to have the context. But it is one of the areas I think we all look at, and I know the banks look at it as well, and say, this is a pocket of risk. It's by our calculations, when you roll everything, all the CLOs, what's on balance sheet, the revolvers, et cetera, in leveraged loan space, it's more than $2 trillion. It's about 15% of credit. It's been growing at 15 points a year. It's about 9% of credit growing at 15% a year. And the underwriting standards have deteriorated over time. So it is a concern. Then we go to the next stage and say, who owns it? And actually, very little is on the bank balance sheets. Very little is warehoused, sort of in between being on the bank balance sheets and going. A lot of it is in longer term, people who have long-term liabilities who own it, so they're matched. And some of it is in these funds, and I alluded to this earlier, where you get more concerned because they have daily liquidity. They're a mutual fund effectively, and they own what is, can be quite an illiquid asset. That's where we get concerned. In the universe of this $2 trillion of leveraged lending, most of it is with institutions that can take the risk. And they may be, if there is a sharper slowdown, if this keeps going, they may be about to lose a chunk of money, right? But that doesn't propagate, or is less likely to propagate through the system. It's more akin to equity being behind something. So it's important to follow the money all the way through. But I'm from where I sit, central banker, you're paid to worry, and we see these trends. And what we worry about is if you extrapolate them and if they keep going, potentially this risk comes closer to the core of the system. Therefore, it's good to be talking about it in an open forum and thinking about it. And again, not being complacent. Just because it hasn't happened doesn't mean it won't happen.
Just off topic, I'll just pass it to you. Just off topic for a moment. I mean, you've been such a good warrior for the UK. If there's a Brexit extension of the negotiating period, would you be prepared to stay around a little bit longer?
I'm prepared to stay around for another 5 minutes and 8 seconds, which is what the clock says.
So I'm not going to get an answer
but
on.
Sergio is a man with a balance sheet who's about to say something.
No,
about leveraged
just two
lending,
thoughts. First of all, on your point, Jeff, you're right that many corporates in the US borrowed in order to buy back shares, but remember that kind of arbitrage on the tax offshore retained revenue profits that are now repatriated, and this somehow is going to normalize. I'm not so concerned about the quality of the corporate loans in the banking system. I fully agree with Mark that we just need to understand, and when investors that are outside the banking system or through funds or through private equity will start maybe to see losses, then that's also going to impact their sentiment, their propensions to risk, and so on. But last but not least, I think that what we are not really discussing in a normalized rates environment, the one who are most vulnerable are governments. I mean, some of those governments will not be able to fund and normalize 300 basis points hike on rates or a normalized environment. They would not be able to pay their debt, outstanding debt. And that's probably, crises do come from two elements.
Well, let me
real estate and government. And
let me take that to our minister, because whilst Germany may have some fiscal headroom, there are plenty of other Eurozone countries, Italy, that don't. Could you perhaps talk to that? And I know you wanted to pick up on some of the other points.
Yeah, so I think on the sovereign debt issue, obviously, on the one side, I think we in Germany we've done the homework to a large degree by reducing debt to GDP levels, but not as a means in itself, but as a means to having the firepower needed that if there is a worsening of economic conditions, there is headroom to react. So I think that's important. On the other side, I think we've said all that needs to be said in terms of supporting the many statements of the European Commission on debt. And your question on Italy, I think, is also very easy to answer in that we've always said that we supported the clear words and analysis of the European Commission. In December, that led to an agreement on that has a very substantial impact on the Italian budget, and I think that's a step in the right direction. It's not the resolution of the problem, of course. Levels of debt, and we fully agree with what the IMF says there, are generally too high. So the further need to consolidate and fix the roof while the sun is shining, as Christine so often says, I think is something we can completely subscribe to. So in that sense, I think work still needs to be done quite substantially. On the liquidity topic, I think that's a very important point, and I think that is just the other side of the medal of compression of spreads in many asset classes, right? The fact that government bond spreads have compressed, corporate bond spreads have compressed, high yield spreads have compressed is very obvious whenever you talk to the institutional investors. What premium do they look for next? It's the liquidity premium. So in a way, the spread compression that we've witnessed in almost all asset classes is just the natural impetus to seek for a liquidity premium. And that's why we in our macroprudential work look very carefully at the exposure of banks. And I think what Sergio has said fully correctly, the real estate market is one area that we're looking at very, very carefully, because European real estate has seen very substantial price increases.
Terrific. Thank you very much, Minister. The reason I want to wrap things up is we're very close to the end here, but I did want to give Madame Lagarde the last word, because while I'm hearing that we've made a lot of progress in different areas of the financial architecture, you made the comment not so long ago that if it had been Lehman Sisters, then the world may look very different.
And I called Goldman Sachs Goldman and Woman Sachs, so that it would be better.
But and just to give you the final word, we haven't made enough progress in that area, have we?
It's a serious point. And we just published recently a study about the composition of boards and the gender of CEOs in the financial sector, banking, insurance, and the larger sector. And the numbers are just appalling. Thank goodness Mary is here with us. But if you look at the numbers, you have 20% of board members in the financial sector who are women, and you only have 2% of CEOs who are women. And, just for, if anybody has some business common sense and purpose and wants and understands that diversity actually precipitates productivity and is good for all, there should be significant changes. We're not seeing much of that, and I would hope that the financial sector takes that approach seriously. It's conducive to lesser risks. It's not conducive to less fees and less return, quite to the contrary, and clearly changes have to take place.
Thank you so much for your contribution, and thank you to all of our panelists for this CNBC special program, and thank you for tuning in. We'll see you next time.
Guys, what's going on? It is Andy Elliott. If you're earning less than $250,000 a year, if you are, I'm going to tell you this is how you're going to rise to the tops. And listen, if you're in the automotive space, any of my auto people, this is your opportunity to go to the next level now. Listen up, okay? Because this is the video that's going to change your life. Check it out.
I just want to stay bad, stay mad, chip on my shoulder because they treat me like an outcast. I ain't gonna take that, stay back, I'll be swinging hard till they...
Hey guys, what's going on? Today I'm here with my man, Dennis Gingrich. Dennis is one of the most savage, killer F&I people in the world. Now listen, I'm gonna tell you what this whole video is about. I'm gonna tell you what this podcast is about. This is an opportunity for you. If you're in the automotive space and you're selling cars, if you want to move up, I don't care if your company wants you to move up. Do you want to move up? Do you want to go and move up through the ranks, own a store, run an F&I department, be a manager? Do you want to move up? If the answer is yes, listen. I'm going to tell you how to do it, okay? Here's your freaking chance. I am going to show you how to have every dealership in the country wanting to hire you if you're not in the automotive space, okay? And you got a job right now and you're earning less than $250,000 a year. I want to tell you this. I train over 10,000 dealerships in the automotive industry, and I'm telling you right now, the number one thing that I get a call every day, and people are asking me, Andy, I need F&I people. And you know what they say? Listen, they say, I don't even want veterans. You know what I want? I want someone who is a salesman, who is hungry, who is fired up, who understands finance, who can come in here, make money, take care of customers, and move the needle in our back end of our company. Guys, listen to me. There's a massive need for finance people. Listen, I've got GM after owner after managers lined up ready to hire you right now, okay? Now, my man Dennis, me and him are putting on an event, okay? One day, I will make you the most deadliest F&I person in the country. Dennis, how many stores do you currently run? Is it 8?
9.
9? He runs 9 stores. Listen to me. Compliance, closing, selling, customer satisfaction, everything. He's put together a one-day guide. He's going to teach you every close, how to present everything from A to Z with me in Scottsdale, Arizona. One-day event, December of 2023. All you have to do, if you want information on this, and then let's get into the training, text this number below. You see the number on the screen, 918-210-0254. Send me a text, 918-210-0254. Say, Andy, send me information on the finance event. Listen to me. The ticket to get into the event is $997. It's less than $1,000. I'm just telling you up front. It's $997. In one-day event. How long have you been in F&I, Dennis?
26 years.
In one day, we have a blueprint, A to Z, to teach you how to walk into any interview at all. I can give you a job on the spot when you're here after you go through his class. Call a GM, get you a job like that. I can show you how to do an interview, and I can make you better than any finance guy who's been doing it for 10 years. Dennis is going to train you in one day, everything from A to Z that you'll need to know. Scottsdale, Arizona, spend one day with me and Dennis. We're going to walk you through the entire F&I curriculum, which is going to show you not only how to understand finance, but how to close and sell every client and make them the most satisfied, happiest customer you've ever seen, and run the highest gross per copy and get paid more than you ever imagined in your life. We've got F&I guys that Dennis trains that make 500 grand a year. Listen to me, guys. Listen, this is your chance to create a new career for your family, your life, everything you've ever wanted. We're going to teach you when you walk out of here. Number one, I'll line you up with the job. I just need you to show up, pay attention, and learn. I'll handle it. So, Dennis, I want to turn it over. I don't want to talk a lot here. I know that you're the king, you're the master. I want to tell you this. I'm really good at selling. I'm good at closing. I'm good at team building. I'm good at leadership. I'm good at a lot of stuff. But I always recognize when somebody's better than me at something. This guy is the best. And, you know, in the F&I space, when it comes to money and compliance, it's really important that you know who you're learning from, okay? And by the way, if you're a general manager, you're a dealer, and you're watching this, like, you need to send your people to this, okay? Let's get into some of the things that they can expect to learn. Let's get into things that the market right now needs. Let's get into things that dealerships are thirsty for. Is that cool? Dennis, if you haven't met Dennis before, guys, he's from California. He's a savage. He's the most incredible man. If he says he's going to do something, he's going to do it. He doesn't take bets that he knows he can't win. He is a savage at training people how to become dangerous in F&I. So tell us a little bit about your background, and let's just talk about this event, what all everybody's going to be learning. Hey, guys, what's going on? It's Andy. A lot of you leave comments telling me that you need help. Do me a favor. I'm going to tell you the best way to get a hold of me. Shoot me a text message right now, 918-210-0254. 918-210-0254. I'll help you with whatever you need. I got your back for life. Let's get back to the video.
Well, first of all, Andy, I just want to thank you for having me down here in the desert. Every time I come here, I just am reinvigorated about everything I do, and I'm incredibly excited to partner with you on December 11th. You know, my career, my entire professional career has been in automotive. You know, I started at 18, I'm 44, got into that F&I office at age 20, and it has been a great business for me. I have never wanted for anything. The F&I arena right now is probably, I don't even want to say probably, it is definitely the most important office in the dealership right now. The market is changing as it always does, but there's so much going on. We've got rising interest rates, we've got inflation, we have government looking closely at a lot of different industries, but the automotive industry has always been at the forefront of regulation and compliance bodies, making sure that we in automotive are doing the right thing. So I would say the table stakes of being an F&I are as high as they've ever been. So when you come down here on December 11th, I want to make sure you're set up for success. Yes, I'm going to teach you how to run big numbers. Yes, I'm going to help drive your penetration and product index through the roof. Absolutely, we're going to make sure you're doing it in a way to make sure your customers feel good about you as an individual, but feel good about the dealership. And then, of course, making sure you're doing all that while being compliant to state, local, and federal entities. I'm grateful that I work in California. California is one of the toughest markets when it comes to compliance. The complexity there is arguably second to none when you compare it to the other 49 states in the union.
I want to say this, Dennis. I got a lot of dealerships that have been buying tickets fast. So listen, if you're watching this, like, text now and get your tickets, okay? Because I think we're only taking like 100, 200 people and we're cutting it off. So I just want you to know this is going to be a smaller, intimate setting where we can train everybody to be the most elite. But I wanted to explain this. Number one, when the dealers that I do business with found out that you were teaching it, the first question they asked is, where's he from? And when I said California, they said, yep, send him my people. Because your compliance are the most strictest from any state. So when you teach from the California standard, it literally blankets every state. And that compliance is the number one reasons why dealerships get sued, why there's lawsuits and all those things. So like, it's not only about making money, it's about keeping it, right? And I know that dealerships right now are looking to make and keep money. They want people that have been trained and have been trained the right way. Dude, when you walk out of here and you say that you're Andy Elliott certified and you were trained by Dennis Gingrich, I want to explain this to you. You can get a job anywhere in the world. And if you've been in this business for a while, I mean, dude, your guys are running crazy numbers. You're still in the dealership today. You still train today. And I love it that your dealership has such an abundance mindset that they allow you to train other people because they're not afraid, they're not scared. They allow you to train other people because they love seeing what you do as far as changing the automotive industry perspective, right? Like you've made the automotive industry a better place, just like I have. So us two together, we're dangerous. So I just want to say, like, I've had a lot of dealers, they've asked me, where are you from? When I say California, they're like, yeah, I'm sending 3.
Yeah.
Let's go.
No, I mean, it's, being in California, yeah, it's challenging, but anything that's not challenging isn't really worth doing. So when you work in an environment like that, not only do you have to elevate your attention to detail, crossing the T's, dotting the I's, but you also have to elevate your sales pitch, right? The days of, sliding something by a customer, they're gone. The internet it has all of the information a consumer could possibly want to know whether they were not treated as they were supposed to. So if you're not trained in a way to meet today's demands of being an F&I manager, you're probably not long in the tooth in your current chair. So, and that's not a criticism of any individual that's been doing this for a long time, Andy. It's not, because some of us have worked at the same dealership for a long time, and we fall into the trap of doing things for the reason because that's the way we've always done it. It's not a fault, but the only way to grow is to get off your island, get outside your dealership, and come to an event with a bunch of different people around the country that are all here to do one thing, and that's learn and grow.
Yeah, I wanted to say something. I've got a guy who's 20 years old who works for a smaller independent store, and he was running around. And by he's 20 years old, he's worked there since he's 18, 2 years. They gave him a shot in finance because there's only a couple salespeople there in the store. He moved up. The guy was running $1,200 a copy. Now, obviously, he's young. He's 20 years old. But look, I love young people. They're very innovative. They learn. They're hungry. He's running $1,200 a copy. Me and you created a finance training together. He bought this finance training. He's running about $3,200 a copy now. And that was literally within just 1 or 2 months of listening to the way that you speak, the way you present, the way you talk. Every dealer that I do business with, when they hear some of the ways that you've closed and presented, they said, look, I've been doing this for 30 years. No one, and I mean no one that I've ever met, is as good as you. Can you give a little background on like your training in F&I so that people, because you were with Zurich for a long time, right? Like in like what that means. I mean, because you haven't just stayed in one dealership. Like you've learned from being in finance training companies, right? Like you don't work in a dealership. I'm like, hey, this is my buddy works at a car dealership. He's going to teach you guys. Let's give a little bit of credibility to your background. Is that cool?
No, I think that's great, and I think it is important because yes, I got started in finance like I mentioned at 20, and you learn over just taking a lot of reps. That's true with anything you're doing. More reps, the better you're going to get. But when you don't pull yourself out and get outside training or seek feedback, good, bad, or ugly feedback, as long as it's constructive, you're really not going to grow. So when I first started, I remember like $1,200-$1,500 was good. That was good. And then you start looking around your local automotive community and you hear about the guy or gal down the street that's running $2,000 or $2,500. And then you start to network with these people. And that's really what we're talking about on December 11th to some extent. But going through this constant repetition, and one thing that, I'm grateful for is that I was one of the upper performers when I came up in the industry. I knew people, and people knew me for what I could bring to the table, and that was getting deals bought, running good numbers, and and then through my network of lending partners, when I moved from Nevada over to California, that's how I got put in with a local automotive group there, which was just another level up. And throughout that time, I made a lot of contacts with various vendors, providers of our service contracts, Gap, and all those different policies. And then, one day I have a buddy of mine, still a very close friend. He came in and saw me at the dealership I was doing F&I with, and he goes, hey man, I'm looking for somebody to come run this region, right? To train and develop our F&I accounts and add new business. And he goes, you know anybody that would be interested? And I was like, that's me. That's what
you've always wanted to teach, right?
I've always, I love teaching. I mean, when you teach somebody something that they can and you know this better than anybody, Andy, but if you teach somebody and they're able to put it in play and make a meaningful difference in their life, and just because you didn't benefit from it financially, that's like the fulfillment piece, I think, of humanity, right? That feels really good. And, and sometimes we get money as a byproduct, which is added bonus, but I think teaching somebody how to grow and learn so they can be successful is great, and I think that's the goal. But, I was presented with this opportunity, and I remember this, and it's kind of a funny story because right now we got 2 open spots at our dealerships right now to bring, a couple new F&I managers onto the team. And I got a call from just somebody I've always kept in touch with, and he goes, "Dude, I've never done a resume. I've never done a resume." And I'm like, "Dude, hit me up. I want to help you with your resume. I want to help you be prepared, because I want him, when he goes into our store, to sit down with our general manager, our general sales manager, and be prepared," right?
Be set up for success.
Yeah, exactly. And I bring up the resume story because I wasn't too different from this guy. When I got, "Hey, are you interested in doing this job?" I had never done a resume. And I just remember I was sitting up late at night obsessing over this resume. Nobody'd ever asked me for a resume. Yeah, I heard.
Resumes in the car business don't normally exist.
No, it's
normally.
Like, here's my W-2.
Yeah, except big. Yeah, here's my W-2. This is what I made selling. This is why you want me. But the big companies, they are interested a little bit in them. And at the end of the day, you're a teacher, and what I like is I speak completely different than you. The way that you speak is dangerous in finance. Like I'm just saying, like the way that you speak, the way that you articulate your words, the way that you talk, the way that you slow down, the way that you make everything clear. It's, I'm not saying that I'm not trustworthy, but the way that you teach people to speak in finance, it's not like you're making them a different person, but you show them the way to be the most credible, trustable person in the finance position. And that's the last person that the dealership, lets the customer meet before they leave. So that's their last perception of the store. And a lot of times right now, profit margins are driving down on the front end. So dealerships are really counting on that back end money, which means they need professionals to do a good job.
Well, and that's the whole, in my opinion, that's the real point of a resume, guys and girls, right? It's really to demonstrate your ability to communicate who you are. And, the way I look at it, that even if it comes across and it's not, grammatically perfect, I don't care. I just want to see a summary, and that you can articulate and show growth. And when I go back to getting hired, I obsessed on it. I worked really hard on it. And, at the end of the day, they told me I got the job because I communicated well. I put forth the effort. And I think that's what society, specifically our industry, is challenged with, is communication skills. So you show me with somebody with an average work ethic and can communicate at a high level, they're going to do okay. But if you show me somebody that's got an above average work ethic and can communicate at a very high level, and communication just doesn't mean this, Andy. It means these 2 big ears are working and listening to the customer, answering the question that's asked, that's it. So to be able to communicate, whether it's in front of a customer that demands clear communication and transparency, because almost any issue you experience in the dealership, whether it be just a standard issue, hey, I'm upset the way I was treated, or you didn't tell me everything that was going on with the car, or the list goes on and on. When I get involved with those at my dealership, because we're not perfect, we strive for it, but we have problems. When I start talking to customers and I start talking to the people on my team, the common denominator is always poor communication. 90% of the problems we face can be avoided with communication. And when you're a good communicator, meaning you're listening to that customer and they felt heard, they're going to engage in dialogue. I always tell my people, monologues don't sell. Dialogue does. You say the same thing, right? Good questions, you get good answers. So you've got to engage in that. So I would say when you come down here on December 11th, we're really going to work on your communication. So I don't want you guys coming down here looking for a silver bullet, because there's not a a customer, there's a customer out there that's not going to buy a service contract, Andy. But if I do a good job communicating through asking questions and listening, you know, they might sign up with a tire and wheel policy. They might sign up for a theft recovery benefit or GAP or paint and fab or whatever the widget is we offer. But they're not going to do that if we don't create a need that they believe in, right? And that all stems from effective communication and a very solid process that is consistent, something that can be duplicated time and time again. And because all that hard work, that pre-work, if you do that all consistently, you're going to get people just say yes or engaged in conversation. At the end of the day, if you ask any F&I manager, all they want is somebody that's willing to engage in conversation about the wares we offer.
Yeah.
That's the key. And we can control that as F&I managers. So that when you come down here, that's what I want to teach you guys, is to set yourself up for success and catch the people that like, man, that was great, I want it all, and then have them engaged in dialogue. So when they tell you no, you can add some additional products so you can still walk away from that deal feeling like, man, I did a real good job.
So, guys, I'm going to call Dennis out. I call bullshit. Listen, everybody will buy everything that you sell when Dennis teaches you. Like, he's very humble. He's like, you know, not everybody's going to do it. Listen, bull crap. Don't listen to him. Okay? Here's what I want you to know. Hey, guys, what's going on? It's Andy. A lot of you leave comments telling me that you need help. Do me a favor. I'm going to tell you the best way to get a hold of me. Shoot me a text message right now, 918-210-0254. 918-210-0254. I'll help you with whatever you need. I got your back for life. Let's get back to the video. The way that Dennis sets up his presentation is 100% differently than any other finance manager I've ever seen in my life, than any other finance person or producer, whatever you call yourself, that I've ever seen in my life. Now, I need you to understand this, okay? If every dealership in the world right now is looking for better finance people, if every dealership in the world right now is looking for trained finance professionals with great attitudes, okay? And if you're good at one of these, you'll make at least $250,000, okay? At least. What's going on? What are you going to do? Where do you get trained? Where do you learn? Simple. One-day event, December 11th, okay? Text the number below, the 918-210-0254. Just text 918-210-0254. The tickets are $997. One day, you spend less than $1,000 in Scottsdale, Arizona with me and Dennis. Dennis will walk you through A to Z, where if you are a current person in the automotive industry who are in sales and you want to move up, we will show you how to leave, go back to your store, and literally get a job in F&I. If you're in finance and you're currently not running at least $3,000 a copy, you need to sell more products, okay? You need to be here. Okay, your job is to be the best in the world, top 1%. This is your opportunity to go back to your store and make $500,000 a year plus. Okay, if you're not in the automotive industry and you're like, man, dude, you know, I'm good at sales, or I'm good at communicating, I'm good at speaking. I know people that have never sold a car before in their life that went into car dealerships and they get a job in the finance department, because it seems like more car dealerships are opening to hiring people who have never sold cars, who actually understand finance. And it's almost like they prefer to sometimes hire people who haven't sold cars. And you say, well, some people are like, well, no, that everybody has to sell cars. No, they don't. No, they don't. I know a lot of people right now that are hiring people that haven't sold cars, but that have been trained on finance. Listen, we're in an era of a new time. Going into 2024, a lot of car dealers right now, like you said, margins are compressing on the front end again. Okay, they're really counting on this back end money. They need to make sure that customers are treated amazing so that the clients will go service the vehicles with them. That way they can stay there as retention with customers. When we sell them a warranty contract, they're going to come back again and do service. Also, I honestly think the automotive industry is sick of amateurs.
Yeah,
I mean, like, they're sick of it, right? Like,
we are tired, and quite honestly, not just the automotive industry, but I think people in general, like the public, consumers, they're tired of amateurs. Andy, I mean, you go out over COVID and customer service and communication,
dog crap,
dude. It's a lost art. It's terrible. I mean, go into a restaurant and try to get somebody's attention, you got people like they'll avoid eye contact. That's how we initiate communication, so right now the industry needs to change. We have, as an industry, a black eye, and some of it, quite frankly, is well deserved because of the way we have dealt with we'll call it instances of transparency. We haven't been forthcoming and transparent in the way we transact with the customers, and I'm here to tell you, the cost of not doing it right and being compliant is huge. Like a lot of you guys, we're all on social media, and there's guys out there that are talking about F&I training, and I was listening to one of them starting to talk about compliance, Andy, and I'm listening to his rant about how important compliance is, which I agree with him fundamentally. And as he's talking through it, he's like, I'm not asking you to give up your leg. And I'm sitting here going like,
that's compliant.
You can't have leg and compliance
in the same sentence.
The same sentence, really. That's like non-compliance, right? So there's a lot of guys that are in this space that want to train that are so far removed from the regulatory environment. Yeah, they might know the regulatory environment in terms of the service contracts and how things work at the state, but just generally speaking, the stakes are so high. And when you come in here, yeah, I'm not going to be able to address all 50 states because there's some states that have some intricacies. And I'm not talking about, like, when you come in here, compliance, I don't care if you know the fine or the prison term if you violate something we got to do. That doesn't mean anything to anybody, right? That doesn't mean. You need to know in a practical sense, how do I solve this on the fly through my daily routine? When I'm in belly to belly across the table with a customer and I got to go 90 miles a minute because they're in a hurry, you need to have a process in place so you can quickly and efficiently and accurately check those boxes. And that is something that we're going to focus on when it comes to compliance. And I think that's important, right?
Yeah, well, I want to say this. Every day I got general managers that say, hey, Andy, train me up a finance guy, okay? I'll pay you. Just train me one up. Let me know when they're ready. And guys, that's not what I do. What we do is that we train people to go find their own opportunities, or we train people to increase an opportunity in their current company that doesn't currently exist. Like nobody's going to hire you to be the finance guy if you're not good at finance yet. Right? Like, I mean, Dennis, getting a job in finance isn't like, hey, boss, when do I get to move up? Well, if you don't understand finance and if you can't go in and take a turn right then and make money off it, they're not going to move you into finance because their biggest fear is that, like, oh, man, now I've got to waste all this energy training this guy. Okay? I want to tell you guys, listen to me. Everybody right now, if you're ready to move up and you want to move up and get a job, or you're currently doing it and want to make more money, as a finance manager, every dealership across the country is looking for F&I people. They're looking for new energy back in those finance office. They're looking for people that are hungry again. They're looking for people who want to grow. They're looking for I say new blood. Like, they're looking for new blood, okay? They're tired of the same washed out people. And listen, if you're not washed out, I'm not talking about you, but you know what I'm talking about, okay? And the deal is that I think that they're waiting for a training program to come out to create new people to come into the market. And, I'm telling you right now, your chance, do not miss this, to learn one day in a finance training class, Andy Elliott certified, Dennis Gingrich being there, how long were you at Zurich? For 10 years?
I was there 8 years.
8 years he did finance training. He's currently in a massive company in California with 9 stores, which oversees all the F&I and everything else. And dude, the guy is a savage. He's the most loving, kind-hearted, gentle person, would never lie to you. But he demands excellence. What I love about you is the way that you teach, the way that you explain, because you haven't taught anything on this. We're just having a conversation. When Dennis goes through with his playbook and walks through everything from A to Z, from how to present, how to handle objections when they come in, how to sell every product, literally, dude, when you leave, you are going to disrupt the market. Every single person at every single company will want to hire you. So if you want to be desired, or if you're a manager, if I was watching this and I was a manager and I'm like, hey, I don't want to go to F&I. Let's just say, like, I don't want to go to F&I. Okay, don't go to F&I, but you got to understand it if you want to be the general manager.
Oh, absolutely.
Right?
And, and we're going to get down to the fundamentals of that, right? Because if you don't, that's a great point. If you truly don't understand how F&I...
And they say they understand it, but they can't understand it if you haven't spent time with somebody like you. Because a lot of managers say, I understand it. Reading and approval, understanding warranty and gap is not understanding finance.
It's so much deeper than that. And I think our industry, and I'm sure there's other industries like that, like I tell the people I work with at the Nilo company, like, I'm okay if you don't know. Like, I would love anybody to say, hey, Dennis, I don't know. I don't understand. I need help. Like, I don't care that you don't know. I'm actually respect you more as a person because you're like, dude, I don't know. I don't understand. I don't get it. I need help. The guys and gals that, sit in their office and pretend they know everything or really believe they know everything, those are the offices the problems come out of.
Evolve or die.
Yeah, and you got to. And if you're not, like, growing, what are you doing? Eventually, you're just going to be burnt out because you're not growing. That's how you get burnt out, is because you're not challenging yourself and you're growing. So those of you that are in the office and have been doing it a long time, and I know some of you guys that are watching this are running great numbers and doing a great job. And, hey, you should still come down here because, yeah, maybe your PVR is great. Yeah, you could probably elevate it a little bit. But here's the other thing I want to spend time on when you come down here on December 11th. How do we get you to yes quicker so you can get on to the next opportunity? That is key, because think about this. If you're running a big number and you can multiply it by another big number, units, a big number times a big number equals a big number, and that means you're going to have a big paycheck. So that's what we want to do. And the other thing that we're really going to focus on for those of you that are already in the industry, already in the F&I chair, and this is going to be just as valuable for those that are looking to break through and get into that F&I office, is I'm going to take an actual human being's, one of my guys, their numbers, and I'm going to break it down. Like, I'm literally going to look at their report and we're going to talk about it. We're going to go through it live in time, and we're collectively going to identify the areas of opportunity that this individual needs to get where they should be. And then we're going to roll that in, and how do we adjust the pitch to fill in those voids so they can get paid and they can have a better life for them and their families. The dealership does better. We get more people in service. So when you come down here on December 11th, all I ask, just come down here with your ears open mind. I think we'll even be able to provide some pen and paper for you to take notes.
Yeah, we got everything, dude.
We got that, and you're going to have a hell of a time. But I promise you this, you're going to learn more in this one day, and I want you to do this, and I know you're going to do this. You're going to leave thirsty for more knowledge. And those are the people we want to hire.
Well, number one, you're going to learn more in one day than you learned in your whole life. And what I love about not only learning more in one day, you're going to learn the right way. What I love about Dennis is that when he trains somebody, I can call anyone. I can call anyone, and I can place you in his dealership or in a dealership if he's trained you. Okay, that's how dangerous Dennis is. I love the way he teaches. I love his core values. I love the way he believes. I love the way he sells. I love the way he closes. I love the way that he slows down but also gets to yes fast. I just love it, man. I love that he cares about not only the penetration that you're running, like on warranty and gap and all that, but also, how many products per deal, right? One of the things that I've seen you do is that someone will be like, oh, I'm running 2,500 a copy, but they may be running, 2 products per deal. And you may change them to running more per copy, but change it to 4 products per deal, which changes the pay plan dramatically. Depends on where you're at and how you make money. I mean, listen, guys, there are a lot of people that honestly are good at finance that don't get paid what they should because they don't know how to max out their pay plan because they're not ever fully developed. And not because they're not good people, they just never been trained the right way. You know, guys, if you want to own a dealership, if you want to become a general manager, if you want to be a teacher yourself inside of your store, if you want to move up through the ranks, if you want to be the best, if you want the greatest earning opportunity in the history of time, if you want to kill it, the automotive industry is thirsty, okay, for great finance people. They don't care about time and experience. They care about, can you do your job? Can you protect the dealership? And that's really it, and run good numbers. And December 11th, okay, the number on the screen, 918-210-0254. Guys, every time I get an opportunity to grow and learn, I lean into that, okay? I lean in. I learn from everybody. Dude, if I wasn't even in the automotive industry and I wasn't even going to do automotive, I would come down here and I would learn from you just to know what you know. Because what you teach, even in the finance space, it can be used in every industry. The way you talk, the way you articulate your words, the way that you frame a client, your golden questions you ask. I mean, dude, it works in every level of sales. But this event, the purpose of us putting it on is because every dealer has asked, we need better finance people, we need better numbers, and we need the best. And honestly, man, I'm looking around and I see the same people circulating, and the dealers are like, I don't want to pick from that pool. Where's another pool? So we're going to make one.
Well, in the pool, right, because we all live in one place, your competitor down the street, if you don't think the owners and the general managers aren't talking, you got another thing coming. Because I've been to the events. They talk. They know the people. You know, you got to be the guy when an opening comes up that your name
gets brought up.
That's what we want to teach you. And, you know, again, I cannot stress the importance enough right now. I mean, if you just look at the news, Andy, there's all kinds of uncertainty in the world. You look at what's happening with interest rates, and let's just keep this specifically to automotive. You know, it wasn't too long ago we saw interest rates in the 2s, not that long ago. Now you're seeing interest for good credit, 7s, 8s.
Isn't that crazy?
Dude, it blows my mind.
Yeah, when somebody's like, you know, you're an 850 credit score, and they're like, yeah, 7.9%. You almost look at them like they disrespected you.
Dude, I feel weird talking about it because it just turned so fast. It's like, this is a good rate. Like, wait a second, it doesn't really feel good because we just had 2. But think about this. When you got 2-3% money, it's a lot easier to be a little bit more frivolous.
That's right.
Right? It is. And so now...
that's why I see a lot of F&I guys are struggling right now, and their excuse is they're saying, well, I can't get a better rate. No, dude, you don't know how to sell that great.
100%. You're not going to get a better rate. Yeah, you could get a better rate.
And this could last for another 2 years.
It ain't going anywhere.
Yeah, that's why I was going to say, like, listen, dealers, owners, salespeople, like, understand this. If you've been wanting to be needed, if you want to be the person everybody's chasing, okay, if you want to be the person that you want your dealership to be like, I need him or I need her, okay, you got to be here. One day we're going to change your life. Guaranteed, man. We're going to make you the greatest of all time. Your company will see more value than in you than ever before. And you'll be the most dangerous person in your dealership. And if you're not in one now, you can get a job at any dealership in the United States after we train you. Guaranteed. In finance.
You're going to get a pop when you go home.
Dude, listen, this is going to be crazy. And by the way, there's only a certain amount of people that we're going to have come. There's only so many seats. It's going to be a private event. It's going to be in Scottsdale, Arizona at my location in the Lion's Den. Me and Dennis are going to be teaching it. You're going to get a playbook. We're going to go through everything A to Z. Guys, it's going to be life-changing, okay? So I want you to be here with me. I can't wait to meet you. I can't wait for you to meet Dennis. But understand and expect what you're going to get. To leave here and be the most dangerous person in the finance industry that exists. From every area, from compliance, from sales, from closing, from presenting, from setting up the sale, from selling more products, to growing a high gross per cop. Everything you need to know, you will leave with everything you need, okay? All you have to do is show up, okay? So guys, text the number below right now, 918-210-0254, 918-210-0254. Listen, bet on you, man. Okay, I know you got a lot going on in life. You know what I'll tell you? If you want 2024 to be the greatest year in the history of time, the greatest year, you want to make more money than ever, and why most companies are hurting, or most, salespeople or finance guys are making less money and bitching and whining and complaining, you will be thriving and killing it. Any last thing that you want to close this out with, Dennis?
Yeah, I just want to say something to the leaders of the stores that are watching this. The general managers, maybe the general sales managers. Maybe you haven't done F&I for very long, because there's some people that just genuinely, they've done F&I, but they don't like it, right? Which, hey, I get it. It has its challenges. Thank God everything's not for everybody, right? That's how we have, we need different skill sets. But to you guys and gals that run the stores, I know if you come down here to this training, you're going to be better equipped to inspect what you expect out of that department, what to look for. So when you're doing your routine deal audits and checking things out occasionally, you're going to know some of those hot spots that you need to make sure are dialed in your store to best protect your dealership and, quite frankly, your career.
Yeah, and you can go home and train your people.
Exactly.
I mean, dude, if I was a general manager, and let's say you say, well, I don't do that no more. Dude, you do that. You may not be the one taking the turn, but your job is to make sure that those people that are taking the turns are the best in the store. So I just want to say, guys, this is going to be a one-day event. This event, I've been super excited. All year long we've been talking about when we put this on, it's going to be badass. I know the event's already halfway sold out, and we haven't even talked about it, just from like people hearing from word of mouth that we're putting it on. Everybody's been asking for us to put on this finance event for a very long time. I don't partner with anybody except for Dennis. Dennis is the best at what he does. His name stands for itself. It's unreal. We have just learned so much from him. Every dealer that I've connected him with, when he talks and trains other people, like, they're blown away. This guy teaches skill on a whole nother level, but he makes it, what I really love about Dennis, and I'll finish on this, you make it fun to learn. You make it easy to understand. If anybody at this point in time, they're like, finance is complicated. Dude, listen, somebody taught it to you wrong. Like, I get it. It's cool, man. Hey, and by the way, look, the way that somebody presents something to you is the way you perceive it. And, a lot of people don't understand finance actually isn't that complicated. It actually isn't that difficult if you get trained the right way. And like you said, if you want to be great, then you need to show up here. We'll show you how to leave here and, either go kill it in your company where you're at, or go get a job anywhere you want and destroy it fast. And if you're currently in F&I, like I said lastly, dude, you'll run numbers that literally you'll never imagine that you could run, and you'll take everybody's soul.
And I love that you touched on this. Learning has to be fun. If it's not fun,
people dread it.
I'm not doing it. I mean, that's me. If it's not fun, I'm not doing it.
And the difference between, because you trained with Zurich,
yeah,
right, and a lot of other companies, dude, a lot of them are boring.
Yeah, dude.
I mean, honestly, like, I need everybody to understand that, but obviously they understand the way I operate. Like, our stuff isn't boring at all, but a lot of them are boring, man. It's just a lot of repetitive information and reading handbooks and stuff. I mean, Dennis, when I sat down and, we talked about finance, and you started teaching me the way that you set up, the questions you ask, the way that you present it, and then your closing, and then the way that you handle objections. I mean, dude, there was a time where I was speechless, and I was like, dude, who taught you this stuff? And then I go back to, not only did you do it forever and you're still doing it, but for 8 years, you taught closes, you taught selling, you taught and you learned from the best in the industry. So anything and everybody that had something great, you took it in. Now you've got this abundance of knowledge that's all badass, and you're going to teach it to people in one day and they can have it, Like, this is cool, man.
It's going to be good, man. I've done I've done a number of seminars over my career at Zurich, and I was always excited for those. But this one, I am really excited to do it just because, dude, it's going to be great. You got such a good vibe down here.
Oh, it's going to be badass, yeah.
I'm looking forward to it. We're going to have a blast. Looking forward to seeing each and every one of you down here. It's going to be fun. It's going to be well worth your time, and you'll definitely get some ROI.
Yeah, you're going to kill it, dude. He said you'll definitely get some ROI. You're going to leave a different human being. We're going to have to send your ass home with a new birth certificate. We're going to have to change your name. That's how much you're going to change, okay? Dennis is the one that always is like, you're going to get this. I'm like, dude, I'm telling you the truth. This guy's a savage. He doesn't give himself enough credit. I'm telling you, I would not be out here telling you he's as good as he is. He's going to show up, and anybody that's here, you're going to be like, oh my God.
Can we arm wrestle at the end of it?
Yeah, you're going to be like, we're going to be like, dude, I can't believe I didn't have to pay 20 grand to get this information. And you don't have to. And all we want you to do is leave and be the best and go build a name for you and your family and go get someone else's dealership and go change their life. Or if you're currently in a dealership, now they can actually see your true value and you can go get paid what you're worth because you self-invested. Now you're going to be ahead of everyone else. Dude, listen, and time and experience doesn't mean nothing. I've seen them take brand new people and make them better than 10-year finance people. Okay, like I need you to understand this. Like this is your way out. So lastly, text guys, okay, 918-210-0254. Just shoot me a text. Say, Andy, send me information on the December 11th event. And I can't wait to meet you, and let's kick some ass.
Dude, the desert in December, bro.
That's it, man. All right, guys, we'll see you in December. See you soon. Hey guys, I just want to tell you, you're the true 1%ers. You made it till the end of the video. Do me a favor, share it with the friend that wants to go to another level. Make sure you like the video, comment below so I know who you are, set your notifications, and then subscribe to the channel. We got daily sales training videos dropping. I'll see you soon.
So today I want to talk about what I consider the most, I don't know, hated industry in our country. Maybe the most hated industry in history. An industry that throughout the last 2,000 years has been blamed for every crisis, every problem, every economic disaster. It's always their fault. And it's not just the industry, it's the practitioners themselves have been demonized time and time again in our media, in our literature, in our songs, in our plays, in our movies, certainly in our movies. You know, Shakespeare wrote one of his most famous plays, The Merchant of Venice, on Shylock, the moneylender. I'm talking about finance. I'm talking about financiers. Everywhere you look, finance is denounced. Finance, oh, these Wall Street guys, they're just greedy. They're just, you know, they'll commit fraud in a second, and they cause every financial disaster we had, whether it was the Great Depression, the 2008 financial crisis, or whether it was, you know, they were thrown out of the temple by Jesus after all. For 2,000 years, since Jesus threw them out of the temple, we have blamed every financial crisis on financiers. Is that just? Is that right? How should we approach the whole area of finance? How should we judge whether finance is this evil industry? Because we've evaluated basically as evil. We regulate it. We regulate it extensively. Every aspect of banking, every aspect of investment banking, every aspect of finance today is controlled and regulated by the government. We don't trust them. We believe that if we left them alone, they would bring about disasters. They would cause major crises, and they would destroy life as we know it. You know, somebody did a survey a few years ago. Might have been quite a while ago, but I think it still holds. About who commits the most murders on television. Who commits the most murders on television? And the result is overwhelming. Almost 50% of all the murders on television and our TV shows are committed by businessmen. And a significant percentage of those happen to be in the area of finance. We don't trust business, but we certainly don't trust finance. As I mentioned, Shylock is one of the most famous villains in theater. Dante, I don't know if you've ever read Dante's Inferno, but the moneylender, the banker, is like on the seventh rung of hell. He's got a bag of money around his neck, and the bag is being drawn downwards towards the fire, dragging him into the deepest pit of hell. These are horrible, evil people. And we need to control them. We need to tell them what loans to give out. We need to tell them how much interest to charge. We need to tell them, you know, what kind of products to sell and what they can and cannot do. We need to have say into every single part of how they do their paperwork. And, you know, this is what we have today. We have an unbelievably regulated, controlled industry. And yet, if you think about it, if you think about the value of this industry, the value to human success, the value to human flourishing, the value to our ability to live our lives, in almost every dimension, finance, financiers, financial institutions, financial markets are crucial, essential for our ability to live well. And I don't know about you, but my standard of the good is individual human flourishing. Does this thing, in this case, does this industry promote human success, promote the creation of wealth, promote flourishing, living well, living as a human being well? And when you look at finance, everywhere you look, in every quarter that you look. What you see is finance helping start businesses, whether it's through venture capital or through banking. Finance helping grow businesses, whether it's through debt or through bank loans or through allowing companies to go public or buying and selling their shares. Financiers and bankers allowing us to buy homes we couldn't otherwise afford until we accumulated enough cash, which would take us 20, 30 years. But because of mortgages, we can now buy homes that we can afford over time, and allowing us to do what I call consumption smoothing, buying stuff today that we will pay for tomorrow, credit cards. And we don't have to store all our cash, under the mattress in a safe in our home. We can have it at the bank and conveniently use credit cards and checks, if anybody still uses checks. Now, electronically, we can transfer money. We buy our cars with debt provided us from bankers. Every aspect of our lives, our business lives, our personal lives, lives as producers, lives as consumers, every aspect is made possible by the existence of these financial institutions, these financial markets, and these financiers that we so love to hate. So what's going on? What's going on? Is my assessment of the value that financiers create in our lives right? What am I missing? Are these guys really the bad guys? That our TV series, that our movies, that our literature, that our, drama, poetry portray them to be? Is this really true? Which one makes sense? Because you can't have them both. You can't have contradictions. I mean, I used to be a finance professor, so I know a little bit about this topic. And I used to teach a class called Finance and Ethics. And people used to look at me and say, wait a minute, that's a contradiction of terms. You can't have finance and ethics. Really? Really? We think that lowly of this profession that makes all the wealth we have around us possible? To the extent that we don't believe it's compatible with ethics? Well, it's true. It's not compatible with a certain type of ethics. We're going to talk about that. Okay? And I used to ask my students, this was their first and most difficult homework assignment. I used to ask them to go find a movie or a book or a novel where the hero in the movie or the novel was a financier. Not just any financier. Not some loser financier. But a successful financier. A financier who'd made a lot of money by being a financier. By working in this profession. Made a lot of money, being successful, and portrayed in the movie positively. Or in the book. Now, this was the hardest homework assignment I gave these kids. They didn't know what to do with it. Because it's hard to find anything. I'll give you an example of one or two where it's positive, and I'll give you some examples of negatives. But, they really went out
1 minute.
And they really couldn't find anything that portrayed financiers. Now, you could find loser financiers who feel bad about all the money they made and then become good guys. You can find loser bankers like the hero in It's a Wonderful Life who runs a failed bank and is therefore the hero of the movie. But the successful banker in It's a Wonderful Life is a creep.
30.
Is a really, really bad guy. Is somebody we love to hate. So you think about a movie or a play or a TV series or anything, any work of art, any work of fiction that portrays bankers positively. All right, when we get back,
10,
we'll talk about why that
9,
is and
8,
what the value of finance
7,
really is. You're
6,
listening to Ron Book Show.
5,
We'll be right back
4,
after this.
3.
So today we're talking about finance. Everybody's going, we don't like those guys. And I actually am excited by the fact that I've got a book coming out about exactly this topic. And the book's out now. You can pre-order it on Amazon. It'll be out. It'll be shipping in a few days. It's called In Pursuit of Wealth: The Moral Case for Finance. In Pursuit of Wealth: The Moral Case for Finance. Go to Amazon. You can get it on Amazon, and it'd be great if you purchased it. And maybe when I come to your town and give a public talk, I'd be happy to sign it for you. But it's also going to be available on the Kindle. And I know can't really sign Kindles or iPads and stuff like that. But I think you'll find the book interesting. There's no other book like it. Nobody else out there will actually go out to defend finance, not just a economic defense of finance, not only an explanation of how finance benefits us all economically, but an actual moral defense. Why being a financier is a noble profession. Wow, that's a pretty strong statement. Why Wall Street? Wall Street has problems. We'll get to that. But why Wall Street is always vilified, unjustifiably, for every problem, every crisis we ever have in this country. And really, this is to a large extent a global phenomenon, but more intensely felt here in the United States. And why we could not have the world we live in. We could not have the world we live in. And I'm talking about all the good things in the world we live in, because we could have all the bad stuff. We could not have all the good things that we live in, whether it's your iPhone or the nice home you live in or the computer you're using or anything, the furniture you have, the car that you're driving, without robust, healthy, functioning financial markets. And yet, these guys are vilified. So I was talking about It's a Wonderful Life. Think about that movie. You've probably all seen it. It's a classic Christmas movie. I consider it one of the most anti-American movies ever made, one of the most anti-capitalist movie ever made, and certainly one of the most anti-finance movies ever made. Because the hero of the movie is a failed banker. He's a banker with a golden heart, which makes him a failed banker, because he won't foreclose on people who won't pay back their loans. So he's subsidizing failure. And he drives his bank into bankruptcy, basically, which is going to hurt his customers. It doesn't help to lose money. Now, we sympathize with him. We like him because our culture has a very weird view of profit. We resent profit. We dislike profit. And if nobility is associated with not making money, right? The best people in the world, we think, are people who work for nonprofits. So here's a loser, not making money, losing money, but still helping people. That's how he got into trouble. That's how he lost money. He's obviously a good guy. We love him. Across town, there's a banker who's been very successful, made a lot of money. Why? Because he actually thinks about what kind of loans he issues. He only gives it to people who can pay him back, or he thinks he can pay him back. And when they can't pay him back, he actually forecloses on. He does what an owner of the bank is supposed to do. He actually runs his business as a business and makes money and makes a profit. We'll get back to him in a second and show why it's so essential that he does that and why that's actually virtuous. Now, the movie makes him out to be a scoundrel and he's a lying and a cheater and he steals and everything. But to make the point that if you're a successful banker, you're a lying, cheating, stealing SOB. It's the loser, banker with a heart, who is the good guy, who is the nice guy. That's It's a Wonderful World, but you see this pattern repeated over and over and over again. Now, why is making a profit virtuous in the mortgage business? Let's take the mortgage business for a second, right? Why was it a good thing that, I forget the guy's name, I forget the name of the villain in It's a Wonderful Life. You get to a point where memory is the first thing to go. But what is it that makes profit in that context actually virtuous? Right? Because we think of it in terms of, wait a minute, he's foreclosing on people. Yeah. People who have a loan, who've signed a contract, and who now, for whatever reason, fault of their own or not, or accident, or just bad luck, cannot pay it back. But who does he have a fiduciary responsibility to? To people who deposited money in the bank. People have opened saving accounts in the bank. They've given the bank money under the assumption that that money would be lent out and make a profit. And that profit would partially pay to give them interest on their saving account. So people are saving with the expectation of getting a return. That return is generated from the return the bank gets on the loans that it makes, on the mortgages that it makes. If the bank stops taking in the return on the mortgages, it can't pay you interest on your saving account. Who loses? You lose. It might not even be able to pay you your principal back if the person they lent the money to can't repay it. And if you don't foreclosure means you take over the house and you sell it, how are you going to get the principal back to pay the savers? So you're basically, this goody shoe-shoes banker, is basically sacrificing his depositors, sacrificing savers for the sake of people who can't pay back their mortgage. It's a contractual violation. It's a violation as a fiduciary duty. It's a disaster. Now, making money off the mortgages is what makes it possible for the banker to pay you interest on your saving. That's a good thing. And those saving, the fact that you're willing to save, is what creates the mortgage market. But if you start having bankers all over the place not foreclosing, letting the banks basically not be able to pay back savers, in a sense, driving their banks bankrupt, then not only do the savers lose, but mortgages in the future lose. The whole industry gets wiped out. And how do you fund your next home? Most of us don't spend our whole life putting money aside and then buying a home for cash. Luckily, there is a whole industry dedicated to the fact, to making it possible for us to actually purchase a home before we have enough cash to buy it. That's what a mortgage is. Wow. It raises our standard of living dramatically. When you can buy a home that you're only going to be able to accumulate enough money to purchase years from now. And by giving you a mortgage, making it possible for you to live in a nicer, bigger home than you could ever imagine. That's terrific. It's fantastic. And if you end up making more money than you expected, you can sell the home, pay back the mortgage, and get a mortgage on a bigger, nicer home. And if it turns out things are not so good, you can sell the home, pay back the mortgage, and buy a smaller home. Wow. The flexibility. I mean, the way in which this simple little thing, this simple little financial product, this simple little financial institution called a mortgage bank has made your life better, every one of our lives better, by making it possible for us to buy and sell
1 minute.
homes, for us to live in homes without having to worry about, putting the money aside. In the meantime, what are you doing? You're renting, or you're living in a crummy home when you really want to live in a nice home. I love mortgages. I love debt generally. If you do it responsibly, if you use it responsibly, which a lot of people don't, but if you use it responsibly, it's incredibly life enhancing. You can buy stuff and
30.
pay for it later. You have to be responsible, not to buy too much stuff that you can't afford to pay. But it's truly a beautiful thing. Think of your mortgage, think of your car loan, think of your other loans. All right. So, in It's a Wonderful Life, the villain is actually the good
10,
guy. And the good
9,
guy is actually the villain.
8,
All right.
7.
You're listening to
6,
the Ron Brooks Show. We're talking
5,
about finance, the
4,
morality of it,
3,
and we'll be back
2,
after this
1.
break. All right, today we're talking about finance. We're talking about my new book, In Pursuit of Wealth, The Moral Case for Finance. It's co-authored with Don Watkins, who This is our third book together. If you haven't got the first two books, you should go out and get them. Free Market Revolution is our first book, came out in 2012. And then in 2016, we had Equal is Unfair. Equal is Unfair and Free Market Revolution. And now, In Pursuit of Wealth, the Moral Case for Finance. So get your Yaron Brook and Don Watkins collection of books. The Goodreads, I think you'll enjoy. I think you'll enjoy it, and of course, I might even offer to if you mail me the book, I'll sign it and mail you back to you. So, or if I come to your town and give a talk, happy to sign the book. But I think you'll enjoy it. I think if you like the show, if you like listening to the show, I think you'll enjoy the book. It's a book of essays, the In Pursuit of Wealth, a book of essays that covers a variety of different issues related to the field of finance. Anything from some of what I'm talking about today, kind of the moral case for finance. So breaking that up into two aspects of it. One is how finance contributes to human flourishing, how finance makes possible the ability of individuals to go out there and make their lives better and flourish and pursue happiness. Also, why it is that financiers are doing something inherently self-interested, rationally self-interested, and to me, that is what morality ultimately is. It's the pursuit of your own rational, long-term self-interest, making your life the best life that it can be, living a flourishing, successful life. So the book has a chapter really just delving into that, into the productive nature of finance. It also does a bit of the history of finance. Why have we hated bankers so long? Some examples of that hatred, some examples of the things they have made possible during that history, and how without financial institutions, we wouldn't have had all the economic progress we've had over the last 400 or 500 years, and certainly not over the last 200 years. We'll also talk about the fact that it's heavily regulated in the book, and we'll talk about greed. We'll talk about Wall Street greed. Good, bad, neutral. There's a chapter. And then there's a bunch of chapters, some about inequality as related to banking, some about luck. Oh, bankers, they're just lucky. Some about, bad stuff that happens, and we'll talk about CEO pay, and is it bad? We'll talk about, other issues that relate to specifics like insider trading. We talk about hedge funds. And it's an exciting book. It's and I encourage you all to buy it. It's called In Pursuit of Wealth: The Moral Case for Finance, and you can get it on Amazon as we speak, and in the weeks to come. All right, so and there's a long epilogue in the book, which is just an interview with me covering all kinds of issues and all kinds of questions that come up. What is a hedge fund? Why, what is it that hedge funds do that is even mildly productive? There's a chapter on central banking and central bankers, and so on. We'll talk a little bit about central banking in a little while. So a lot of information. Even if you think you know a lot about finance, I think you'll gain something from reading this book. So we discussed a little bit how finance, banking, mortgages, debt financing for us individuals makes our life easier. And the flip side of that is that as savers, it makes our life easier. We can actually now, because of banks, because of financial institutions, because of the industry, I can now put money aside for retirement. Now, I know some of you are saying, well, I don't need to do that. I got Social Security. Well, you don't want to live off Social Security. First of all, it's not a lot. Secondly, it might not exist, particularly if you're young. Social Security is going bankrupt. We'll do a show on Social Security, but Social Security is going bankrupt. So if you're in your 20s or 30s, certainly if you're in your teens, I wouldn't count on it. Put some money aside, save. And it's not just that you put money aside and it just sits there. I put $10 and then put another $10. Now I have $20. No, you put $10 in and it earns interest. Now, I know interest rates are pretty low right now, but returns in the stock market have been pretty good the last few years. And there have been periods in the past where interest rates have been higher. And when you think about the compounding of those returns over many years, your money grows. If you do the math, it's pretty amazing. And I'm not in the business of giving you financial advice or doing self-help in finance, although I know there's a big industry of that and I could probably make some money doing that. But let me give you this advice anyway. Save, save, save. It's the most important thing you'll do for yourself if you're a long-term thinker, and I think we should all be long-term thinkers. There are going to be emergencies. And you don't want to rely on the government for help for emergencies. You don't want to rely on your family for help for emergencies. If you save, if you build a little nest egg or whatever you want to call it, an emergency fund, you can take care of yourself in those emergencies. Retirement. You don't want to count on Social Security. You certainly don't want to count on your kids. Your kids are not going to fund you when you're old, right? That's how we used to do it 300 years ago. The kids would take care of you. No, you put money aside, you save it, and then you can spend it once you stop working, once you stop making a living for yourself. Save, save, save. You want to buy a nicer computer. You want to buy a nicer home. You want to buy a nicer automobile. Save, save, save. Saving is the way to do it. We focus so much on consumption, on buying stuff. And our economists, really, really bad economists in my view, keep telling us, the economy is driven by consumption. No, it's not. No, it's not. Economic growth ultimately is driven by saving. It's driven by production, by building stuff, creating stuff, making a profit, or making income and spending only part of it, and then keeping the rest and investing in. It's the investment that allows factories to grow. It's the investment that allows startups to be created. It's the investment that creates the future jobs that are going to be created in the future. And investment is just a flip side of saving. You save by giving it to the bank or giving it to a hedge fund or giving it to a pension plan, and they invest the money so that they can give you a return on your saving, so that you can one day buy that nicer car, that house you've dreamt of, or just retire in much better condition than if you had to rely totally 100% on Social Security. So what really drives an economy is saving. Now, you shouldn't say because it drives the economy. This is the beauty. The beauty is that if we all act as individuals in our own long-term self-interest, this is one example of that, the economy benefits. The economy benefits, to the extent that there is such a thing as the economy. Job creation in the future will benefit. New product creation in the future will benefit. So all you have to focus is what's good for you. What's good for you is to save and be diligent and disciplined about it. And by the way, you're also helping the economy. Not why you should do it. You should do it for yourself.
10.
All right. We'll be back in after this break. We'll be talking more about the morality
5,
of finance. You're listening
3,
to Ron Book Show on the
2,
Blaze Radio Network.
1.
All right, today we're talking about my new book. My new book, In Pursuit of Wealth, The Moral Case for Finance, co-authored with Don Watkins. And we talked about savings, and we've talked about investment a little bit, and we talked a lot about kind of using debt to fund some consumption. All good things, all wonderful things. And this is great. And if you think about how banking really started, I don't know if you know the history, banking really started by people wanting to be able to store money. Money in those days was real money. None of this paper stuff that anybody can print anytime and just create out of thin air. Money was gold or silver, mostly gold. It was real. And you had to carry out all your gold, and you had to bury it in the ground, and it got difficult, and it got cumbersome, and it got risky. People could steal it from you, and there was no way to get recourse. How do you identify your gold versus somebody else's gold? So people started taking the gold that they had made, the gold that they had saved maybe, hoarded, and putting it storing at the goldsmith. And the goldsmith would give you a little certificate, a little piece of paper saying, I owe you X amount of gold. Right? And you would have the certificate. And somebody at some point, probably accidentally, had the certificate and wanted to buy something and needed to use the certificate to go run to the bank, in a sense, to the guy who was storing all the gold and get gold to buy the stuff. And he said, you know what, let me ask the guy if I could use this piece of paper instead. And the guy said, yeah, I'll take the piece of paper. The guy took the piece of paper, right? The piece of paper said that this goldsmith owes X amount of gold. And that was the beginning of paper money with these IOUs. And it turned out that you could circulate these IOUs, and once in a while people would go and withdraw their gold, but mostly they kept the gold in the vault, and all that was needed was circulating the IOUs, these pieces of paper. Call it paper money. But every piece of paper was backed by gold in the vault. And, this is how money came into being, modern money, how paper money came into being. Basically came into being with these deposit receipts, right? IOU deposit receipts. And these deposit receipts became the money that was being used. Again, finance made life easier by, instead of lugging around bags of gold or bars of gold, which are heavy, cumbersome, dangerous, risky, all you had to now carry were pieces of paper. Walk around with pieces of paper. Right? So even just at the very basic level of a payment system, of our ability to pay for stuff, to buy stuff, or to take that money and invest it, which is what the goldsmith discovered. They had all this gold, right? And it was just sitting there. And then they figured out, okay, not that many people come and take the gold out. The deposit slips are just being transacted independently. We can take the gold and issue more deposit slips and give people loans. And now you got modern banking. All of this was kind of created out of the marketplace. All of it created out of the marketplace in order to make a profit. But the only way to make a profit in any industry, but certainly in the financial industry, the only way to make a profit is by providing a service that people want at a price they're willing to pay, which exceeds your costs of delivering it. So you cannot make money without making other people better off. You cannot make a profit without providing a service that people really desire and are willing to pay for. Now, you can short-term steal, lie, and cheat, but putting aside fraud, lying, stealing, cheating, all of that, profit is a reflection of how much value you have created for other people, the people who trade with you, the people who are transacting with you. Profit is this amazing, wonderful thing. And people who make a lot of money, a lot of profit, do it because they provided huge amount of value. They made people's lives better. This was just, by the way. So let me just say, at every point in financial history, from those early goldsmiths to the creation of money, paper money for the first time, to the building up of whole banking networks that made investments, to the complexity of the financial industry today, at every one of those steps, value was being created. Lives were being made better. At every one of those steps, financiers could only make a profit by trading with people around them, by providing services to people around them, services that those people really, really desired and were willing to pay for. And by the way, at every one of those steps, financiers were being demonized, were being often criminalized, sometimes burnt at the stake, sometimes put in jail, but generally victimized. I mean, never, historically, until this book, really, have never receive the kind of credit, the economic credit, the moral credit, most importantly, the moral credit for making the world a better place, for filling our world with wonderful, wonderful products and goods and everything. Again, everything is being touched by finance. You can't build a hospital without finance. You can't build a school without bonds that are financed by somebody, without a banker in the middle. At every point, everything that we do in life,
1 minute.
these people touch. And again, we vilify them, we harass them, we condemn them, we prosecute them, we put them in jail, often put them in jail. Frustrating. So, and yet, here they are. They've created this immense value. And they keep creating the value because there's money to be made. They're doing it for self-interested reasons. They're doing it in order to make a profit.
30.
Yay for profit. Yay for self-interest. If what self-interest and profit do is improve my world, if they enhance human flourishing, then I am all for that. All right. You are listening to your own book show on the Blaze Radio Network. That was hour number 1.
10.
We will be back to discuss more about finance when we come back. All right. You are listening to your own book show. We're talking today about my new book, In Pursuit of Wealth, with Don Watkins, my co-author. This is our third book together. In Pursuit of Wealth, the moral case for finance. I know some people's heads are spinning. How can finance be moral? Finance is all about the pursuit of profit. And yeah, the pursuit of profit is moral. The pursuit of profit is good. The pursuit of profit is what leads to all of the successes we have in the material world around us. So don't slam profit. Profit is good. Profit is moral. Profit is virtuous. The pursuit of profit is good. It's when people start lying, stealing, cheating, committing fraud. But we've always had laws against fraud. We don't need new laws against fraud. Bernie Madoff is not self-interested. Bernie Madoff is just a creep. Bernie Madoff is the guy who had that pyramid scheme and basically stole $50-something billion from people. He didn't really even steal it for himself. He just defrauded people. The huge pyramid scheme. It's all wasted. Most of it was gone. A lot of it was returned to people. But the guy's a massive crook. But he's not a financier. He's a fraudster. You don't blame the whole field of finance for the actions of one fraudster, which is what he was. All right. But people are bewildered, right? Okay, so they get saving, and they get the creation of money, and they get maybe some loans, mortgages, some business loans. But it can be what is the productive function of a stock market? How's a stock market productive? How does it add to my life? I don't own any stocks. So how does my life benefit from the existence of a stock market? Well, I mean, you wouldn't have the computer you have on your desk. You wouldn't have the car that you're driving. You wouldn't have most of the products, particularly the more expensive ones, but also the cheaper ones. There would be no Procter & Gamble. There wouldn't be no Johnson & Johnson, all the big consumer goods companies where you buy your toilet paper and stuff like that without a stock market. A stock market is what makes it possible for companies to raise vast amounts of capital so that they can go out there and build substantial companies. And I know people say, oh, big business, we hate big business. But the fact is, the most of the good stuff we have is built by big business. And the most, if not all, small businesses want to be big businesses. And they will be big businesses if they succeed. They stay small businesses if they fail. But success means growth. Success means growth. It really does. So a small business, if it's going to be successful, it's going to become a big business. So I love big businesses. And think about all the goods and services that you get on a daily basis, that you benefit from, at prices that if you actually thought about how much it takes to make this thing unbelievably cheap. And we get them easily, efficiently, quickly. Think about all the stuff you buy from Amazon. Amazon couldn't have built those warehouses, the infrastructure, the logistics, the variety of products without the capital that it raised when it went public, when it joined the stock market. The stock market is essential for raising large quantities of capital, a lot of money, so you can build plant, equipment, logistics, warehouses, and hire people. Hire people. Right? I mean, nobody goes to work saying, that's okay, I don't need to be paid. If the company makes money, I'll take a percent. Maybe some small businesses function that way. But how many people would actually join an auto company if that were the case? How many people would actually join a biotech company where it takes 10 years before any profit is seen? No. Capital is raised, salaries are paid, and if the company turns profitable, and if there's money left over after all the debts and everything else is paid off, then the shareholders make some money. Hopefully that's a lot. But they're the ones taking all the risk. So stock market facilitates raising large quantities of capital so that people can be employed, so that we can buy factories and machinery or warehouses and logistics in Amazon's case, or software, servers and everything else. You can have a thriving, successful economy. You can have a thriving, successful economy that creates jobs unless you have a thriving, successful stock market. And indeed, the fact that since Sarbanes-Oxley was passed, Sarbanes-Oxley was a law passed in 2002 by Bush and a Republican House and a Republican Senate. It passed the Senate 98-0. One of the worst pieces of legislation in American history. Passed the Senate 98-0. Not one conservative voted against it. It's probably cost the U.S. economy. I hate these kind of measures because you can't really tell. They always underestimate. But the estimates of economists are somewhere between $1 to $1.5 trillion. Trillion, that's with a T. Made the stock market a lot less efficient because it made it very expensive to go public. So a lot of companies are not going public. The number of IPOs, initial public offerings, has collapsed, gone down dramatically since 2002. Hurt the U.S. economy. One of the reasons we have slow growth today, because we don't have enough companies going public and growing fast, using those vast quantities of capital. And this has been going on for 15 years now. You'd think a Trump administration, Republican House and Senate would do away with something like that. Oh, no. No. God forbid we should actually get rid of any regulations, even as Republicans, right? Without a stock market, without a thriving IPO market, without that kind of growth, without that kind of investment, without that kind of investment in capital, the economy is not going to grow very fast, and you, as an individual, are going to suffer. It hurts you, every one of us. Not only because our jobs might not be as productive as they could be, but because our neighbors, our friends, our family members are not as productive, but also because the economy is growing less. That means less innovation. That means less new products. It means less cheaper products. It means a lower standard of living than we could have otherwise as an individual. It means job opportunities that we never had, that we can only imagine. And yet nobody cares. Nobody cares. We continue to vilify financial markets. Janet Yellen just a few weeks ago came out and said, oh, we can't do it with regulations. Don't do it with regulations because it's regulations that will save us from the next financial crisis, because it was lack of regulation that caused the financial crisis. Well, we're going to talk about that after the next break, about where the financial, or maybe actually the second half of the show today, but we're going to talk about whether the financial crisis was caused by too little regulation. That's a bizarre, surrealistic claim. But that's what she holds. But my point is, stock markets, even though we want to regulate and control them because we don't get it, are incredibly valuable. But here's another way in which they're valuable people don't think about. When people trade in the stock market, they give a price to a particular stock. What that price reflects is the value of that company. And what that value reflects is what the market, what people in the market estimate to be its future cash flows. How profitable this company will be in the future. Talking here about economic profit. How profitable would we be in the future? It's saying this is a successful company, stock price declining, that's an unsuccessful company. To the extent that the market is right, and the market is very good at getting this stuff right, that is unbelievably important information to other participants in the market, often to the companies themselves. They don't know that their company or their industry is dying. Imagine when the automobiles were first produced, you were in the buggy industry. You might have not known your industry was dying until you saw the stock price go down. And then you looked up and you started looking around and discovered there was an automobile industry. So what the stock market does is it helps allocate those resources towards the next big thing, automobiles, away from the dead, dying thing, buggies. It's a beautiful thing to allocate capital on a grand economy-wide scale to its best and most productive uses.
5.
You're listening to Ron Book Show
3,
on the Blaze Radio
2,
Network.
1.
All right, today we're discussing financial markets and the morality of finance. And the last segment I talked about the stock market. I want to reiterate this. One of the things the stock market does, and really all financial markets and institutions do, is they allocate capital across the economy. They choose winners and losers. They decide which industries are going to thrive and which industries are going to die. And how do they do that? What's the basis by which they do that? They do it based on what they think is going to be profitable and what they think is going to lose money in the future. Now, how do you make money in industry? By providing goods and services to customers. By creating new things that customers are going to want. You want those industries to grow. When do you lose money in business? When you're not providing services to your customers. When your customers are not willing to pay for the service and the product that you are offering them. In other words, when you're a drag, when you're not adding value, when you're not contributing to success, to growth, to human flourishing. So financial markets allocate capital to industries and companies that are going to or are already and are going to in the future, because finance is primarily focused on the future. They're providing capital to industries and companies that are going to provide for human flourishing. And they're taking money away. They're driving the stock price down. They're not lending money to industries that are destroying or not providing for human flourishing. They're taking money away from buggies, which nobody's going to want because everybody's going to shift to automobiles, and giving it to automobiles. During the 1980s in the United States, we were shutting down a lot of what's called the Rust Belt. And the reason was that American business was not competitive anymore in a lot of the heavy manufacturing. Other people could do it better. And what you saw is people coming in, selling off a lot of those assets, shutting them down, firing people, laying people off, and taking that capital and putting it into the future. A lot of capital, huge quantities of money flowed from the Rust Belt to Silicon Valley. This is the era where Apple was created, Microsoft was created and built up, IBM shifted completely, where all the personal computer industry and ultimately the internet industry were all built. That took a lot of money. Where did that money come from? To a large extent, it came from shutting down the old industries that were not worth that much anymore. Shutting down the industries that were not providing a value, not providing a service, or where you could get the value, you could get that service cheaper, better somewhere else. And yes, people lost their jobs. And they had to get retrained. But you know what happened to their kids? Their kids didn't go into the steel business. Their kids didn't go into old manufacturing. Their kids figured it out. And they went to Silicon Valley and got in computer engineering jobs, programming jobs. There are millions of jobs today that have to do with computers and games and technology generally that didn't exist 30 years ago. Those jobs were created because our economy was free enough, was flexible enough to reallocate capital from losing industries to winning industries. And we demonize that. We demonize that. We think that's horrible. But that's wrong. That's how economic progress happens. That's what makes human flourishing possible. It's not holding on to that buggy plant or to that, I don't know, steel business. It's not profitable anymore. You got to take your capital and put it into something that is profitable, because that profit, again, represents value creation, making people's lives better, human flourishing. And that's what happened during the 1980s. People ask me, that in the 1970s, if you go back to the 1970s, the U.S. economy was struggling. U.S. businesses were struggling badly. We had massive conglomerates, inefficient, unproductive. We couldn't compete with the Japanese. We couldn't compete with anybody. We had inflation in the U.S. We had stagflation. Unemployment was 13, 14, 15%. And inflation was 15%. It was a terrible time. And then by the time we got to the 90s, we suddenly had low inflation. We had an incredibly robust, lean, efficient, productive businesses in America, hiring like crazy. Economic growth had accelerated. From the 70s to the 90s, how did that happen? In the 80s, what happened? What happened in the 80s is we had the restructuring of America. We had financiers like Michael Milken, like Carl Icahn, like the hostile takeover artists go into companies and restructure them, sell losing assets in order to invest in winning assets, move capital from poor uses to excellent uses, and therefore, yes, create unemployment in a sense of firing people, but unemployment during the 80s plummeted. It went down dramatically. Why? Because when you allocate capital efficiently, more jobs are created than are being destroyed. So more opportunities are created, more opportunities to build, to create, to make stuff, to flourish, to succeed. So people used to ask me in the 90s when I was a finance professor, used to say, who's responsible for the good economy we have? Is it Bill Clinton? Is it Alan Greenspan, the chairman of the Federal Reserve? And I said, no. It's never a politician, and it certainly is not a central banker. What made the 1990s, what made American industry lean and efficient and successful and growing, what made Silicon Valley, but what made all of American companies so successful were people like Mike Milken. That's who made America great again. And that's the only thing that can make America great again is to free up businessmen, and most importantly, of all businessmen, is to free up financial markets so they can more efficiently allocate capital, more efficiently kill off losing businesses, losing industries, and fertilize growth industries, the future industries. This is exactly what happened in the 80s. Shut down the Rust Belt, grew Silicon Valley, and not just Silicon Valley, but all the places around the country where technology and technology companies have thrived, and the people who support technology companies have thrived. It was all made possible because of this obscure thing called reallocation of capital, which financiers and the private equity and the hedge fund business in the stock market make possible. And having the stock price reflect the real value of the company is incredibly important so that the rest of the market knows where to allocate capital to. It's an incredibly powerful tool of valuation and a value of something. The financial value of something reflects its future potential, reflects its potential to be successful or not in the future. A stock price that's going down means that that company's prospects for the future are declining. A stock price going up means that the company prospects for the future are getting better. We want stock prices to be reflective of that information. To do that, we need a free market in finance. We need financiers who are incentivized and motivated.
1 minute.
To buy and sell, to invest, but also to short. Shorting is a form of selling stocks, so that whatever they think about the future of these companies, that they do the research and discover new information, and discover new facts about them, can be reflected in the price and make the markets more efficient, and therefore make the allocation of capital more efficient, which leads to more jobs, more economic
30.
growth, new industries, and the kind of human flourishing that the world makes possible. All right, we're talking today about my new book, In Pursuit of Wealth, with my co-author Don Watkins. It's available on Amazon and everywhere else. The
10.
Mall Case for Finance. And we'll be right back to talk more
5.
after this break.
4.
All right, we're talking today about the Mall Case for Finance. And I've been giving you a bunch of different arguments about how productive financial markets are and so on, and how they allocate capital and why that's all a good thing. I want to talk a little bit about a different aspect of finance now. And then I want to talk about the financial crisis, the Great Depression, and all the things blamed on finance. And we're not going to be able to cover everything today. I mean, after all, I have a 6-hour course that I did years ago about the financial crisis, where I analyzed the financial crisis from A to Z. 6 hours it took me, so we're not going to be able to do it in a few minutes that we have left on the show. But in the book, we cover a lot of this. So again, I encourage you to go out and buy the book, In Pursuit of Wealth, The Mall Case for Finance, with me, Yaron Brook, and Don Watkins, my co-author. The other aspect of finance is its ability to reduce risk, or to allow us to control risk. In a sense, to take on only the risks that we want to take on. Now, this is somewhat hard stuff. It's complicated, and this is why people get so confused about this, and I think why people are scared of it, and why people want the government to come in and help them because they're scared. This is the whole area of derivatives, options and futures, and collateralized debt obligations, and credit default swaps, and on and on and on it goes, the kind of different types of derivatives they are. But I'm here to tell you they're not that complicated, and they're all good. They basically serve one purpose, these derivatives, and that is to protect, to cover the downside. All of these derivatives, in one way or another, are forms of insurance. Just like you and me, we all buy life insurance or property insurance, or if flood insurance, fire insurance, in order to protect the downside, and we hope we'll never need them. Derivatives are the same thing. Derivatives are a way to protect us from downside. Now, for most of us, insurance is enough. Insurance covers the kind of risks that our house will flood or be destroyed by a tornado or something like that. Hopefully that doesn't happen to any of us, but we know what that risk is, and we can go, and there's a whole business called insurance that covers that risk. Now, notice insurance is a financial industry. It's a financial industry whose responsibility is to help you protect yourself from risk. And there are all these insurance products. We buy health insurance and life insurance and property insurance and all this stuff. And now notice, again, from the financial perspective, all these insurance companies have to make money on the premiums that you send them in order to be able to finance you when something bad happens. And the way they make money is by investing that money. And thus, by investing the money, they're adding to production, because they are financing new plants and equipment and new jobs and new industries. That's what insurance companies do with the money. It might be in bonds, it might be in stocks, but they are investing. Even, in some cases, they can even invest in hedge funds. So the insurance business is a great financial business, important financial business, crucial financial business that protects individuals and businesses from a certain type of risk. But there are other types of risk that are harder, that you can't use straight insurance kind of products. And that's what derivatives were created for. And the simplest derivative to imagine or to explain is a futures contract on, let's say, a barrel of oil. So an oil refinery produces barrels of oil, but the price fluctuates a lot, from $100 a barrel to 50 to 20 even, back up to 100. It goes up and down. And what the producer would like to do is cap that price. It's going to be producing oil over the next year, but it doesn't know the price at which it can sell a barrel in a year. But let's say it wants to make an investment, and it would like to know how much oil, at what price it can sell oil in the future. It can sell a future. It can, in a sense, ask somebody to guarantee the price. So I come along and I say, you know what? I'm willing to pay you $80 in a year for any oil you produce. And I'm taking the risk that the price might drop to 50, but there's also the possibility it might go up to 120. So I'm basically betting that the price is going to go up, and the oil refinery is betting that the price will go down. And we're both coming together, mutually agreeable, and agreeing on 80. I protected the risk of the price going up. Let's say, I own a fleet of trucks, and I'm worried about oil prices going up. So I've just locked in a price for oil. I can now price all my deliveries based on this price that I've locked in. And the oil company has locked in a price that they know they can sell it at. So if the price goes down, then I'm worried. Both of us are happy. What's interesting is that if the oil price goes to 20 and I bought the oil for 80, I'm going to feel like I was screwed, even though I wasn't. If the price goes to 120 and the oil company locked in a price of 80, they're going to feel like they were screwed. But you know what? They're adults. And they understand that what they really did was buy an insurance policy. And sometimes you buy an insurance policy and your house doesn't burn down. So you feel like you've wasted money. But no, what you bought is peace of mind. What you bought is certainty about the future. That's what derivatives allow companies to do. You can now swap loans, you can swap interest rates, you can do all kinds of fancy things, but the essential characteristic is you're locking in payments in the future. You know how much something will cost you in the future, so you don't have to worry about it. You're creating peace of mind. You're reducing risk. You're making business decisions more rational by using these products called derivatives. And generally what that does is it makes the economy more efficient. It makes the economy more productive, which means more jobs, which means better jobs because productivity is going up. Jobs are allocated to the right kind of industries. We don't have these wide, huge, good times and then crash bad times. Again, if the markets were free, we'll get to that in a minute. What causes financial crises? Which I'll have to do a whole show on because I'm only going to get a short segment to discuss. But that's okay. We'll do 7 minutes on boom and busts and why financiers are not at fault. So derivatives
1 minute.
Are not evil. They're good. We should celebrate derivatives. They make the economy more efficient. They make the economy more stable. And the more we regulate, the more we control them, as we'll see in a little bit, the less stable they will be. The less efficient the economy will be. So we want companies, finance companies, regular companies, we want them to be in a position to reduce their risk, make wiser investments.
30.
And again, that's all derivatives do. All derivatives do. Now, yes, they can be used for gambling, but the gamblers lose and the gamblers get wiped out, and what's left are the people who are using them to actually reduce risk and benefit enormously from them. All right. You're listening to the only defense of financiers you will ever hear on the radio,
10.
the Yaron Brook Show on the Blaze Radio Network. We'll be right back.
Bye.
All right, today we're talking about financial markets, financiers. Is finance moral? And I've argued it is, because it enhances human flourishing. It enhances individual human flourishing. And the people in finance are value creators. They make goods and services. They make products possible. They provide the financing that make it possible for us to live well, for companies to grow, for companies to start. There would be no Apple, there would be no Microsoft, there would be no Intel, there would be no Walmart without finance. None of the goods and services you have in the world around you without efficient, productive, good financial institutions and markets you wouldn't have. And if we hadn't regulated them, we would be so much richer. The products we had would be so much better. Oh no, Yaron, that's impossible. Unregulated financial markets, that's what caused the financial crisis. Really? That to me is one of the most bizarre statements ever. And I hear it all the time. And Janet Yellen, the head of the Federal Reserve, said this recently. It's the lack of regulation that created the crisis. We need more regulation to prevent it. That is just nuts to me. Because in 2007, before the financial crisis started in 2008. Finance, banking, Wall Street were the most regulated industry in America. Every aspect of finance was regulated. Everything they did, they needed to get permission. So, a financial crisis happened. How can you blame it on the lack of regulation where so much of what they did was regulated? I argue the exact opposite. I argue that in a fundamental sense, it was too much regulation. Indeed, regulation is what caused the financial crisis. Now I'm going to give you a quick outline of this. You want more? Buy my book, In Pursuit of Wealth, The Moral Case for Finance. It actually has a whole section on the financial crisis. The role the regulations played and the role the central bank played. And let me just quickly say this about central banking. Right? The number one product of finance is money. Money used to be private. Banks used to issue money based on the reserves that they had. You remember the story I told you earlier in the show about the goldsmiths. They would issue receipts which served as money to their customers. That used to be money. And then at some point in the United States in 1914, money was nationalized. Money was taken over by the government. And since then, the government decides how much money should be in the economy. Who should get it? Who should get it first? Who should get it last? The Federal Reserve is a government entity that monopolizes money. And it messes up constantly. It provided too little money, too little liquidity during the early 1930s and drove us, together with a few other factors, into a Great Depression. I know they still teach in high school that Wall Street caused the Great Depression, but it didn't. The Federal Reserve, along with a lot of bad decisions by Hoover and FDR, caused and sustained and perpetuated the Great Depression. Not perpetuated, sustained it for a long, long time. Could have been just a simple recession if they'd kept their hands off and if the Federal Reserve had behaved themselves and done the right thing. But it's hard to do the right thing when you're a central planner. Money should be private, but that's a big, big topic we'll get to another time. Same thing happened in the Great Recession of 2008. In 2002, the Federal Reserve lowered interest rates to below the rate of inflation. And it kept it there for 2.5 years. Now, when you have interest rates at below the rate of inflation, what are you doing? You're incentivizing people to take on debt, to borrow money like crazy. And we did, all of us. We all borrowed money like crazy because it was so cheap. It was insane not to borrow money. And we all borrowed money to buy one specific asset, housing. We took out all kinds of mortgages, and usually variable rate mortgages at a really low interest rate. You remember the days of 1% variable rate mortgages, 5% down, 10% down? If you were really, really conservative, 20% down, but mostly you could get 0% down on some mortgages. Why mortgages? Because the government was heavily incentivizing that. Freddie and Fannie, the government institutions, We're subsidizing those mortgages and encouraging us to invest in those mortgages. And our politicians were telling us we should buy homes. We have housing policy at the federal government. Housing policy that is geared towards maximizing the number of Americans who own their own house. Why is the government telling me whether I should buy or rent? Why is the government telling me what house I should buy? Why is the government intervening in the rate of mortgages and what kind of mortgages and how much down we should put down? Why not let the market do its job? The market would have never done it this way. Zero down mortgages, not a market phenomenon. Interest rates below the rate of inflation, not a market phenomenon. Giving mortgages out to people who no way can afford those mortgages, not a market phenomenon. But what was happening was the banks were doing that, then taking the mortgages and selling them to government entities, Freddie and Fannie. And then Wall Street started competing with Freddie and Fannie. And why did they do that? That's kind of stupid. Because there was money to be made. Yeah, but if you do something stupid and you're in business, you know, then ultimately you'll go bankrupt. Oh, wait a minute, but that doesn't apply to Wall Street banks. If Wall Street banks do stupid things, take a lot of risk, and make a lot of money, they get to keep all their money. But when they lose, when they go bankrupt, the government bails them out. It's called too big to fail. And now it's in our laws. Dodd-Frank institutionalizes too big to fail. So we have a system where banks are told, you're too big to fail, and we're going to bail you out if you get into trouble. Now, that's not free markets. That's not unregulated industry. That's a heavily regulated industry, heavily controlled, obviously heavily subsidized. Deposit insurance is a subsidy that banks get. And then we have to control them because we subsidize them, and we give them too big to fail. So then we have to watch everything that they do and make sure they don't take too much risk. And we regulate and regulate and regulate, and distort and pervert the incentives and make them do stupid things because we create incentives for them to do stupid things. And then we're shocked when they actually do the stupid things. That's what regulations do. That's what the Federal Reserve does. So what caused the financial crisis is
10
stupid regulations, a lot of them, not any one, lots of them, primarily
5,
regulations of housing and
3,
Freddie and Fannie
2,
and the whole
1.
gamut of housing policies that incentivize us all. I mean, the woman who cuts my hair bought 2 investment houses. I mean, that's insanity, but it was subsidized by the government, so why not? And then when she couldn't pay the mortgages on them, she just walked away with no penalty. All of that is insane. But that's government. And then the Federal Reserve, the people who control, have a monopoly over money, keeping interest rates way too low. But anyway, if you want to know more about the financial crisis and why it happened and why it was not a failure of capitalism, why it was not a failure of Wall Street, it was a failure of Washington, D.C. and government, read In Pursuit of Wealth, The Moral Case for Finance by myself and Don Watkins. It's available on Amazon. Go get your copy today. And keep on listening. This is the Ron Brooks Show on the Blaze Radio Network.
Right?
Cool.
Sounds good.
Thank you.
Of course.
I'll talk to you on Sunday.
Sounds good.
Okay. Bye.
Bye.
The Private Finance Initiative (PFI) is a way of creating public-private partnerships (PPPs) where private firms are contracted to complete and manage public projects. Developed initially by the governments of Australia and the United Kingdom, and used extensively there and in Spain, PFI and its variants have now been adopted in many countries as part of the wider program of privatization and financialization, and presented as a means for increasing accountability and efficiency for public spending. According to critics, PFI has been used simply to place a great amount of debt off balance sheet. PFI has been controversial in the UK. The National Audit Office felt in 2003 that it provided good value for money overall. However, in 2011 the Parliamentary Treasury Select Committee found that PFI should be brought on balance sheet. The Treasury should remove any perverse incentives unrelated to value for money by ensuring that PFI is not used to circumvent departmental budget limits. It should also ask the OBR to include PFI liabilities in future assessments of the fiscal rules. Overview. The Private Finance Initiative (PFI) is a procurement method which uses private sector investment in order to deliver public sector infrastructure and/or services according to a specification defined by the public sector. It is a subset of a broader procurement approach termed Public-Private Partnership (PPP), with the main defining characteristic being the use of project finance using private sector debt and equity, underwritten by the public in order to deliver the public services. Beyond developing the infrastructure and providing finance, private sector companies operate the public facilities, sometimes using former public sector staff who have had their employment contracts transferred to the private sector through the two-pay process, which applies to all staff in a company whose ownership changes. Mechanics. Contracts. A public sector authority signs a contract with a private sector consortium, technically known as a Special Purpose Vehicle (SPV). This consortium is typically formed for the specific purpose of providing the PFI. It is owned by a number of private sector investors, usually including a construction company and a service provider, and often a bank as well. The consortium's funding will be used to build the facility and to undertake maintenance and capital replacement during the life cycle of the contract. Once the contract is operational, the SPV may be used as a conduit for contract amendment discussions between the customer and the facility operator. SPVs often charge fees for this go-between service. PFI contracts are typically for 25 to 30 years depending on the type of project. Although contracts less than 20 years or more than 40 years exist, they are considerably less common. During the period of the contract, the consortium will provide certain services, which were previously provided by the public sector. The consortium is paid for the work over the course of the contract on a no service no fee performance basis. The public authority will design an output specification, which is a document setting out what the consortium is expected to achieve. If the consortium fails to meet any of the agreed standards, it should lose an element of its payment until standards improve. If standards do not improve after an agreed period, the public sector authority is usually entitled to terminate the contract, compensate the consortium where appropriate, and take ownership of the project. Termination procedures are highly complex, as most projects are not able to secure private financing without assurances that the debt financing of the project will be repaid in the case of termination. In most termination cases, the public sector is required to repay the debt and take ownership of the project. In practice, termination is considered a last resort only. Whether public interest is at all protected by a particular PFI contract is highly dependent on how well or badly the contract was written and the determination or not and capacity of the contracting authority to enforce it. Many steps have been taken over the years to standardize the form of PFI contracts to ensure public interests are better protected. Structure of providers. The typical PFI provider is organized into three parts or legal entities: a holding company called TopCo, which is the same as the SPV mentioned above, a capital equipment or infrastructure provision company called CapCo, and a services or operating company called OpCo. The main contract is between the public sector authority and the topco. Requirements then flow down from the topco to the capco and opco via secondary contracts. Further requirements then flow down to subcontractors, again with contracts to match. Often the main subcontractors are companies with the same shareholders as the topco. Method of funding. Prior to the financial crisis of 2007 to 2010, large PFI projects were funded through the sale of bonds and/or senior debt. Since the crisis, funding by senior debt has become more common. Smaller PFI projects—the majority by number—have typically always been funded directly by banks in the form of senior debt. Senior debt is generally slightly more expensive than bonds, which the banks would argue is due to their more accurate understanding of the credit-worthiness of PFI deals. They may consider that monoline providers underestimate the risk, especially during the construction stage, and hence can offer a better price than the banks are willing to. Refinancing of PFI deals is common. Once construction is complete, the risk profile of a project can be lower, so cheaper debt can be obtained. This refinancing might in the future be done via bonds. The construction stage is financed using bank debt, and then bonds for the much longer period of operation. The banks who fund PFI projects are repaid by the consortium from the money received from the government during the lifespan of the contract. From the point of view of the private sector, PFI borrowing is considered low risk because public sector authorities are very unlikely to default. Indeed, under IMF rules, national governments are not permitted to go bankrupt, although this is sometimes ignored, as when Argentina restructured its foreign debt. Repayment depends entirely on the ability of the consortium to deliver the services in accordance with the output specified in the contract. United Kingdom. Development. In 1992 PFI was implemented for the first time in the UK by the Conservative government of John Major. It immediately proved controversial, and was attacked by the Labour Party while in opposition. Labour critics such as the Shadow Chief Secretary to the Treasury Harriet Harman, said that PFI was really a backdoor form of privatisation. House of Commons, 7 December 1993, and the future Chancellor of the Exchequer, Alistair Darling, warned that, "...apparent savings now could be counted by the formidable commitment on revenue expenditure in years to come." The use of PFI was very limited until 1997 but became widespread under the New Labour government. 2 months after New Labour took office, the Health Secretary, Alan Milburn, announced that, "...when there is a limited amount of public sector capital available, as there is, it's PFI or bust." PFI expanded considerably in 1996 and then expanded much further under New Labour with the NHS Private Finance Act 1997, resulting in criticism from many trade unions, elements of the New Labour Party, the Scottish National Party (SNP), and the Green Party, as well as commentators such as George Monbiot. Proponents of the PFI include the World Bank, IMF and, in the UK, the CBI. Both Conservative and Labour governments sought to justify PFI on the practical grounds that the private sector is better at delivering services than the public sector. This position has been supported by the UK National Audit Office with regard to certain projects. However, critics claim that many uses of PFI are ideological rather than practical. Pollock recalls a meeting with the then Chancellor of the Exchequer Gordon Brown who could not provide a rationale for PFI other than to declare repeatedly that the public sector is bad at management, and that only the private sector is efficient and can manage services well. In 2003 the Labour government used public-private partnership (PPP) schemes for the privatisation of London Underground's infrastructure and rolling stock. The two private companies created under the PPP, Metronet and Tube Lines, were later taken into public ownership. In 2005-06, the Labour government introduced Building Schools for the Future, a scheme introduced for improving the infrastructure of Britain's schools. Of the £2.2 billion funding that the Labour government committed to BSF, £1.2 billion (55.5%) was to be covered by PFI credits. Some local authorities were persuaded to accept academies in order to secure BSF funding in their area. By October 2007, the total capital value of PFI contracts signed throughout the UK was £68 billion, committing the British taxpayer to future spending of £215 billion over the life of the contracts. The global financial crisis, which began in 2007, presented PFI with difficulties because many sources of private capital had dried up. Nevertheless, PFI remained the UK government's preferred method for public sector procurement under New Labour. In January 2009, the Labour Secretary of State for Health, Alan Johnson, reaffirmed this commitment with regard to the health sector, stating that PFIs have always been the NHS's Plan A for building new hospitals, there was never a Plan B. However, because of banks' unwillingness to lend money for PFI projects, the UK government now had to fund the so-called private finance initiative itself. In March 2009, it was announced that the Treasury would lend £2 billion of public money to private firms building schools and other projects under PFI. Labour's Chief Secretary to the Treasury, Yvette Cooper, claimed the loans should ensure that projects worth £13 billion, including waste treatment projects, environmental schemes and schools, would not be delayed or cancelled. She also promised that the loans would be temporary and would be repaid at a commercial rate. But, at the time, Vince Cable of the Liberal Democrats, subsequently Secretary of State for Business in the coalition, argued in favor of traditional public financing structures instead of propping up PFI with public money. The whole thing has become terribly opaque and dishonest, and it's a way of hiding obligations. PFI has now largely broken down, and we are in the ludicrous situation where the government is having to provide the funds for the private finance initiative. In opposition at the time, even the Conservative Party considered that, with the taxpayer now funding it directly, PFI had become ridiculous. Philip Hammond, subsequently Secretary of State for Transport in the coalition, said, "If you take the private finance out of PFI, you haven't got much left. If you transfer the financial risk back to the public sector, then that has to be reflected in the structure of the contracts. The public sector cannot simply step in and lend the money to itself, taking more risk so that the PFI structure can be maintained while leaving the private sector with the high returns these projects can bring. That seems to us fairly ridiculous." In an interview in November 2009, Conservative George Osborne, subsequently Chancellor of the Exchequer in the coalition, sought to distance his party from the excesses of PFI by blaming New Labour for its misuse. At the time, Osborne proposed a modified PFI which would preserve the arrangement of private sector investment for public infrastructure projects in return for part privatization, but would ensure proper risk transfer to the private sector along with transparent accounting. The government's use of PFI has become totally discredited, so we need new ways to leverage private sector investment. Labour's PFI model is flawed and must be replaced. We need a new system that doesn't pretend that risks have been transferred to the private sector when they can't be, and that genuinely transfers risks when they can be. On PFI, we are drawing up alternative models that are more transparent and better value for taxpayers. The first step is transparent accounting, to remove the perverse incentives that result in PFI simply being used to keep liabilities off the balance sheet. The government has been using the same approach as the banks did, with disastrous consequences. We need a more honest and flexible approach to building the hospitals and schools the country needs. For projects such as major transport infrastructure, we are developing alternative models that shift risk onto the private sector. The current system, heads the contractor wins, tails the taxpayer loses, will end. Despite being so critical of PFI while in opposition and promising reform, once in power George Osborne progressed 61 PFI schemes worth a total of £6.9 billion in his first year as Chancellor. According to Mark Hellowell from the University of Edinburgh, the truth is the coalition government have made a decision that they want to expand PFI at a time when the value for money credentials of the system have never been weaker. The government is very concerned to keep the headline rates of deficit and debt down, so it's looking to use an increasingly expensive form of borrowing through an intermediary, knowing the investment costs won't immediately show up on their budgets. The high cost of PFI deals is a major issue, with advocates for renegotiating PFI deals in the face of reduced public sector budgets, or even for refusing to pay PFI charges on the grounds that they are a form of odious debt. Critics such as Peter Dixon argue that PFI is fundamentally the wrong model for infrastructure investment, saying that public sector funding is the way forward. In November 2010, the UK government released spending figures showing that the current total payment obligation for PFI contracts in the UK is £267 billion. Also, research has shown that in 2009 the Treasury failed to negotiate decent PFI deals with publicly owned banks, resulting in £1 billion of unnecessary costs. This failure is particularly grave given the coalition's own admission in their National Infrastructure Plan that a 1% reduction in the cost of capital for infrastructure investment could save the taxpayer £5 billion a year. In February 2011, the Treasury announced a project to examine the £835 million Queen's Hospital PFI deal. Once savings and efficiencies are identified, the hope, as yet unproven, is that the PFI consortium can be persuaded to modify its contract. The same process could potentially be applied across a range of PFI projects. PF2. In December 2012, Home Treasury published a white paper outlining the results of a review of the PFI and proposals for change. These aimed to centralize procurement by and for government departments, increase Treasury involvement in the procurement process, and move the management of all public sector investment in PFI schemes into a central unit in the Treasury, draw funding providers into projects at an earlier stage to reduce windfall gains when they were sold on, exclude from PFI schemes soft services, where the specification was likely to change at short notice, such as catering and cleaning, reduce the role of bank debt in financing, improve transparency and accountability by both public and private sector participants, increase the proportion of risk carried by the public sector. In October 2018, the Chancellor, Philip Hammond, announced that the UK government will no longer use PF2, the current model of private finance initiative. A centre of excellence is to be established within the Department of Health and Social Care to manage the existing PFI contracts in the NHS. Scotland. A specialist unit was set up in the Scottish office in 2005 to handle PFI projects. In November 2014, Nicola Sturgeon announced a £409 million public-private funding package which would be funded through a non-profit distributing model which would cap private sector returns, returning any surplus to the public sector. On Monday, the 11th of April 2016, 17 PFI-funded schools in Edinburgh failed to open after the Easter break because of structural problems identified in two of them the previous Friday. The schools had been erected in the 1990s by Miller Construction. Topic: Examples of projects. There have been over 50 English hospitals procured under a PFI contract with capital cost exceeding £50 million. There have been some 6 Scottish hospitals procured under a PFI contract with capital cost exceeding £50 million. The following is a selection of major projects in other sectors procured under a PFI contract. The Guardian published a full list of PFI contracts by department in July 2012 and Home Treasury published a full list of PFI contracts by department in March 2015. Impact. Analysis. A study by Home Treasury in July 2003 was supportive, showing that the only deals in its sample which were over budget were those where the public sector changed its mind after deciding what it wanted and from whom it wanted it. A later report by the National Audit Office in 2009 found that 69% of PFI construction projects between 2003 and 2008 were delivered on time and 65% were delivered at the contracted price. However, a report by the National Audit Office in 2011 was much more critical, finding that the use of PFI has the effect of increasing the cost of finance for public investments relative to what would be available to the government if it borrowed on its own account, and the price of finance is significantly higher with a PFI. An article in The Economist reports that getting the private sector to build and run prisons has brought tangible benefits. One is speed. Private jails are built in as little as 2 years, rather than the 7 that they used to take when the government did the building. Running costs are lower too, mainly because staff are paid a quarter less than in the public sector, though senior managers are paid more and get fewer benefits. On the other hand, Monbiot argues that the specifications of many public infrastructure projects have been distorted to increase their profitability for PFI contractors. PFI projects allowed the Ministry of Defense to gain many useful resources on a shoestring. PFI deals were signed for barracks, headquarters buildings, training for pilots and sailors, and an aerial refueling service. Amongst other things, individuals have speculated that some PFI projects have been shoddily specified and executed. For example, in 2005 a confidential government report condemned the PFI-funded Newsom Centre at Seacroft Hospital for jeopardising the lives of 300 patients and staff. The Newsom Centre is for people with lifelong learning difficulties and the mentally ill. The report said that there were shortcomings in each of the 5 key areas of documentation, design, construction, operation and management at the hospital, which cost £47 million. Between 2001 to 2005 there were 4 patient suicides, including one which was left undiscovered for 4 days in an out-of-order bathroom. The coroner said that Leeds Mental Health Teaching NHS Trust, which is responsible for the facility, had failed to keep patients under proper observation. The government report said that the design and construction of the building did not meet the requirements for a facility for mental patients. The building has curving corridors which make patient observation and quick evacuation difficult. The report said that the building also constituted a fire hazard, as it was constructed without proper fire protection materials in the wall and floor joints. In addition, mattresses and chairs used below standard fire retardant materials. Patients were allowed to smoke in rooms where they could not be easily observed. The fire safety manual was described as very poor, and the fire safety procedure consisted of a post-it note marked, "To be provided by the Trust." The report concluded that, "every section of the Fire Safety Code" had been breached. On the other hand, the building of 2 new PFI police stations on behalf of Kent Police serving the Medway area and the North Kent area, Gravesend and Dartford, is credited as a successful PFI project. Supporters say that the new buildings take into account the modern needs of the police better than the 60s, 70s building, and that another advantage is that the old buildings can be sold for income or redeveloped into the police estate. National Health Service (NHS). In 2017 there were 127 PFI schemes in the English NHS. The contracts vary greatly in size. Most include the cost of running services such as facilities management, hospital portering and patient food, and these amount to around 40% of the cost. Total repayments will cost around £2.1 billion in 2017 and will reach a peak in 2029. This is around 2% of the NHS budget. A 2009 study by University College London, studying data at hospitals built since 1995, supports the argument that private sector providers are more accountable to provide quality services. It showed that hospitals operating under PFI have better patient environment ratings than conventionally funded hospitals of similar age. The PFI hospitals also have higher cleanliness scores than non-PFI hospitals of similar age, according to data collected by the NHS. Jonathan Fielden, chair of the British Medical Association's Consultants Committee, has said that PFI debts are distorting clinical priorities and affecting the treatment given to patients. Fielden cited the example of University Hospital Coventry, where the NHS Trust was forced to borrow money to make the first £54 million payment owed to the PFI contractor. He said that the Trust was in the ignominious position of struggling for money before the hospital's doors even opened. The Trust could not afford to run all the services that it had commissioned and was having to mothball services and close wards. The high cost of hospitals built under PFI is forcing service cuts at neighbouring hospitals built with public money. Overspending at the PFI-funded Worcestershire Royal Hospital has put a question mark over services at neighbouring hospitals. A Strategic Health Authority paper in 2007 noted debts at two hospitals in southeast London, Princess Royal University Hospital and Queen Elizabeth Hospital. The paper attributed the debts in part to their high fixed PFI costs and suggested that the same would soon apply to Lewisham Hospital. In 2012, 7 NHS trusts were unable to meet the repayments for their private finance schemes and were given £1.5 billion in emergency funding, to help them avoid cutting patient services. Barking, Havering and Redbridge University Hospitals NHS Trust, Dartford and Gravesham NHS Trust, Maidstone and Tunbridge Wells NHS Trust, North Cumbria University Hospitals NHS Trust, Peterborough and Stamford Hospitals NHS Foundation Trust, St Helens and Knowsley Teaching Hospitals NHS Trust, South London Healthcare NHS Trust. Peter Dixon, chairman of University College Hospital, the largest PFI-built hospital in England, has gone on the record to say, "We now have indexed payments for the next 35 years, which at a time of growing concern over NHS budgets can only be a millstone. It isn't just that our scheme was expensive. Its very existence distorts whatever else needs to happen in this part of London and beyond. And that is before we get to paying for the much larger scheme at Barts and the London in a few years' time." An anonymous NHS finance director pointed out in November 2015, that PFI payments are often linked to the retail price index, which has risen more rapidly than the NHS tariff. He estimated that payments were about 3% higher than those incurred using traditional public dividend capital. Northumbria Healthcare NHS Foundation Trust was the first to buy out a PFI contract, borrowing £114.2 million from Northumbria County Council in a deal which reduced its costs by £3.5 million per year. A report by the Centre for Health and the Public Interest in 2017 calculated that PFI companies had made pre-tax profits from the NHS of £831 million in the previous 6 years. They calculate that PFI payments in the NHS will rise from £2.2 billion in 2019-20 to a peak of £2.7 billion in 2029-30. Private sector. Semperian, Innisfree Limited and the HICL Infrastructure Company are the main players in NHS contracts. Employment. When spending is tight, hospitals may prefer to retain medical staff and services by spending less on building maintenance. But under PFI, hospitals are forced to prioritize the contractual payments for their buildings over jobs and, according to figures published by the Department of Health, these committed payments can account for up to 20% of operating budget. Nigel Edwards, head of policy for the NHS Confederation, noted that a hospital with a PFI scheme is contractually bound to keep the maintenance up, and if you are spending 10 or 15% on your buildings, it means all the other efficiency and productivity gains you need have to come out of only 85 or 90% of your budget. Dr. Jonathan Fielden, chair of the British Medical Association's Consultants Committee, has said that as a result of the high costs of a PFI scheme in Coventry, they are potentially reducing jobs. In fact, by 2005 the Hospital Trust in Coventry was anticipating a deficit of £13 million due to PFI, and drastic measures were required to plug the gap, including shutting one ward, removing 8 beds from another, shortening the opening hours of the surgical assessment unit, and the rationalisation of certain posts, which meant cutting 116 jobs. Under PFI, many staff have their employment contracts automatically transferred to the private sector, using a process known as two-pay. In many cases this results in worse terms of employment and pension rights. Heather Wakefield, UNISON's National Secretary for Local Government, has said, "Local authorities and health authorities have very good final salary pension schemes. We have surveyed contractors in best value contracting out deals. At only one company in the past 3 years was any pension provided. And that is the pattern in transfers across the public sector, not just in local government, and not just best value. It happens in PFI too. Two-pay does not apply to pensions. The government is supposed to have revised two-pay, integrating the Acquired Rights Directive from the EU. That has not happened." Debt. The debt created by PFI has a significant impact on the finances of public bodies. As of October 2007, the total capital value of PFI contracts signed throughout the UK was £68 billion. However, central and local government are committed to paying a further £267 billion over the lifetime of these contracts. To give regional examples, the £5.2 billion of PFI investment in Scotland up to 2007 has created a public sector liability of £22.3 billion, and the investment of just £618 million via PFI in Wales up to 2007 has created a public sector liability of £3.3 billion. However, these debts are small compared to other public sector liabilities. Annual payments to the private owners of the PFI scheme are due to peak at £10 billion in 2017. In some cases trusts are having to rationalize spending by closing wards and laying off staff, but they are not allowed to default on their PFI payments. In September 1997 the government declared that these payments would be legally guaranteed. Beds, doctors, nurses and managers could be sacrificed, but not the annual donation to the Fat Cats Protection League. Should certain trusts fail because they cannot meet their PFI payments, this will provide further opportunities for privatization if the government brings in private healthcare corporations to run the hospitals instead. Mark Porter, of the British Medical Association said, "Locking the NHS into long-term contracts with the private sector has made entire local health economies more vulnerable to changing conditions. Now the financial crisis has changed conditions beyond recognition, so trusts tied into PFI deals have even less freedom to make business decisions that protect services, making cuts and closures more likely." John Appleby, chief economist at the Kingsfund Health think tank, said, "It is a bit like taking out a pretty big mortgage in the expectation your income is going to rise, but the NHS is facing a period where that is not going to happen. Money is being squeezed and the size of the repayments will make it harder for some to make the savings it needs to." I don't see why the NHS can't go back to its lenders to renegotiate the deals, just as we would with our own mortgages." Officials at the Treasury have also admitted that they may have to attempt to renegotiate certain PFI contracts in order to reduce payments, although it is far from certain that the private investors would accept this. PFI contracts are generally off-balance sheet, meaning that they do not show up as part of the national debt. This fiscal technicality can be convenient for governments. In his paper on PFI in Spain, José Francisco Beled Redondo notes that one of the main drivers for PFI in Spain is compliance with the fiscal restrictions imposed under the Maastricht Treaty and Stability and Growth Pact, which set concrete limits to the national debt. In the UK, the technical reason why PFI debts are off balance sheet is that the government authority taking out the PFI theoretically transfers one or more of the following risks to the private sector: risk associated with demand for the facility, e.g. underutilization, risk associated with construction of the facility, e.g. overspend and delay, or risk associated with the availability of the facility. The PFI contract bundles the payment to the private sector as a single unitary charge for both the initial capital spend and the ongoing maintenance and operation costs. Because of supposed risk transfer, the entire contract is deemed to be revenue rather than capital spending. As a result, no capital spend appears on the government's balance sheet. The revenue expenditure would not have been on the government balance sheet in any event. Public accounting standards are being changed to bring these numbers back onto the balance sheet. For example, in 2007 Neil Bentley, the CBI's Director of Public Services, told a conference that the CBI was keen for the government to press ahead with accounting rule changes that would put large numbers of PFI projects onto the government's books. He was concerned that accusations of accounting tricks were delaying PFI projects. Risk. Supporters of PFI claim that risk is successfully transferred from public to private sectors as a result of PFI, and that the private sector is better at risk management. As an example of successful risk transfer, they cite the case of the National Physical Laboratory. This deal ultimately caused the collapse of the building contractor Laser, a joint venture between Serco and John Lang, when the cost of the complex scientific laboratory, which was ultimately built, was very much larger than estimated. On the other hand, Alison Pollock argues that in many PFI projects risks are not in fact transferred to the private sector and, based on the research findings of Pollock and others, George Monbiot argues that the calculation of risk in PFI projects is highly subjective, and is skewed to favor the private sector. When private companies take on a PFI project, they are deemed to acquire risks the state would otherwise have carried. These risks carry a price, which proves to be remarkably responsive to the outcome you want. A paper in the British Medical Journal shows that before risk was costed, the hospital schemes it studied would have been built much more cheaply with public funds. After the risk was costed, they all tipped the other way, in several cases by less than 0.1%. Following an incident in the Royal Infirmary of Edinburgh where surgeons were forced to continue a heart operation in the dark following a power cut caused by PFI operating company Consort, Dave Watson from Unison criticized the way the PFI contract operates. It's a costly and inefficient way of delivering services. It's meant to mean a transfer of risk, but when things go wrong the risk stays with the public sector and, at the end of the day, the public, because the companies expect to get paid. The Health Board should now be seeking an exit from this failed arrangement with Consort and at the very least be looking to bring facilities management back in-house. Value for money. A National Audit Office study in 2003 endorsed the view that PFI projects represent good value for taxpayers' money, but some commentators have criticized PFI for allowing excessive profits for private companies at the expense of the taxpayer. An investigation by Professor Jean Shaul of Manchester Business School into the profitability of PFI deals based on accounts filed at Companies House revealed that the rate of return for the companies on 12 large PFI hospitals was 58%. Excessive profits can be made when PFI projects are refinanced. An article in the Financial Times recalls that acute embarrassment of the early days of PFI, when investors in projects made millions of pounds from refinancings and it turned out that the taxpayer had no right to any share in the gains. Investors in one of the early prison projects, for example, made a £14 million windfall gain and hugely increased rates of return when they used falling interest rates to refinance. A number of PFI projects have cost considerably more than originally anticipated. More recent reports indicate that PFI represents poor value for money. A Treasury Select Committee stated that PFI was no more efficient than other forms of borrowing and it was illusory, that it shielded the taxpayer from risk. One key criticism of PFI, when it comes to value for money, is the lack of transparency surrounding individual projects. This means that independent attempts, such as that by the Association for Consultancy and Engineering, to assess PFI data across government departments have been able to find significant variations in the costs to the taxpayer. Tax. Some PFI deals have also been associated with tax avoidance, including a deal to sell properties belonging to the UK government's own tax authority. The House of Commons Public Accounts Committee criticised HM Revenue and Customs over the PFI Steps deal to sell about 600 properties to a company called Mapley, based in the tax haven of Bermuda. The committee said it was a very serious blow indeed for the government's own tax-collecting services to have entered into the contract with Mapley, whom they described as tax avoiders. Conservative MP Edward Lee said there were significant weaknesses in the way the contract was negotiated. The government agencies had failed to clarify Mapley's tax plans until a late stage in the negotiations. Lee said, "It is incredible that the Inland Revenue, of all departments, did not, during contract negotiations, find out more about Mapley's structure." Bureaucracy. The National Audit Office has accused the government's PFI dogma of ruining a £10 billion Ministry of Defence project. The Future Strategic Tanker Aircraft project to develop a fleet of multi-role RAF tanker and passenger aircraft was delayed for over 5 years while, in the meantime, old and unreliable planes continue to be used for air-to-air refueling, and for transporting troops to and from Afghanistan. Edward Lee, then Conservative chair of the Public Accounts Committee which oversees the work of the NOW, said, "By introducing a private finance element to the deal, the MOD managed to turn what should have been a relatively straightforward procurement into a bureaucratic nightmare." The NOW criticized the MOD for failing to carry out a sound evaluation of alternative procurement routes, because there had been the assumption in the ministry that the aircraft must be provided through a PFI deal in order to keep the numbers off the balance sheet, due to affordability pressures and the prevailing policy to use PFI wherever possible. Complexity. Critics claim that the complexity of many PFI projects is a barrier to accountability. For example, a report by the trade union Unison entitled, "What is Wrong with PFI in Schools?" says, Lees often seek to withhold crucially important financial information about matters such as affordability and value for money. In addition, the complexity of many PFI projects means that governors, teachers and support staff are often asked to take on trust assurances about proposals which have important implications for them. Malcolm Trobe, the president of the Association of School and College Leaders, has said that the idea that contracting out the school building process via PFI would free up head teachers to concentrate on education has turned out to be a myth. In many cases it has in fact increased the workload on already stretched staff. Waste. A BBC Radio 4 investigation into PFI noted the case of Balmoral High School in Northern Ireland, which cost £17 million to build in 2002. In 2007 the decision was made to close the school because of lack of pupils. But the PFI contract is due to run for another 20 years, so the taxpayer will be paying millions of pounds for an unused facility. With regard to hospitals, Professor Nick Bosanquet of Imperial College London has argued that the government commissioned some PFI hospitals without a proper understanding of their costs, resulting in a number of hospitals which are too expensive to be used. He said, "There are already 1 or 2 PFI hospitals where wards and wings are standing empty because nobody wants to buy their services. There will be a temptation to say, right, we are stuck with these contracts so we will close down older hospitals, which may in fact be lower cost. Just closing down non-PFI hospitals in order to up activity in the PFI ones is not going to be the answer because we may have the wrong kind of services in the wrong places." In 2012, it was reported that dozens of NHS trusts labouring under PFI-related debts were at risk of closure. Relationship with government. Treasury. In July 1997 a PFI task force was established within the Treasury to provide central coordination for the rollout of PFI. Known as the Treasury Task Force (TTF), its main responsibilities are to standardize the procurement process and train staff throughout government in the ways of PFI, especially in the private finance units of other government departments. The TTF initially consisted of a policy arm staffed by 5 civil servants, and a projects section employing 8 private sector executives led by Adrian Montague, formerly co-head of Global Project Finance at investment bank Dresdner Kleinwort Benson. In 1999 the policy arm was moved to the Office of Government Commerce (OGC), but it was subsequently moved back to the Treasury. The projects section was part privatized and became Partnerships UK (PUC). The Treasury retained a 49% golden share, while the majority stake in PUC was owned by private sector investors. PUC was then staffed almost entirely by private sector procurement specialists such as corporate lawyers, investment bankers, consultants and so forth. It took the lead role in evangelizing PFI and its variants within government, and was in control of the policy's day-to-day implementation. In March 2009, in the face of funding difficulties caused by the global financial crisis, the Treasury established an infrastructure finance unit with a mandate to ensure the continuation of PFI projects. In April 2009, the unit stumped up £120 million of public money to ensure that a new waste disposal project in Manchester would go ahead. Andy Rose, the unit head, said, "This is what we were set up to do, to get involved where private sector capital is not available." In May 2009 the unit proposed to provide £30 million to bail out a second PFI project, a £700 million waste treatment plant in Wakefield. In response, Tony Travers, director of the Greater London Group at the London School of Economics, described the use of public money to finance PFI as "Alice in Wonderland economics." The House of Commons Public Accounts Committee has criticised the Treasury for failing to negotiate better PFI funding deals with banks in 2009. The committee revealed that British taxpayers are liable for an extra £1 billion because the Treasury failed to find alternative ways to fund infrastructure projects during the financial crisis. The committee suggests that the government should have temporarily abandoned PFI to directly fund some projects, instead of allowing the banks, many of which were being bailed out with billions of pounds of public money at the time, to increase their charges, by up to 33%. Scrutiny. The House of Commons Liaison Committee has said that claims of commercial confidentiality are making it difficult for MPs to scrutinise the growing number of PFI contracts in the UK. The National Audit Office now is responsible for scrutinising public spending throughout the UK on behalf of the British Parliament and is independent of government. It provides reports on the value for money of many PFI transactions and makes recommendations. The Public Accounts Committee also provides reports on these issues at a UK-wide level. The devolved governments of Scotland, Wales and Northern Ireland have their own equivalents of the NOW, such as the Wales Audit Office and the Northern Ireland Audit Office, which review PFI projects in their respective localities. In recent years, the finance committees of the Scottish Parliament and the National Assembly for Wales have held inquiries into whether PFI represents good value for money. Local government. PFI is used in both central and local government. In the case of local government projects, the capital element of the funding which enables the local authority to pay the private sector for these projects is given by central government in the form of what are known as PFI credits. The local authority then selects a private company to perform the work, and transfers detailed control of the project, and in theory the risk, to the company. Appraisal process. Jeremy Coleman, former Deputy General of the National Audit Office and Auditor General for Wales, is quoted in the Financial Times saying that many PFI appraisals suffer from spurious precision, and others are based on pseudo-scientific mumbo-jumbo. Some, he says, are simply utter rubbish. He noted government pressures on contracting authorities to weight their appraisals in favour of taking their projects down the PFI route. If the answer comes out wrong, you don't get your project. So the answer doesn't come out wrong very often. In a paper published in the British Medical Journal, the magazine of the Medical Trade Union, the BMA, a team consisting of 2 public health specialists and an economist concluded that many PFI appraisals do not correctly calculate the true risks involved. They argued that the appraisal system is highly subjective in its evaluation of risk transferal to the private sector. An example was an NHS project where the risk that clinical cost savings might not be achieved was theoretically transferred to the private sector. In the appraisal, this risk was valued at £5 million, but in practice the private contractor had no responsibility for ensuring clinical cost savings and faced no penalty if there were none. Therefore, the supposed risk transfer was in fact spurious. Development in other countries. As well as the UK, PFI has also been adopted, under various guises, in many other countries including, Australia, Canada, the Czech Republic, Finland, France, Greece, India, Ireland, Israel, Japan, Malaysia, the Netherlands, Norway, Portugal, Singapore, Spain and the United States. Spain. Examples of PFI projects in Spain include Parque de Valdebebas in Madrid, Ciutat de la Justicia in Barcelona, the Autovia de Noroeste in Murcia, and the Hospital Puerta de Hierro in Majadahonda. See also: Government procurement.
Gold. Now what we're going to do is we're going to measure gold. We're going to put the price of gold up here because a lot of people consider the price of gold to be a valid measure of preserving wealth, maintaining preventing for your money from depreciating, right? When you look at this thing, when money goes from $100 to, when US dollar goes from $100 to $3.70, that's a currency, right? That's not money, because one of the things money has to be a good store of value, and currency is not a good store of value. So when that saying comes along that says cash is money, it is true, you need to be liquid, right? But cash is only money for short periods of time. You don't want to be in cash too long, right? We'll talk about this a little bit more when we graph some of these things. But let's put gold on here. In 1900, right, gold was $20.67. So gold, I'm going to put this $20.67. Okay. And this is gold. Put this guy this way. Gold. So let's put gold as gold, right? Use the gold marker. So this is gold. Okay. So gold was $20.67. And what we're going to do here, we're not going to adjust for inflation. We're not going to, because $20.67 in 1900, in 2017 dollars was $517, right? So $20 was equivalent your purchasing power if you take this into consideration, right? So if you had this money, not money, I keep using the wrong word, but this currency, if you had your wealth in this, right, and inflation was doing this, right, if we were going to measure how much $20.67 was equivalent to in these dollars, it was worth $517, right? But we're just going to use the value there. This is 10 here, this tick, so 20 is around here, right? So if you put, you bought $20 worth of gold in 1900, and the government didn't confiscate your gold in this period, because the US government, there's a period in I wrote this down. I knew this history before. I wrote it down in the previous iteration. I didn't copy it over to this one because I wasn't going to talk about it. But there was a certain period, a few years here, during World War II, where the US government confiscated everyone's gold, right? And sort of everyone had to take it into the banks, and the banks took that gold in at this price. And then a few years later, the government raised the price of gold because this was not fluctuating the way, or controlled. Well, it was completely controlled. It was set in stone. Right now it's supposed to be fluctuating based on market principles, but it's really not. It's sort of controlled as well in a big way. But during the World War II period, or build up to World War II, the US government confiscated people's gold, and the banks took them in, and a few years later the banks sold them a higher value, right? So they made pretty good money, pretty good returns considering the amount of time involved, right? So $20, if you put $20.67 of gold in 1900, right now gold is trading at a few days ago anyway, when I looked this up, is trading at $1,230, right? So let's put that on here. Oops, took off the wrong side. $1,230. $1,230. Right. So this is 1,000. This is 1,000. 2,000 is up here because that's 10,000. So $1,230 is like pretty close to 1,000. Let's say it's about here. Okay. So right now, if we just think about these as straight lines, this straight line, this was a bad place for you to be in. You would have lost everything because your purchasing power has also decreased, right? It's a double whammy. Your money, value of your money has decreased, and your purchasing power has decreased. This is supposed to be a measure of this, but it's really not. Okay, so keep this in mind. And gold basically mirrors this, right? To a certain degree. Because one thing we can do once we start putting things on graphs visually, we can do a table format too, but it's more difficult to visualize the stuff in table format. What you can do is start doing calculation, taking ratios, some stuff we're going to talk about in series 4 of the language of mathematics. But what you can do is take the slope of this graph and take the slope of this graph, which is basically rise over run, right? And rise over run, and see which one is a steeper slope. The one that's a steeper slope, if you're invested in it, that's better because it's giving you faster returns, right? So for this graph, for this visualization, what we're thinking about is which one is going to be a steeper slope, right? On the upside, not on the downside. This is one of the only one that I took or I found where the price has decreased over time. I think textiles I looked at as well, but I didn't really bother graphing that because that's very small scale. And technology actually goes down as well. The cost of technology goes down over time as well, and that's really cool to look at. But we're going to take a look at it at a different time in a different video that we've set up for it, right? So gold has gone from $20 to $1,200, right? And you can do a multiple of this, right? You could do this if you want to figure out what the multiple is for the CPI. 244 divided by 8.9, that's 27.4 times, and 1230 divided by 20.0 is 59 times, right? Wow. So if this is, let's say this was 30 times, this is 59, let's say 60 times. So the slope of this, even though that doesn't appear so right now because we're on a log scale, right? Gold has increased twice as fast as the CPI, which is a good indication of gold based on government measures, is a good place to store value, right? Is it a good currency? Does everyone trade gold? I don't know how to, well, I do know, I did geology, so I can test it and figure out if it's gold, if it's malleable, right? If it's not metallic. You can figure out if something is gold. I know, I've talked to someone where they said some people go to, if you want to find, use a method to find gold in places where there might be gold, right? You don't have to go out in the forest, into the rivers and start panhandling, they call it, and start digging for gold. Some people take magnets and they go to thrift stores, right? And they take anything that's gold colored and they put a magnet to it, and if it doesn't stick to it, they buy it because gold is not magnetic, it's not ferrous, right? I think it's ferrous if I remember terminology correctly. And if magnet doesn't stick to it, if it's really gold colored, then it might be gold. And that's one of the things you could use to go searching for gold, right? Go look for treasure, right? So gold is a good place to preserve wealth based on CPI numbers. But this double slope really doesn't do anything to help you compensate for the price of tuitions going up, stuff like that, right? Now, the next measure we're going to look at the S&P 500, the stock market, Wall Street, sort of what we talked about in the previous video, or reading Mr. Armstrong's article, right? So the S&P in 1900, okay, and this is sort of, it wasn't called the S&P in 1900, it was called a composite index, and the composite index, I found only one source which gave me the 1900 number. There's multiple sources I found for the 1920 number and stuff like this, but the 1900 number, the S&P 500, if you want to think about it as the S&P 500, was 6.1. 6.1. Okay. So 6.1 is under the 8, somewhere around here. I'm just going to put it far enough down that we can actually see. Here, let's move this guy a little bit higher up. Now we're a little bit more accurate, I guess, and get rid of that 10 value and give this guy room. Okay. So 6.8 or 6.1 is around here. Okay. Just a straight up S&P value is, the last time I looked, is 2,459. 2,000, let's say 2,450, right? 2,400, oops, mark this one up. 2,450. 2,450. 2,450. And that guy, that's 1,000 here, this tick. So 2,000 is going to be up here. The slope of this is much better than the slope of the other two, that's for sure. Let's look at the multiple on this. 2,450 divided by 6.1. 401 is the multiple. 402 is the multiple, right? That's pretty good. Now, one thing with the S&P is you can't just, well, you can. You could buy the S&P and just let it ride, right? But one thing with the S&P happens is the stock market, if you buy the right number of stocks, what happens is they give you dividends, money back, a certain percentage per year. And that's basically the main gist of our current economic system, which is just chasing growth. And that's a certain flaw in our economic system as well, because things don't grow in forever, right? So our current system, our current economy is based on growth, and a certain percentage, I'm going to S and P. Let's put the S&P up here, another thing as well, right? So it's based on growth, and this slope is much better. But what happens with the S&P is there's certain stocks you can buy that give you dividends every year. So, you know, it varies, it fluctuates. It goes from anything from less than 1% up to like 6, 7, 8% more aggressive ones, right? But the average S&P return during this period, I looked it up, you know, seemed a little sketchy, some of it, because first of all, not, you know, no individual is going to be invested in for 117 years. It's not going to happen. It's going to be institutions to a certain degree, right? And what happens is, basically, if you take out the inflation factor, the CPI, the devaluation of the currency, you lose a little bit of percent there as well, right? But one of the measures on the high end, if you include you getting dividends and not spending your dividends, because what happens, most people invest in dividend stocks because they get a certain amount of income. They're called income stocks. I believe they're called income stocks, if I remember correctly. And you get a certain percentage back every year, and they use that as expense money, right? Funds that they live by, right? But if you, on the extreme end, if you invested $6.1, right, in $1,900 in the S&P, and took out your dividend, right? You didn't reinvest that dividend. You just went for this growth. This is what you would have, right? But if you took that dividend, all of that dividend being given to you, and put it all back into play, right? And this is the concept of compound growth. The value jumps up a lot, and this is on the extreme side. And I found some numbers, and the calculation I did was I basically took it being a 7% growth, okay? Because average, I believe, the dividend return for the S&P was 4% per year if you average it out for this period of time. Actually, it went for a shorter period of time, so I'm not sure even if dividends existed here. So we're thinking about absolute extreme. Okay, so 4% dividend return. The growth rate was 2.8%. So I took it to be 7% growth. Right? If you put $6.1 in 1900 into the S&P at 7% growth for 117 years, that's what we're talking about, right? Your return was 16,000. Okay. No one would have done this. Most people I know that I've known that play Wall Street, play the stock market, they don't reinvest all dividends into the same play, same game. It wouldn't be a smart decision to do, but basically, well, it would be to a certain degree, depending on what you're in at certain points in life, I guess. But 1600 would be here. Okay, oops, squished it. Okay, that would be 1600. So your growth could either be this on the minimum side, if you took out all your dividends, or the growth would be this. And that multiple is way more. 16000 divided by 6.1 is 2,622 times return. That's very good. That's very good, right? Now, let's take a look at some other measures. Okay. On the same level, if we take a look at, and I took this and it comes up, the reason I took this because this company is having a huge role to play in our current political and economic system, but basically Renaissance Technologies is a tech company that was started, not a tech company, it was an investment company, hedge fund managers basically, that came about because of the advent of technology, because of the advent of computing, what we talked about in the previous video, right? Really, all these videos are sort of connected, right? Which Martin Armstrong talked about, right? Behind the curtain, the full Monty, how automation came into play in our current political economic system. And this company has had a huge role to play in our current political and economic system. They were one of the main backers of both parties in the United States last year or this year, I guess, right? So they were one of the main backers, main players, and policymakers to a certain degree, because those funding an election get to decide the policy of that governing body to a certain degree, right? So this company came about in 1980s, right? Because of the advent of technology, computer power, okay? And what they were able to do, they were able to come up with programs to do trading on a more frequent basis and use algorithms, right? And their return from their main fund, one of their main funds, from 1994, okay, if you invested $100 with them in 1994, 100, $94. I'm just going to put a little dash 94. Is that going to show up? I don't know if it's going to show up for you guys. Right? $100, and that's 94. Right? In 1994, so we're talking about, this is 2020, 2010, 2000, 1990. Right? 1994 is here. So if you invested here $100, right, about here, and we're talking here right here, somewhere around here anyway, right? If you invested $100 in 1994 in this fund, if you were given the opportunity to do so, your return, $100 would have gotten you back $22,661, right? 22,000. $661. Okay. 22,000. That's 16,000 is not up here. My apologies, gang. If this is 10,000, that's 20,000, right? So 16 is here. My bad. Somewhere around here anyway, right? So $22,661 is higher than this. So that's 10,000, 20,000 comes up here, right? So take a look at this. The slope of this dwarfs like these guys, right? And this sort of plays out for us in something called differential accumulation, something we talked about in ASMR math previously, right? When we talk about disruptive innovation. And basically what we're seeing right now is automation in regards to trading stocks, right? From the 1980s, right? 2010, 2000, 1990, 1980, coming into play, technology coming into play here, where the people playing that system at this time, in 10 years, were able to create a fund that in 1994, if you put $100 in it, gave you a return of $22,661. That's pretty impressive. That's pretty impressive. And the multiple on that is, did I do the multiple calculation? I don't even think I did the multiple calculation. The multiple calculation is, what is it? It's just it's 226, right? The multiple is 226 times in a matter of, and one thing I forgot. This isn't in 2017, it was 2014, so we're actually here. 2010, 2014. It's actually here, right? Little bit out, so it's a dot. It's not on the tick. So you have 226 times the return. And for fun, I punched it in because this what this return is for this period was 71% return compounded yearly, right? So 71% return. Now think about this. The CPI, the purple, and actually let's put the table on here. The purple here, or sorry, not the purple. The purple here. This was the the pink. The pink was the CPI, right? The pink is the CPI. This was supposed to compensate for inflation, right? And inflation is supposed to be around 2 to 3% per year. These guys were getting a return of 71% per year, right? Renaissance. Rentec. Let's call it Rentec. Okay. That's these guys here. And for fun, what I did was I took that measure, that growth, and I applied it. Come on, stick away. And I applied it. Hey. And I applied it from 1900. And I took, we did the thing here. I took $100. And I did it from 1920. I didn't even do it from 1900. I did it from 1920 because initially I was just going to do things from 1920. Your return was if you put $100 in 1920, which is 1910, 1920, we're not going to write the numbers because it doesn't make sense, right? If you put the number here, $100, 1920, right? Your return was 2 times 10 to the 23. 2 times 10 to the 23, 71%, the same rate of return as this. So if you want to visualize where this graph is, because all you really need to do is take the line created here, right? Over here, let's do it with the ruler. Okay. So because the growth rate is going to be the same, right? The growth rate to a certain degree is rise over run, right? Basically, it's going to be, right? The percent rate on it anyway, compounded. But what you can do is just get an approximation of where this is going to go. Use the same slope and just transpose this over here. And keep in mind that each one of these ticks is log 10. And what this was is 10 to 23. You could buy the world, maybe. I don't know. It's past trillions, right? I should have actually figured out what that word is to describe 2 times 10 to the 23. Now, going back to more realistic, or not realistic, this is realistic, right? This company, the same company had, and this was a private fund, by the way. You could only have connections to be able to buy in that fund, or a lot of wealth to be able to buy in that fund. It wasn't open to the public. This same company had funds existing for a certain period there where they lost a certain percentage. So the slope was down, right? Those were the public funds that you can invest in. The private ones, slopes were like this, the two I looked at. And the public ones, there was only 2 public ones they had, or 1 public one. That 1 public one was a declining investment, not a good investment, right? Take that however way you want. Okay. Now what we're going to do is take a look at another place where you could have stored your wealth in a big way, okay? And that's in art, right? Because art has been one of the greatest investments you could have made over time, okay? And that investment, we're going to talk about something that's dear to my heart if you're watching these videos. We're going to take probably the most important comic book on the market, since we've reached a level where we're talking about extremes, right? As soon as we hit this, we've hit extremes, returns, right? So let's do something that's compatible to this. Art is one of the best places you could invest in. Paintings, well-known painters, their prices, they're astronomical. I don't follow that market, but I do follow the comic book market, right? So if you bought Action Comics #1, the first appearance of Superman, I'm just going to put Superman here. Superman. But it's Action Comics #1. Oh, I've got to write this the other way. Really, it's not Superman. Action Comics. But I'm going to call it Superman so we know what it is. Superman. So if you bought Action Comics #1 in 1938, because it came out in 1938, its price was 10 cents, right? Its price was 10 cents. So it's 1938, so let me put this here too. Let's do that. Let's make enough room for it. 10 cents. 1938. Okay. So that's 1910, 1920, 1930, 1938 is here. So let's see. 10, 20, 30. So we're here. 1930, and you bought it at 10 cents. So you basically, I should have had another scale here. My bad, right? I totally forgot about that, right? Because then 10 cents would be here, right? So let's not make it 10 cents. Let's make it you bought 10 of them, so we can put it on this graph, right? Initially I'd gone, and by the way, 10 cents in 1938 was equivalent to $1.73 in 2017 dollars, right? So 10 cents was $1.73 in 2017 dollars. So even the price of comic books hasn't stayed up with, surpassed the CPI measure, right? If comic books had only stuck with CPI, took the rate of inflation into consideration, we should have been able to buy comic books at $1.73 in our stores right now. But comic books cost $5 right now. Anywhere between $3 to $5 right now, your basic comic book, right? So that's gone up huge as well. That's sort of showing you where the CPI really doesn't take into consideration certain things. So instead of buying one Action Comics #1, let's say we bought 10, so that makes it $1, right? So let's say it's $1, 1938, and we're sitting right here. Okay. 1910, 1920, 1930, 1940, so we're sitting right around here. Oops. So that's Action Comics number 1. Okay. Since I only did the calculation for one of them, I'm going to have to multiply this. But basically what happened in 2014 and 2016, I believe as well, Action Comics number 1, the higher grade ones, which is grade 9. 9 means it's very fine, near mint, right? Near mint minus, like it's in good quality, it's in good shape. Sold for $3.2 million, right? So 10 cents, if you bought it and if you kept it in good shape, would have returned $3.2 million, right? $1, 10 of those, if you assumed it was going to keep the same value, okay? Because if you had 10, then it wasn't as rare as it is now, right? Because I believe it's less than 10 that are graded at 9.0, right? I think there's only 4 or 5 of those around. But I actually live in a city right now, Victoria. I talked to a comic book store owner that told me that he actually personally knows 5 people that have Action Comics number 1 in their possession. Lower grades. I don't know what the grades are. We didn't talk about it, but I'm assuming it's lower grades as well. But supposedly there's 5 of them in my city alone. That's one reason I moved to the city as well. It's got a huge comic book history to it. A lot of comic book people here. Okay, but 10 cents would have got you 3.2 million. So 10 of them would have got you 32 million. Pretty sweet. If the value kept the same. And just to give you a comparison of 5.5 Action Comics number 1 sold for about $1 million. So the different price between the 9 and the 5.5 was $2 million, 3 times, right? But basically, $1 investment in Action Comics number 1 in 1938 would have got you $32 million. How am I going to put this on here? That works. Okay. $32 million. Wow. I hadn't planned on doing 10 comic books, so we're actually up here, right? We're above scale. So what I'm gonna do is I'm gonna extend this. Right? Oops. And we're basically up here. Oops. If it kept the same value, right? $1, $32 million, 32 million times your return. Wow, right? And the slope of this is compatible to this one, right? It's compatible to these guys. The return of these guys. Right. One big difference. It is less. These guys were able to get that kind of return in a short period of time, right? Now, let's kick it down a notch and take a look at the wages that we earn. How have wages varied over time? Okay. Now, in 1938, I did it for 1938 because we had data available for that. I also looked at salaries, so let's talk about salaries. In 1938, basically, hourly wage was 25 cents an hour. Okay, so if that's $1, so we're back down here again below this. So we're not going to look at hourly wages, but just to give you a heads up, an hour, the minimum wage was 25 cents an hour, and right now the minimum wage is 7.2 dollars an hour. Okay. In 1968, the minimum wage was $1.6. So 1960. So if we're talking about, I should make the ticks here. What are we at? That's 1940, 1950, 1960, that's 1970. 1970, the minimum wage was $1 something, $1.60. And right now, it's at 7.5, 7.2. So if we do the minimum wage, right? Min wage. Let's throw this on here for the fun of it. So minimum wage is this guy here, the orange. Okay. Minimum wage was $1.60. $1.60 in 1968. $1.60 in 1968, 1940, 50, 60, 70. So $1.60 is like here. And minimum wage right now is $7.25. $7.25. Okay. And that puts you about here. If you're doing minimum wage, you're out of the game, right? Because one thing you have to consider is, you look at these guys, right? This was the S&P, okay? This was gold, right? So gold was above S&P. If you come over here, the S&P, both the minimum and the maximum, are above gold. So that means if you consider these to be systems, right, and they are systems, they're different economic systems, if you're invested in gold, you could have easily bought into the S&P, right? But over here, if you're invested in gold, it's not as easy to buy into the S&P. You get less of the S&P for your gold. So what's happening when you see a crossover, right, with the slopes, with the lines, when you see a crossover, basically jumping from an upper system to a lower system is easy to do because it's based on its US dollars, based on its currency value, is valued more, so you can jump into it. But when one system is above another system, it's way more difficult to jump into the other system, right? This economic system, if you want to invest in, right? Or you have to buy a smaller chunk. So over here, I don't know what gold prices were here, $100, but if you're invested in gold here, and these guys are up here, or Action Comics is up there, hard time. If you look at 1938, the minimum wage in 1938 was 25 cents, right? So you could have bought, you worked 2.5 hours, you could have bought one Action Comics, right? If you worked, you had to, you could have, for 1 hour, you could have bought 2.5 Action Comics, right? So if you worked an hour, right? You worked 4 hours, which is $1, you could have bought 10 Action Comics, right? If you bought 10 Action Comics in 1938 with your 25-cent minimum wage income, right? You were in the game for all of these, right? In 2017 and before that. But the price of Action Comics hasn't gone up in that amount. I believe in or Superman #1, I can't remember if it was Superman #1 or Action Comics. I'm pretty sure it was Superman #1, not Action Comics #1, which we're talking about. In 1970 was worth $100. In 1980, Superman #1 was worth $1,200. And I remember in 1994, which is right here, 1992, 1993, Action Comics #1 sold for $160,000, and at that time was breaking records, right? So Action Comics #1, let's put this up here too. Action Comics #1, because I know this, I heard about this in at a convention, I believe. $160,000. 94. Let's say 92. I think it was 92. Okay. And let's put the dot there. So 1992 cost you $160,000, 10,000. Oh, I forgot to put a little tick on the 100,000 here. Yeah. So 1992, which is about the same as 1994, this thing costs you this much, $160,000, right? Not $200,000. $200,000 would be up there a little bit more. $160,000. Oops, 94 is going to be further over, isn't it? It's going to be here. Hopefully I'm doing this right. Maybe. So it was like here, right? Hey. That would be Action Comics number 1. It pretty much fits a linear scale on a logarithmic graph, which is a good thing, right? It could have maybe done this a little bit, price gone up, or fluctuated, comes down. On a log scale, it's difficult. Looks like a linear line to a certain degree, right? So if you bought 4 Action Comics number 1s in 1938, working minimum wage, 4 hours of your time, stored that over time, right now, in 2017, you could have $32 million. So keep this in mind. In every period in our lives, right, there are times where even though you're not in one of these systems, there are investments you can make that could possibly increase your slope, give you a better return than what you're in right now, right? If we go back to the minimum wage here in 1968, the minimum wage, is that where we were? The minimum wage puts you $7.25, right? That's the slope there. So if you're here right now, you should be thinking, what type of systems can you invest in? Here, possibly closer to your range here, that can kick you up down the road into a higher return, right? You're looking for a steeper slope. Are there any steep slopes coming in, right? And there are. Okay. While we're on this, actually, let's do the salaries as well. Because the salaries, we're just going to do one salary from 1900, because that way we can put it on the scale here, right? The average income in 1900, okay, individual income in 1900 across the board was $438, which is equivalent to like $12,000 in 2017 dollars, right? If you take the deflation or rate of inflation into consideration, devaluation of your currency, but we're still going to stick with the $1,900, right? So $438 in 1920 was $1,400, but we're going to stick with the 1900. So 1900 average salary was $438. Okay, 438 minimum wage salary. So this should really be salary as well, wage. 438 would be around here. Okay. And the average salary right now, this was, you know, depending on different measures, you could measure average salary, individual salary, or you could measure average income per household. I took one of the measures, like personal average for one person is $30,000. Household is $56,000. That's basically usually one person full-time at least and one person part-time, or 2 people full-time. But the average I took as being 48,000. Okay. On a log scale, it's not gonna, these numbers, and based on the other graphs that we have, are not going to make that much of a difference, right? So $48,000, so that's 10,000, that's 22,000. 48,000 would be around here, maybe a little bit lower, but I don't want to overlap too much, right? So what we have to do is take a look at the slope, and that's the slope there. That's the slope there, right? The multiple is 110 times, and the multiple here is not 110 times. Multiple here, we would just do it, but the multiple here is oh, let's just do it. We got 7.25 divided by 1.6 is 4.5 times, and there's different states have different minimum wages. Massachusetts has the highest one right now at $11. Okay, so if you're making just a salary, right? If you're making hourly salary, you need to think about systems. If you want to function in the society, if you want to have better returns, better growth, because that's what this is sort of about, then you need to think about different systems that you can put your money in. Okay. One other thing we're going to take a look at, two other things we're going to take a look at. We're going to look at home prices. Okay. Home prices in 1900 were seeing a bubble. They were seeing a peak. In 1900, home prices, an average home cost around, this is what I came across. It was hard to find this information, really difficult to find this information. It was around $5,000. Okay. In 1920, the average home price was $3,000. Okay. So 5,000, 3,000. So they're saying $5,000 here was the average home price in 1900. And in 1920, which is this tick here, is around 3,000. So around here. So what I'm going to do, I'm going to take the average. I'm going to make it $4,000. Home. Let's make this home. House. Not home, but house. Okay. So light green is house. And let's put the average price in 1900, 4,000. And keep in mind, you know, what type of houses you were getting at that period. Keep in mind that most places didn't have electricity, right? 4,000 will be around here, right? So those are houses. I should have brought other tape. Oh, I do have other tape. Let's tape these down. That way they're not sticking up. Okay. Let's tape these guys down too. And let's take these guys down. We're at it. There we go. Right. Oop. So $4,000 was average house in 1990. And in 2017, the average house in the United States, the median house is not the average. The median house, and the median is, we're going to talk about this when we do series on statistics, but median is the middle number, is $370,000. $307,000. That was the median. So 300. So, no, I put in too many zeros on this one. Silly me. That's a million. We got, let's make this one, and that should be $100,000, right? Of all the places to make little mistakes, right? So that's $100,000. So it's going to be $307,000, which is going to be somewhere around here, right? That's what a house is. And that's the slope there, right? And the multiple on that thing is going to be 307 divided by 4,000. It's 76 times your return, right? Gold was divided by 20 was 61 times, right? Inflation was supposed to be only 27 times, right? Your money's devalued 96%, right? This loses purchasing power, right? What's this guy? That's the minimum wage. Your wage has only gone up, what was it, 100 times? 110 times, but house prices have jumped up 76 times. Not bad, considering your wages, I guess. You have to work 10 years to buy a house here. Well, less than 10 years. It's about the same. Okay, but there's a big difference in living expenses, right? Your purchasing power, your cost of living, interest rates. Actually, interest rates are pretty low right now. Very nicely low. Okay. Now we're going to look at one more thing, one more measure. And that's something that's playing out right now. It's come into play because of the same reason that these guys were in play, right? Renaissance technologies, how they've come to play, right? Using automation, computer power to generate wealth, right? Wealth that we can measure with US dollars, okay? One thing that's come into play recently is something we talked about. I sort of gave you my opinion on it, which is cryptocurrencies, right? And when it comes to thinking about them as investing, or you thinking about them as currency, or thinking about them as commodity. For me, cryptocurrencies are sort of faith-based, trust-based, and they also have certain aspects of a commodity because they're based on scarcity. One of the reasons that the US dollar has depreciated, lost 96% of its purchasing power, right, is because there's more and more being printed, right? It's just being flooded with currency, with US dollars, right? To a level where 10 years ago in 2000 and I can't remember, 2008, 2009, 10, they stopped reporting the M3, I believe, how much money was being on the large scale, how much money was being dumped into the markets. And that's one of the reasons we're seeing the S&P. The S&Ps are this guy, the S&P at these levels, right? So let's take a look at Bitcoin as far as cryptocurrencies goes, because they're considered to be currency, but they're based on scarcity, and to a certain degree, the hurdles that Bitcoin faces or cryptocurrencies face that are based on scarcity is to get them into circulation, to increase their velocity. Okay, and once they increase their velocity, then what happens? They start changing hands more often. But since they're based on scarcity, most or a lot of people might be holding on to them, expecting for the value to go up because it's based on scarcity, right? I gave you my opinion regarding cryptocurrencies, and right now I'm not holding any cryptocurrencies as of mid-July, okay? And if you want to know my opinion regarding cryptocurrencies further, that video is the place to be. And again, please keep this in mind. This is not financial advice, okay? So cryptocurrencies, the history of Bitcoin is this. Well, you can take a look at the history, but the price of Bitcoin is this, okay? I believe in 2008 or so, 2009 or so, someone tried to sell 1,000 or 10,000 Bitcoins for $30 and there was no takers. Okay, so it was very hard to get rid of your currency. It wasn't very liquid, right? It lacked liquidity and liquidity, and it was very volatile, and it is still very volatile. But in 2009, you couldn't really sell Bitcoins. You know, we're talking about hundreds or thousands for a little bit of money. But in 2010, the price of Bitcoin was 6 cents, right? Again, we're off the scale. We're in the decimals here. Okay. So 6 cents, let's convert this to $1. So all we do is just 1 divided by 6. Oops, not 1 divided by 6, 1 divided by 0.06. You could have bought yourself, what? Oh, 100. 100 divided by 6. You could have bought yourself 16 you you could have bought yourself. I'm just checking, making sure, because in 2017 dollars 6 cents was only 7 cents, but that doesn't really make a difference. So you could have bought yourself 16 bitcoins, right? So let's make this, leave this as a dollar. We got the Bitcoin up there, so $1 in 2010. Let's put that here. $1 in 2010. So that's 2020, 2010 is right here. That's 2000. So 2010 right here. That's really when the game began for Bitcoin. Okay? And Bitcoin right now, the last I checked, its price was around 2,600. So if you bought 16 of them times 2,600, 16 times 2,600 is $41,600. $41,600. Make sure I got all this correct. I don't want to give you guys the wrong data. 41,600. Okay, so we're here. Bitcoin, 48,000, 41,600. So we're here somewhere. Okay. In 2017. I'm going to put it a little bit off. No, let's put it on the line. Okay. Now, the slope of this is much steeper than the slope of this, right? Much steeper. How much steeper? You could take the slopes, but I'm not really going to get into that game right now. Basically, the multiple from these guys, Renaissance was 260, 230, let's say. The multiple of Bitcoin is 41600 divided by 1. 40. The multiple of Bitcoin is 41,000, right? This is what happens when you use trusted calculators. You refer to them for the most simple calculations, right? So this was 230, and this slope is 41,000. This is blowing away anything else, really. Okay. Superman was pretty good. Superman is really good, right? Superman's fantastic. Oh, did I divide by 10 on this one? No, it was a multiple. It was $1. $1 of this, yeah. Same deal to a certain degree. Okay, so this is something you have to really keep in mind when it comes to economic systems at play. And this ties into what we are talking about in series 4 of the language of mathematics, when we're talking about jumping from one system to another system, because this is what we really have to keep in mind when we're thinking about personal finances, is different economic games at play, right? And we just talked about 2, 4, 6, 8, 9 of them. Only 9, right? There are multiple other things you can invest your time and energy and your funds in, right? There's different types of, if you're thinking about buying a home, there's real estate. There's different types of real estate you could buy. There are different types of cryptocurrencies you could buy. There are different types of funds. There are different types of comic books, right? This is one of the best returns. But there are other comic books that have given you phenomenal return in shorter periods of time as well, right? Walking Dead #1, Harbinger #1, right? First appearance of Venom, right? First full appearance of Venom. Amazing Spider-Man 300, right? Not phenomenal return like this one, or Walking Dead return, but there are other returns. Saga #1. Those are shorter periods of time. Those are in this time frame we're talking about here, right? A few dollars investments gets you a few hundred or a few thousand, right? So if you're, think about it. Which system are you functioning in? If you're functioning in a lower down system where your returns aren't as much as you'd like, then you can take a look at these systems, see if they're models are valid, if you plan on saving to jump into those systems, or if you're in this system, there are lower down systems that are coming into play which are going to surpass your growth rate. Your, over time will preserve your wealth or increase your wealth at a lot better rate than the system you might be invested in, okay? And again, keep in mind that this isn't financial advice. This is just quantifying the different economic systems we have at play and taking a look at how they vary, because when it comes to personal finance, when it comes to wealth, we're thinking about growth, but this is only the things that seem tangible to us right now. There are non-tangible to a certain degree, things that we haven't quantified that are worth a lot, worth more than this, give you returns much more than this, right? There are different types of currencies at play. This is the US dollar. There are local currencies at play, right? When certain economies to a certain degree go under stress, all of a sudden disruptive innovation comes into play and new opportunities arise, right? Greece being one of them during the financial crisis for Greece, where basically if you look at government statistics, they give you unemployment rates that are huge, they give you GDP that is very low, all this stuff happening. But GDP is a measure of what the government is keeping track of or can keep track of, and the taxes that they're collecting. So GDP, I know I'm going off a little bit here, but we are going to touch up on this stuff. But I want to really emphasize the point, using Greece as an example. But Greece, the GDP of a country is basically how much taxes a country is taking in and how much money they have, how they can manage their finances, right? They're basically looking at this, but at a larger scale, right? But once the financial crisis hit Greece, what happened was the taxes went up, the services that the government was providing went down, certain banks closed their doors, they confiscated certain types of funds, certain funds, especially in Cyprus, right? All of a sudden people have to scramble and had to adjust to the system, and they basically came up with disruptive innovation. And in Greece there were basically barter systems put in place where people were doing trade on a personal level, right? They weren't trading everything into a currency and then using the currency as the exchange of medium, right? What they used to be able to trade between each other, they just bypassed the currency and did straight trades. And websites came into play and different types of technology came into play where people could go on there and offer certain goods or services and exchange those for other goods and services, right? This isn't the only thing in play. Everything is not necessarily measured in dollars or currencies that lose their value over time. But since most of us are forced into the system, we really have to think about other systems that have more potential, more growth, okay, that will either preserve our wealth and or give us a certain type of growth, whatever type of growth we're thinking about. And one of the most important things we have to keep in mind when we talked about at the beginning of this video is make sure you diversify. Do not be in one system, because if things go wrong, some of these things may do a about turn and start having a negative return, right? Devaluing, losing their worth, you might start losing your wealth. So make sure you're diversified, but diversify in systems you either know, right? Or systems where you can get the information and spend the time required to understand how those systems operate, or hire someone to give you financial advice regarding whatever it is that you're planning on investing your time and energy on, right? I think that's enough. Yeah. That's a fair bit to think about, and that's a good place for us to sort of do a pause, sort of finish off these set of videos anyway. When it comes to personal finance, it's pretty important to think about these things. And you know, your weighting doesn't have to be the same in all of them. You could do what the CPI does, right? Have the measure your wealth invested a little bit in this, a little bit in that, a little bit in that, a little bit in that. And keep in mind, things that are usually generally more steeper slope, they have a faster growth rate, exponential growth rate, that only lasts for a certain period of time. Keep your time frame in mind, right? Are you going to be invested for 117 years? I don't think so. Average lifespan in the United States and Canada is, I think for males anyway, it's 82, high 70s, let's say 80 mark for both Canada and the United States, both male and female, right? Well, if you're 80, you know, where are you going to function? For a certain period of that time, you're a child, right? For a certain that time, you're not working, right? So what's your work time frame, timeline, right? From when have you started working to when can you continue working, or will you continue working to generate income, to invest in certain systems where you will not lose your wealth. You will at least maintain your wealth, right? I hope this did a good little summing up of what we talked about so far and what we have to keep in mind. And this stuff is directly going to link into Series 4 of the Language of Mathematics. And we're going to talk a lot more about this and delve down into some of these systems. One of the ones we're going to delve, give you a little heads up, one of the ones we're going to delve into at some point is comic books. And I've laid out some videos, a set of videos I'd like to do on that, and basically quantify investing in comic books a little bit more than the way they've been quantified right now, because it's very subjective of what a worth of a comic book is. If you're in the industry, if you know what I'm talking about, the grading system is one way people are going with slabbing comics and stuff like this, but I like to take a look at the numbers and quantify some of those numbers, and I've done some research into it, and I've put together some data, some tables, and at some point we will be talking about this a lot more. Okay, I guess that's about it. I hope you enjoyed this set of videos. It was fun to create. It took a little bit of time. Sorry for the slow progression of these videos, but I really lost myself in the data and really enjoyed looking at the stuff and trying to figure out a way of what a good way is to present this information. Okay, that's it for now. I'll see you guys in the next video.